T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery.
Go for launch, GC. Go. Guidance, go. Fido, go. Bravo, go. GC. Go. Max, go. Eagle, go. Eco, go. DeFeo, go. Payloads, go. Scan for the customer, go. DPS, we're go. Eco, go. Booster, go. Surgeon, go. PRS, go. Okay. And let's see, we'll wait on GNC.
T-minus 60 seconds and counting. We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start.
MC, I hear you loud and clear. 5 mics. Tell me. Have you loud and clear as well? Thanks, sir.
Go for auto sequence start.
And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, start, 2, 1, booster ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff.
Should have a good forward link now in SM. Okay, you sound good.
Discovery Houston, negative return.
Copy, a negative return.
With the mustache and a supernova, tossed off the cliffs of Dover, washed up on a faraway shore in the arms of the daughter of the buffalo. Mama said he was a chosen one, Ray Ray said he was the other one. All that paid no mind inside his econo line. Swallow our planets, the prophets of doom, corner link trust the white man trapping the black man. He just saving all his voodoo for you, just for you. Never trust the white man trapping the black man. He just saving all his voodoo for you, just for you. When the night's getting cold, you're needing a shoulder. Puff out your chest and be a little bolder. All we do is buy and hold. There will be shills who wanna steal your thrills. There will be friends who hold till the end. There will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead. Panic and fear really are near. It's not ours to own. We have shown that all we do is buy and move. Oh, there will be chills who wanna steal your thrills. There will be friends who hold till the end, and there will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead. So when the nights get colder, you're needing that shoulder. The Ape's got your back. We got each other. All we do is rely and hope.
Good morning, you filthy apes. Welcome to AMC and APE, where we buy, we hold, and we screw those hedgies. Screw them! That's right. This is where we like to fling some poo and eat crayons for breakfast. Rock strong. Good morning, guys. Good morning, apes. Inverted yields with falling inflation. We have that scenario set up. However, inverted yields do not signify that it's over, and they're not getting better. You should be seeing the inverted yields getting better and becoming not inverted. so, and that's not the case. So why do we have falling inflation? I think maybe some of the interest rate hikes has helped a little bit and getting us down on inflation, but the numbers may start turning back around, and the Fed may have continue to increasing rates. The target rate probability for June 14th is now 35.6%. I have no idea what it was yesterday. I know it was 30-something percent, but I'm pretty sure this is a little bit higher than what it was yesterday. 35.6% chance. This is over 1/3 now of a chance at seeing interest rates raising another 25 basis points in approximately 26 days, 6 hours, 46 minutes, and 45 seconds. One of the things that I want to show you this morning is this. What you're looking at here is the on-loan amount versus the reported short interest that we've had historically. Actually, let me grab a screenshot of this real quick here because I'm going to do some drawing. This is January right here of 2001. You can see that down at the bottom of the page. This is our June run-up right here. This is our March, I think this is our March 2022 run. MAR 22. So we got 21 over here. All right, so here's the thing. I want you to notice a pattern here that occurs oftentimes when you see big run-ups that are incoming. Not always, but a lot of times. On loan amount dips. Sometimes it's more often than not, it's a large quantity. But in this particular example for the March run, there was two different dips. There was this one right here, and then there's this one right here. The dip right here preceded a little bit of a rundown, followed by a period of time where price was running up. We just had a pretty massive dip here, and we're starting to head back up a little bit, but obviously we don't know if this is going to continue downwards, if this is kind of like a momentary trend up before continuing down more. But oftentimes these big dips occur before big run-ups. This one's a little bit of a smaller dip over here that occurred prior to the January 21st run-up. And I've told you guys this on many occasions that on loan average age per day, when you look at that, it shows that a lot of positions that are older are getting closed out. And so you have right before big runs, and you can see this massive closing out of positions that were older. Now you can see the on loan amounts driving upwards here leading into January, but the on loan average age per day was dropping because they were getting rid of older shorted positions. But then you can see again another drop right here in on loan average age per day with that little dip that you had in well, when was this? March, middle of March, going into June's big run up. You got another big drop happening right over here in on loan average age per day, and we had a big run up in starting in about June of 2022, leading up until about August. And you got a couple of smaller ones in here that were around some run ups that we had. They were really tiny run ups, but now you've got this current one. None of those, by the way, had big, huge amounts of on loan amount dropping nearly as much as what it has just recently. But here's the other part that I want to show you guys. Our brokers who are lending out shares, they make money when they're lending. So the more lending that they're doing, the more money they're making. When they're not making as much money, they have to do something in order to start making more money. That's the goal, right? Any business wants to make money. So all this shaded in area, if I were to like kind of draw some lines in here between the difference between where on loan amount is versus where short interest is, you can see it's starting to creep down a little bit here, and it's starting to get tighter, which means they're not making as much money. The closer this gets, the closer the on loan amount gets down to the short interest amount, the less money that's being made. And you can see that in order to do something to make money, in order to get more lending to start coming in, sometimes that involves buying shares in order to be able to lend more. There's a lot of different things that institutions can do to try and increase that amount, but you can see here they were not making a whole lot of money. Of course, that's not why I think we moved up in January. That was more of a sympathetic move to what was happening with the market, especially with GME. But more money started getting made once they had closed out some positions. You can see there's by institutions that were lending shares in this area and here. Not so much money was being made during this period of time, so something had to be done so they could start making more money. This is a big money-making zone in here for institutions. Big money-making zone. When did that start? That started right around February. Actually, the on loan amount touched down on the short interest amount, or very close to it, right about here. where exchange reported short interest was 83.41 million shares on the on loan amount was 90.61. They were almost, I mean, 7 million, about 7 million shares difference. And that was November 29th. And it was a period of time that I will never forget, because I remember looking back at this and thinking to myself, oh my gosh, we're in super trouble. I started seeing a bunch of call positions by hedge funds like Citadel, who are short normally AMC, that started going long. They started going long on AMC at that time. And our brokers decided, nope, we don't want this price to run yet. We're not ready because we haven't made ours. And so they have made theirs ever since that November date. You can see the on loan amount has been increasing more and more and more and more, and they've been making theirs ever since that November period. I don't know if we're going to start running up right away, but I can tell you that we've had a pretty significant dip in the on loan amount, and usually when that happens, an incoming price increase is coming. You're going to ask me for a date? 2 weeks. That's it. It's 2 weeks. I don't know. But I can definitely see that there's a correlation to closing out of loan positions and price running. I think we're going to see this debt ceiling announcement next week, perhaps at the latest. I think we'll see the debt ceiling raised at that point, and I think very soon thereafter, I think the market's going to start trending down. In the meantime, I think the market will probably continue to head up. But I want to show you one last thing. And I think this is probably a historical event that's probably never occurred before. So I don't really have anything to base it off of. But let me show you something. On a weekly, and I've done this only on a couple occasions where I've shown this to you, but on a weekly using the Ichimoku cloud, there's been only 3 times in history where we've seen some massive red clouds on a weekly. And red clouds are identified as a turning point at which price will start rising back up after having gone down through a green cloud, right? So here you have down through a green cloud, up through a red cloud. Point number 1, red cloud started, the big red cloud started here in April of 2001. The next big red cloud started in July of 2008. The next big red cloud on the SPY started in November of 2022. We are breaking through that cloud currently, and a green cloud is forming right behind it. Price likes to move down through green clouds and up through red clouds. We may see some initial movement upwards on this, but never in history, never in recorded history have we ever seen price move back down through the front side, I think, of one of these green clouds, ever. I don't know of an instance where I've seen that happen on the front side of a green cloud. It didn't happen here. And I mean, I only have 2 other times in history to pull from, and it didn't happen here. So no other time in history, the other 2 times that I have data for to look at, I've never seen that happen before. So the question is this market going to truly continue to rise? Or is the debt ceiling going to get raised, and then we're going to see price starting to curl back over and heading back down? If price were, and I've mentioned this on several occasions, if price were to fall through a thicker portion of the red cloud and drop down through a red cloud, which, by the way, this red cloud goes right up until the end of middle September. If price were to fall through this cloud anytime between now and September, I would be looking for a massive, massive drop on this because it would be extremely bearish to have happen. Otherwise, lagging lines above price, conversions above base, everything is pointing towards more upwards momentum here. We've broken the cloud officially as of yesterday. The aftermarket hours was really extremely helpful for seeing that clear break of the cloud especially. Let me get rid of Ichimoku. In the aftermarket hours yesterday, it really got that big, huge bump up to 420. DXY was up and is also broken and found some resistance a little bit around 103. This is that 62% chance that we may see this continue up higher. If this does continue up higher, the market will head back down. I cannot even stress to you enough, like this next week is probably one of the most biggest weeks that probably any of us will have ever seen in the market. It will determine our future this next week. I'm pretty sure of it. It'll determine what this economy is going to look like going forward. Pretty sure it'll be next week. We'll see. All right, let's take a look at these numbers, see what we got going on for the day today. Let me see what you guys are saying. Let the price rise. Love everything you do, Casey, but after over 2 years, I've come to the conclusion that the charts, etc., mean nothing in this play. It's all corruption. I don't agree at all. In fact, I think the charts are really telling. Let's see here. In fact, not only are they telling, but I was telling you guys that Bitcoin was going to be dropping through multiple levels of support long before it ever happened. I was also telling you that the SPY was going to be dropping long before it ever happened, and here we are. It's just that you're not looking at the macro, the bigger picture. The charts are very, very telling. It's all spin theory. Let me clear up with AMC, not the rest of the market. Okay. Well, I think the charts are pretty telling on AMC as well. But that's okay. We don't have to agree. Casey, do you see a correlation in which we need SPY to rip in order for AMC and Ape to rip along? So here's the thing. We have ETFs in this market that encompass like lots of different stocks, right? And this market is actually really kind of being driven backwards. It should be the stock prices that are driving the ETFs, and we're actually in reverse. I think that we have a bunch of ETFs that are driving the market instead of the other way around. And so what I would suggest to you is that if you saw, for example, a bunch of different companies, maybe, and I hate saying this because we've been grouped into these, and I don't like repeating it, but if we saw a bunch of meme stocks that had their tentacles into a bunch of other ETFs that are out there, more than likely you're going to see the driving upwards momentum of the overall market from that, because when you start seeing those ETFs rise in value, that helps raise the price of other stocks as well, even if the other stocks are going down. So it kind of balances it out a little bit. It kind of takes a little bit of the pressure off of the individual stocks themselves from price reduction. So in a sense, you will see the market move upwards at first. But very, very quickly thereafter, I think you'll start seeing, once money starts leaving the marketplace, I think very, very shortly thereafter, you'll start seeing a tanking of the market as well. That's how it works. When money's not there, when there's no more money to be, buying things, the market goes down. Let's see here. let's take a look at these numbers. I'm going to clean off my glasses, take you guys over the other page here. I'm not going to be able to see what it is you guys are saying, so hold those personal thoughts, comments, questions, or concerns until you see the big tramp back up on the screen. Also, I want to give a shout out to CensoredContent for his maintaining his reigning champion title as the all-time most winningest. Is that a word? Winningest contestants for movie trivia. Congratulations to him. He won by 1 point, narrowly missing the win. Who did we have? Who was it in second? Was it Pirate Porn? Yeah, Pirate Porn was in second. And then tied for third place, we had NC Proud Dad and Frank Lehman. Yeah, also Frank Lehman being a returning champion from the past. It's very, very close. Let's see here. Cleaning these glasses off. Two-factor authentication. If you don't have it, you may want to consider getting it, as it could prevent somebody from getting into your account that shouldn't be in your account. When you do sign up for it, make sure you set up a secondary number to be able to receive that information in case something happens to your primary. And while you're at it, make sure you're taking pictures or video footage and saving it for your own personal records of what it is that you hold within your account. Obviously, the more active your account is, the more often you should be taking these pictures. The less active, you could probably go a little bit longer without taking them. The reason for this is that you don't know, you can't trust your broker. You don't know if your broker is going to suddenly report one day that you have a different holding than what it is that you actually had been reported to you previously. Make sure you're holding them accountable. Because the last thing you want to do is wake up one morning and find out that they're telling you that you only have half the shares that you're supposed to have, or 0 shares that you're supposed to have, and you having no proof. Make sure you're collecting that. You need those receipts for what it is that you hold. All right, let's take a look at these numbers. Starting on the top left-hand side, price prediction tally points. Ape closed at $1.63, AMC at $5.07. The combined price was $6.70, which means that anybody who had a price prediction of $5.20 to $8.20 would have gotten the price prediction correct for the day. Nobody had that. The closest would have been Eric with 513 to 813. Very, very close, but nobody got. So points around though. Everybody got a point for getting the price predictions correct. That means we're going into a 4-way tie into today. So whoever has the closest price prediction for the day today will be the winner for the week. It all comes down to Friday. All right. Points added. Short exempt volume on AMC was 161.2 thousand. Let's see here. Slightly increasing. Ooh. I feel a little carpal tunnel working its way into my arm right here. Let's take a look at what we got going on here on Ape. Sudden pain in my arm. Right arm, guys. I think it's left arm if it's a heart attack. I don't know. It's not a heart attack. It's not a tumor. Let's see here. APE. 57.6 thousand shares of short exempt volume for Ape. A little bit up from yesterday. AMC was down 0.59 for the day yesterday. And Ape was up 1.24. Utilization. Give me 1 second to update. On AMC, I'm still seeing 100% utilization. Let me verify the date. It is showing the 18th, which is correct. That puts us on day number 88 straight trading days in a row of 100% utilization. And taking a look at APE, 54.23. Woo, big drop there, 54.23%. Must have had a lot of return shares yesterday. I mean, we did see at the end of the day, I think we were around like 3 million. Yeah, 3.24 million is what we had in the last hour when we were looking at the data yesterday. So that kind of makes a little bit of sense. We'll take a look at the rest of the numbers here in a few minutes, but let's move on. Max Pain did drop, and that was simply because we saw a bunch of $13 calls and puts that were being closed out. I haven't looked at the options yet to know whether or not that's going to change, but I would assume it's probably going to stick right around $8 unless they close more out. If this drops, if it doesn't stick at $8, then they probably closed out some more puts and calls at a $13 strike, in which case we would probably see this drop down to somewhere between, probably somewhere right around $6. Let's give it a refresh. Max Pain is $8 still. Taking a look at off exchange and EDGX data for AMC, it was 50.54% going through off exchange. EDGX was 9.5%. The grand total between the two was 60.04%. Normally by the end of a day, I would expect to see about 64%, so it was 3.96% lower than what it should have been. CHX volume was 2.13% of the total daily volume, so a bunch of volume at the end of the day there going through that exchange. The 30-day average is 3.19. 229,000 shares is pretty elevated. I normally get excited over 500,000 and really excited over 1 million shares, but still 229,000 shares is not a bashful amount. Taking a look at APE, 53.47% going through off exchange. EDGX was at 4.93. The grand total is 58.4%. That's about 5.6% lower than it should be by this time of the day. CHX volume is 0.03 with a 30-day average of 0.09. And let's see here. GME's CHX volume is 0.25 with a 30-day average of 0.2. So definitely some closing out of failure to deliver is occurring there through CHX on GME. But the volume was really low. It's only 5.2 thousand shares, not very much. So low volume is going to, the volume percentage might be a lot, but the total volume was low, so it didn't amount to much. Taking a look at options, let's see what we got going on here. As of yesterday, the highest amount of call volume was at a $10 strike with 76.2 thousand contracts. That is still the case, and it's the exact same number, so no changes in positions there. Highest amount of volume for puts yesterday was at a $4 strike. There was 91.1 thousand contracts. There's now 91,000 contracts. So that did drop just a hair. Take you guys over the other screen here and move some screens around, give a little bit of music to you, and we'll take a look at the rest of the data. All right, so we did indeed get the breakout, or at least the attempt to break out of this long 14-day wedge here. And we got it just a little bit after the box, but it was more aftermarket hour trading and pre-market trading this morning that caused it to just kind of trade sideways. We're not really seeing the big push out of this as of yet. So I would not expect to say that this is a full breakout just as of yet, because I mean we should be seeing increased volume and increasing price breaking out of a wedge like this, and right now not seeing it. So we'll have to wait for either some volume or some price to move us up here to really kind of know or signify that we're breaking out of this trend. Combined price of AMC and APE is at $6.71. Short share interest of the free float's at 25.06%. Utilization, 100%. It's been that way for the last straight 88 days in a row. On loan amount, let me erase my board here real quick. On loan amount, day over day, slightly decreased from 168.8 million to 168.59. So we're looking at 210,000 shares having been returned yesterday. Of course, Ortex is going to estimate about 700,000 of that was 70,000 of that was probably short interest that was closed out day over day. Let's take a look at what they're estimating. They said 25.07% short share interest of the free float to 25.06. So yeah, we're looking at 70 or what is that? 61.5 thousand. I don't even have to do the math. It's 61.5 thousand shares having been returned in short interest. Actually, it should be 61.9. We'll just call it 62,000 shares. Let's just round it. 62,000 shares haven't been returned. Wait a minute. No, I'm sorry. 52,000. I don't know why I'm saying 62. 52,000 shares. That's actually only about a quarter of the total amount of shares that were returned yesterday in on loan amount. Taking a look at on loan average age per day, it is still dipping. Went from 96.85 down to 95.89. Security lending volume did decrease a little bit from 21.29 to 12.17 million. On APE, short share interest of the free float went up, is at 5.56. I think that's a little bit down from what it was before. But let's take a look here at some of our numbers. There's utilization day over day dropping pretty significantly. It went from 60.9% to 54.23. On loan amount did take a big dip there, and it went from 23.07 million to 19.37. So wow. Okay. Let's do some math here. 2307, 1937. 3.7 million shares returned in total yesterday on APE. It's obviously going to have the effect of lowering the short share interest of the free float, estimated from 5.78 down to 5.56. On loan average age per day, moving upwards, which means that they closed out mainly newer to middle-aged positions. Maybe some long position or older positions as well too here, but it went from 87.55 million shares on loan average age per day to 92.28. Sorry, days, not shares. Security lending volume did increase with the return of those shares from 821.8 thousand shares to 3.79. Orders by Fidelity customers. I do not expect to see AMC APE or GME due to low volume on this list here, but this is, I'm looking at this data here, and it was only the last 4 minutes of the day that's being provided. So we might be on this list if the last 4 minutes of trades for the day yesterday were large quantities. They were not. SSR triggers for the day on AMC at $4.56 for APE. 1.467. Shares showing back up as available to borrow here. Looks like they kept returning shares up until it went up to about 900,000. So 150,000 shares borrowed so far for the day today. Yesterday it was about 1 million shares. Fees are currently at 68.6%. Currently, there's 331.8 thousand contracts out of the money on the calls versus 34.6 thousand contracts that are in the money. 293.8 thousand contracts are out of the money on the puts versus 182.2 thousand contracts that are in the money. Futures. VIX is showing down 0.87. So I would expect maybe somewhere around like between slightly positive to maybe around 0.2% up on the individual markets. It looks like they're up a little bit more than that. They're up anywhere from 0.11 to 0.47. Actually, I don't want to look at that. Some of the early moving banks in pre-market this morning. Let's see what we got going on here. Biggest movers in pre-market for banks are, it doesn't look like any of them are moving dramatically. Yeah, nothing really moving too dramatically in the pre-market. Ethereum Classic is currently showing down 0.03%. The US dollar is down 0.27 at 103.3. Oil is up 0.24. Mortgage-backed securities are down anywhere from 0.49 to 0.52. And SPY is up 0.26. Tesla is up in the pre-market 0.08. Amazon up 0.11. Cinemark is down 0.99. Doge is down 0.02. Bitcoin is up 0.1 at 26.8K a coin. GME is down 0.35. HYMC is down 0.03. NCMI is down 3.13. Hood is down 0.93. Ape is down 0.61 and AMC is up 0.2. Inflow versus outflow for the day today, we have, or for yesterday, I should say, there was approximately, let's just call it 1.15. So $1,150,000 more outflow than inflow. So far this morning, we have 7,000 shares having been traded on AMC, with a 4-hour time interval looking like there's more buying pressure than selling pressure than RSI of 41.86, which is below average. On a 1-hour time interval, more buying pressure than selling pressure than RSI of 48.45, which is average. On a 30-minute interval, more buying pressure than selling pressure than RSI of 48.71, which is average. And on a 5-minute interval, more selling pressure than the buying pressure than RSI of 50, which is average. Taking a look at APE, there's approximately $900,000 more outflow than inflow. 7,000 shares is well traded on APE so far for the day today. On a 4-hour chart, there's more equal amounts of buying and selling pressure than RSI of 54.75, which is slightly above average. On a 1-hour time interval, we've got more selling pressure than buying pressure than RSI of 56.07, which is slightly above average. On a 30-minute interval, more buying pressure than selling pressure than RSI 58.54, which is above average. And on a 5-minute interval, we've got more buying pressure and selling pressure than RSI of 61.58, which is above average. Taking a look at the Ichimoku cloud on a 1-hour time interval for AMC, or APE rather. Lagging line is right at price line. Conversion is just slightly below base. And price is above the cloud. Kind of, sort of. I mean, the cloud's kind of non-existent because price has been trading so sideways for a while now that the cloud is just kind of deciding to go sideways. But we are currently above the cloud. To turn this into a buy signal for the day-to-day, we're going to have to see price get up above 164. And we're at 162 right now. Taking a look at a 4-hour chart, we've got lagging line is above price line. Conversion is just slightly a hair above base. To turn this into a buy signal for the day, a strong buy signal for the day-to-day, we're probably going to need to see price stay above. I think getting it above 163 is probably going to be target, but I'm going to say 165. Let's just go 164. 164 is going to be the single-digit number that we need to see above on both a 4-hour and a 1-hour chart here. So no change in that value. They're in agreement. However, price does like to move down through green clouds, so I'm not especially expecting this to move up just yet. Although there's thinning portion over here. Let's see here. What do we got going on AMC? On AMC on a 1-hour chart, lagging line is where is it at? It's on price line. Conversion's above base. Price is above the cloud. We are breaking out of the cloud here, and we should see some upwards momentum if price can get above the conversion. We're going to need to see the lagging line above price line at some point in order to see a continued buy here, which is going to be about $5.16. The 4-hour chart, lagging line below price line, conversion below base. This becomes a buy signal if we can get the lagging line up above price line, which for the day today is going to be around 537. 537 should get the conversion above the base. So 516 and 537 are our push points. And with that, we got 9 minutes before pokey stick of volume. Oops. Alrighty. All right, let's check Fed meetings because I think Powell and Bernanke are going to be speaking today. So let me pull that up and see what we got going on there. Be interesting to see what they're going to try and sell as a future. 519. Yep, there it is. It's going to be at 11 a.m. Eastern Standard Time, so expect around 10 a.m. We'll watch that. All right, let's see what you guys are saying. Let's see. Batter says, Casey, you think a sharp price dip would be likely in order to bounce off of previous resistance and turn it into new support? I mean, that's typically the case, right? Like, I mean, a lot of times you see like double bottoms before seeing a jettison back up. In our particular case for AMC, and I'm assuming you're talking about specifically AMC. Let me pull it back out to a daily real quick here and just kind of take a look at it. If there was a point to where I would say we've hit a double bottom, I think we've already kind of accomplished a double bottom down here at around that like $3 and I don't know, 3.90 around that range. I feel like we've already seen the double bottom that we needed. In fact, not only that, but there's 3 tests in here at 3.90 or $4 right there, right there, right there. We've had 3 tests of $4. A 4th test, I don't know. Seems a little unrealistic, but yeah. And then if and that's from a macro perspective, right? Like looking at it from a long term, I think we've touched this bottom here pretty good. And I think Bollinger Bands are pinching down pretty tightly here, which I think is showing kind of like a springing effect in the future of price movement. There's volume suppression occurring here. I mean, look at our average 3-month volume. Average 3-month volume is 31.34 million on AMC, right? And we're pulling off 10 to 13 million share days for like the last since May 11th. And if you want to just say 10 to 14 million share days, then it's since May 10th. I mean, we've been pulling some pretty low volume here, and you see that compression just before the springing movement of price. So if it does retest some type of bottom here, I would think that it would probably be more of a not a macro bottom, but more of a more current bottom. It could be like the 490. What did we hit back here? 490 something. 487, 490. We could see one more test on that number, which I've already mentioned before that, we could see one more test of that. And we almost got it. I think we just found too much support in price coming down yesterday that they were never able to really fully bring it back down to those kind of numbers. Whether or not we continue to get that same buying support today or not, we'll see. I don't see it in the volume, but yeah, we'll see. Richard says, do you think the talk about Biden's impeachment might have something to do with the market price? Not really. I mean, no, not really. I mean, they're just talking about it though, right? Talking doesn't do crap. Maybe if they actually came through with an impeachment, maybe then, but talking is just talking. Which one, Derek? Are you talking about the June one? That was one of the lowest time. That was one of the more least amount of volatile times that we've seen. But I want you to keep something in mind here too, is that we had much what's the word I'm going to use here? Residual volume still kind of rolling through from January in the June 2021 volume move. So if I were going to compare apples to apples, I would probably look at like prior to January of 2021 to compare volume. And if you want those numbers, give me 1 second. What sheet am I pulling up here? I'm pulling up sheep. 1 second. Let me take you to the other page here real quick, so I don't blind you guys, so I can open up another page, because I don't have that one open. But I did volume analysis on AMC like a month or no, probably a month after the January run up. So like in February of 2021, I did volume analysis. So I have all the data pulled back from as far back as September of 2020. Hold on a second here. All right, let's see here. We had volume was ranging from October 25th. I can give you an average volume actually leading into the run up. Let's use from October 25th to September 12th. And give me 1 second here while I do an average on this. What? What's wrong with you? Let's see here. There we go. The average volume, let me just convert this number real quick with some commas so I can see it easier. Was 4,984,458 shares. Now remember, our float was a lot smaller back then. I'd say, I'm trying to remember what it was back then. I want to say that it was probably close to half the size that we are now, maybe a little bit more than that. So yeah, I mean, we had a much smaller float back then. But we were doing the average daily volume from 9:25 until 10:12 was basically 5 million shares a day. Then we had this sudden spike in volume, and I'll do the spike in volume. Let me see what the dates are pulling on this one. D13. D3. I don't want D3. I want we had a little bit of a spike in volume on September 13th. Give me 1 second while I calculate this. And that sudden spike in volume from the 13th of September to November 6th averaged about 13 million shares per day for that time frame. And then on November the 9th, we had this big jump in price and volume. It was a 51.4% jump in price on November the 9th, and the total amount of volume that occurred in that single day was 132 million shares. And some people probably don't remember this because a lot of us weren't invested in the marketplace when that happened. And I can only imagine anybody who would have been invested probably in November of 2020. They would have been going like, what the hell just happened? Like, where did that come from? 51% increase in price. The closing price for the day went from $2.49 a share to $3.77 a share. And you're probably going like, that doesn't seem like a whole lot. Imagine Ape doing that right now. Imagine in a single day Ape going up a buck 25, right? Imagine us going from buck 63 to $2 ish. Not $2, sorry, $3. Pretty hefty. And the volume was the crazy part. The day-over-day volume increase was a 1,364% increase in volume, and the total amount was, like I said, 132 million shares traded that day. The crazy part about it is that the float at that time, I'm trying to remember off the top of my head. Give me 1 second. I think I can pull the data. The crazy thing about that is that if you go back and look at the float size, and I think I'm probably just going to be able to tell you outstanding shares. Maybe I can tell you float. Let me see. I can show you. I can tell you shares. Actually, I'm just going to tell you the float, free float share amount. And then I'm going to fact check the float amount first, because sometimes they modify the data a little bit based off of splits and whatnot. But at that time, the float size was being reported as about 56.92 million shares. So in a single day, more than double the amount of shares of the entire float were traded. Double the float was traded on that day. More than. I'm gonna have to go back and fact check this though to verify that the float indeed was only that much at that time. Let me just check something real quick here. 513, 2016. It's gonna be pretty close. Yeah. I think those numbers are pretty close. So big move. Oh my gosh. I think it's next week, Arthur. In regards to Robinhood trading next 24. What was the volume before run up? What was I think that's the question I answered already. Because they're hurting for money, Bird Eye. The reason Robinhood is doing what they're doing is because they're hurting for money. That's it. How do you squeeze more pennies out of every dollar that it is that you're transacting? And the answer is you extend your hours. Maggie, good morning to you. Derek says, hood who? That's funny. Oh shoot, 708. Pokey stick of volume already happened without me. Let's see what it was. 18,000 shares on AMC, giving us 28,000 in total Because I mean, even if I include all those other minutes afterwards, it's not even 1,000 shares. So yeah, 28,000 shares on AMC. That means I can't predict more than 5 to 25 million. And on Ape, 8,000 shares, giving us a total of 16,000 shares traded so far for the day today. Again, very low volume, 1 to 20 million tops. No change in volume predictions. Still. Casey, I DM'd you the movie trailer. Take a look. We're about movies and it needs promotion. Okay. Yeah. I can look into that. Where you said you DM'd me it. Let me look at it when I'm on break, and then I'll play it a little bit later. Yeah, CPR says I can only imagine on a Saturday night after a bottle of wine, your stock decisions will be swayed. You know, CPR, this is one of the things that I found out really quickly trading cryptocurrencies is that since it's a 24/7 thing, because I was running a an algorithmic checker to see if I could figure out exactly where they were moving prices. One of the most common things that was occurring in cryptocurrencies was big run-ups and rundowns when everybody's sleeping. And so if you went to sleep and you didn't have some kind of stop loss set up, you got screwed. So yeah, kind of crazy how that works out. But if you were awake, and since I work night shifts, it was never a problem for me because I was naturally just up during that time. So you can well imagine that a lot of mistakes are going to be made by anybody who's investing through Robinhood in 24-hour trading because nobody's going to be able to, or people are going to make mistakes, overnight decisions or lack of decisions that will cost them money. Aquatic Tours, good morning to you. Yeah, Ice Cream says, you snooze, you lose. It's terrible, right? I mean, I can't even. I mean, at least in Vegas, you can go to sleep and your money's safe. You can't do that. You can't do that in a someplace where your money is invested, and you know that's like putting your money on a craps table and it just sits there all night long while you go to sleep and you never get to rechange like where you're putting your bets or anything. It's terrible. So that's the worst way to lose money. And of course, Robinhood's going to pick up on that real quick, and they're going to be like, "Ooh, thank you. Yes, we will." Andrew says, "Yeah, Casey, I get your point, but you figured out the C." It's actually, Andrew, I would say the opposite. I would trade crypto when you're supposed to be sleeping. That's probably some of the best times to be trading crypto. That's when you get your biggest moves. So you go to sleep during the day and then you trade crypto at night. you you probably end up doing way better. Yeah, Bird Eye says crypto's for the weekends. Exactly. Watch those weekends. Those weekends are crazy, man. I can't. Yeah, weekends are rough. Yeah, attendees plus plus says Sunday was my day to lose, and that was the day that I was always working too. I worked the compressed shift week that I was working was front half nights. So that was my first night on Sunday nights, first night on to work, and I got to see it every Sunday. Everybody would go out on their 2 a.m., 3 a.m. lunch breaks and come back in talking about oh my gosh, did you see crypto? It was really common. Roseanne said, I had a hard time finding you this morning. I like to hide. Yeah, I don't know, Roseanne. I don't know what to do about it. There is one thing that I can do, Roseanne, and I'm not doing it. So I could monetize, and then I probably would pop up everywhere. We'd probably have a lot more people in here, and we don't need that. We just don't need it. I feel like we have a pretty good community. It grows naturally. I don't have to promote anything. It's word of mouth. You guys do a great job controlling things around here. It's happy. It's a happy place. So while it might be hard to find me, eventually you get there. Bird Eye says the first night of Robinhood going 24 hours, I'm staying up all night watching crypto. I mean, it's already traded out 24-hour on crypto, but I mean, yeah, it could shoot up pretty quickly. I could see that happening. Andrew says crypto is a Ponzi scheme. Ooh, Andrew, you're gonna be pissing some people off, man. Don't you dare talk about crypto like that. Don't you dare tell the truth. It is not. You just don't understand blockchain. I can feel the hate already building. I'm just saying. Not from me. You're not gonna get any hate from me, but I mean, seriously. Uh, good comment. Thorbladed says, I'm going to hire a little kid down the street for $1 to stay up at night and give me a call if the market moves. For his summer vacation, you're gonna tell him to go pay him to play video games in the middle of the night, and then blow your phone up if something happens. Barry says, what you're saying is that the biggest moves in crypto are when the USA sleeps. Sometimes, not always, but a lot of times, yeah. Historically, I feel like that's probably pretty correct. I mean, let's look at it and see. I mean, there's no sense in like just talking about it. Let's look at it and verify. I mean, because it should be pretty simple to do. Let's go to an hourly chart, I guess. Can I do that on an hourly chart? Maybe I should. I don't know if it's going to show this or not. Let's see. So I have to kind of look at the time frames right now. So right now, crypto's showing 1300, 519, 1300, which is actually 1 o'clock Eastern. So we're probably going to look for something 6 hours before 1300. So, and then probably 6 hours before that, right? So we're looking at, we'll just say 7. So we're looking for anywhere between 1 to 7 on this timer right here at the bottom of the page. So anytime between 1 to 7, which is going to be in this time frame right in here. Anytime we see a new date until 7 a.m., that's going to be the wee hours of the morning. And so we'll just go back a little bit. And I mean, let's look for some of the biggest moves. Let's go for some really big moves here. Here's a big move. This seems like a pretty big move here. This was kind of in the night. It was in the later portion of the day right here, 1800. Let's look for another big move. Here's a big move. This is 2000. It's getting really close to that time zone that I'm talking about. Let's see another big down move. Here's some up moves. Those happen usually during the daytime. Yep, 1700. Big up moves are in the days. Big down moves are in the nights. Let's see. Let's find another big down move here. That's pretty big. 2 o'clock in the morning. What do you know? Yep, there's a big one. Let's see. These are probably in the middle of the day. These run-ups. 2100. It's kind of the later portion of the day, but yeah, not too much in the night. Up in the day, down in the night. Let's see here. Ooh, here's some rundowns. What do we got here? 1900. That's still kind of during the day right there. Yeah, that's still kind of daytime-ish. Let's find some more big ones. Here's a pretty decent sized one. 7 in the morning. That's that's almost right within that time frame window that I'm talking about when most people are probably sleeping. Let's see. Oh yeah, look at that run. Oof. This one started about 2000, but lasted overnight, the entire night. It just fell the entire night and through to the next day. This run right here started at nighttime, 2000, fell all the way down and didn't even reach an end until the next night. That's a big one right there. But it did start at the end of the day. Here's a big run. This one's in the middle of the day. This drop down's in the middle of the day. Oh, this one started midday as well. But this big chunk right here started around like 1300. So part of it was this entire move right here was all daytime. This was a daytime move. Here's a big one. This is nighttime. This is a night move right here. Big move on this one. Big time night run. This one's smaller, but it's a nighttime run. Ooh, look at that. That one's nighttime. This one found support by the end of the day. It found support by the end of the day, and then overnight, this big chunk right here was all overnight. So it started to tank a little bit, found some support in there. Probably people went to bed and thought, okay, it found support right around where it had before. If I wake up in the morning, it should consolidate. Maybe it'll be a head and shoulders. I can decide to get out or not. And then while they were sleeping, poof, gone. So yeah, I mean, just some really big moves happen at nighttime. Some happen during the day. I would never ever sit here and tell you that they all happen at night. That would be probably not very accurate. This one's during the day. So yeah, some big moves do happen at night though. Anyways, how far back did I go? I went to, actually it doesn't give dates. I don't see a date on this. I don't know what year this is. Would have been probably 2022 because it was still in the 30K, 38K range. Apex going with AMC closing at 515 and Ape closing at 165 with a combined price of 680. 530 to 830. It looks like he's going bullish today. He's up by about 25 cents from where he was yesterday. I got you down Apex for 530 to 830. I have not guessed mine yet for the day. And I think Einstein actually sent me. Yeah, Einstein's going 497 to 797. Einstein's going a little bit more bearish, but not too much. He's actually going 5 cents lower than what he had previously. For What am I going to do for price prediction? Hold on a second. Let me look at this real quick. I think I'm going to have to wait until 15 minutes before market opens because I want to see if today's still going to be an up day. Starting out opening, or if it's going to be like yesterday where we have like down to begin with and then up in the later half. Because if that's what we're going to have happen, then I think we'll see a pretty similar close on AMC. I mean, we went up 1 penny day over day on AMC from yesterday. We closed yesterday at 5.15, and then not yesterday, but 2 days ago we closed at 5.15, and then yesterday we closed at 5.16, so we were a penny higher. And then on Ape, we were up 2 cents. We went from 162 to 164. If that's the case, I would expect maybe a 3 cent increase, maybe again if we're going to do very similar moves. So I would probably go with like a 5.17, maybe a 5.17 for AMC. I'm going to write this down tentatively, and then I'll change it 15 minutes before market opens if that's the case. And then I would guess maybe like another 2 pennies on, yeah, 160. I'm going to guess 1 penny. $1.65 on Ape. Which is 682. Let's see. Make sure. But I got to see what the market's going to do just before market open. Andrew says, Casey, just reminding you, so we used to be Disney annual pass holders. Got too expensive. We do sit-down dinners, quick lunches, and order from garden grocer before we arrive for room snacks. Ah, gotcha. Yep. Okay. Yeah, we're talking about the Disney hints. Sit-down dinners, quick lunches, and order from the garden grocer before we arrive for room snacks. Yep, that definitely helps cut down costs. So if you were Disney annual pass holders, you know what you're doing. I don't have to tell you. Oh, Roseanne's saying I thought we closed at 5:07. Oh, wait a minute. Hold on a second here. What am I looking at then? Oh, shoot. You know what? You're right. I was looking at the wrong numbers. You're absolutely right. I was looking at the highs yesterday. My bad. You're absolutely right. We closed at 5:07. I was totally looking at the wrong numbers. Dang it. We closed down 3 cents. I could see us closing down another 3 cents. That's what I'm getting at. We should be doing about the same thing. So let's go 5:04. Thank you. I was looking at the total wrong numbers there. And then 160, we were up 2 cents on Ape from 161 to 163, which means that 164 should be my number. Thank you so much for clearing that up for me. I was looking at the wrong spot. My bad. Let's see, 668. Who do I got to give a point to for that? Roseanne, point. Yeah, you're absolutely right. So I'm going 668. Let me make sure that's okay. Yeah, that should be fine. Yeah, I was looking at the highs yesterday. I was looking at the wrong column. I have 2 different places I look at the previous days, and I don't usually use Yahoo for this, and so I went to Yahoo to look at it, and I was looking at the high, the high numbers. So we had 516 as a high yesterday. Those were the numbers that we had for highs, and 164 was the high for Ape. So now I've adjusted my numbers. I'm looking at like a 668 close maybe by the end of the day today. Beer says, "Give me points now, please. I'm here." Say something that helps me out. Oh man. All right. It's about time for break here. Let me zoom out on this just a tad bit so you guys can see that this has just been trading the same price for a while. You know, good information. All right. Let me throw in my price prediction for the day today, just in case. 514, no, 518 to 818 is looking like what I'm going to predict for the day. Raise your hand if you're sure. Raise your hand if you think, or put in a one. Put in a one in the comment section if you think that they'll try to push us below $5 at some point today. I know I'll put in a one. I have full faith that we'll see price run below $5 at some point. More than likely, if I had to guess, we'll probably test like that 487 again and then come back up again as well. Very similar to what we did before. My guess would be to close out as many positions as possible at a $5 put strike. There is, how many is there? $5 puts. At a $5 strike, there's 53.4 thousand contracts at a $5 strike. And the lower they push price today, food goes 69. The lower that they push price today, any of the positions that they would have been purchasing in the money on puts will end up being worth more. Bird Eye says end of day price combined 666. Boy, I'm real close to that number. I'm only 2 pennies off of that. I didn't even realize it now that I'm looking at it. You might not be wrong. I could see that happening. Alrighty, guys. Let me put up the message, some music, and take a break. All right, I'll do that. Attendees, thanks for the reminder. Yeah, somebody with no name, I don't even know how that's possible, but somebody with no name says it's just to let everyone know they are in control of price exactly like before is going to be 666. I could see it. I could definitely see that happening. But if I guess 668 and I'm 2 pennies off, I'll be okay with it. So I'm probably going to stick to that price prediction, but I got to wait and see what market's looking like 15 minutes before it opens. All right, I'll see you guys in a little bit. All right, I'm back, and I'm just kind of running through some of the numbers here. I see oil is up in the pre-market 1.46. The DXY is down 0.31. We've got mortgage-backed securities trading even on the pre-market. SPY is up 0.32. A lot of the banks are up right now. Let's see here. Man, I cannot drag this bar here. What you're looking at right now is oil on the screen. I'm just kind of looking at some of the different charts. I think the market's going to have a green day. VIX is starting to head down further. I don't see any. Let's take a look at one more thing here. 17,000 in volume. I want to see what volume was like at the Pokey Stick for SPY yesterday. It was 8,000. So yeah, volume's rising on SPY. So if price is rising and volume is rising, that's bullish. We may see some more bullish run for the day-to-day on the VIX. I might change my numbers just slightly here. Let me think about this for just a minute. I'm going to drastically change my numbers. Boy, I feel like I'm going to regret this. I want to go bullish so bad on AMC here because I see a potential for a breakout here on a 4-hour chart if price can jump up above 532. We could get some more momentum out of that, and I could see it close maybe at like 540-ish by the end of the day today, especially with a bull run in the market. The question is how much more of a bull run is there going to be? Man. Hold on a second. Let me look at something real quick here. I'm gonna go 540 on AMC. I'm risking it here. Yeah. So that would have me going 554 to 854 would be my price prediction for the day today if I do this instead of the 518 that I had originally. It's a big run though. Let me check one more thing on how much of an increase in price that would be. 554. 7.6% increase in price. Actually, we're at 507. It'd be less than that. It would be more than that. It would be a 9.3% increase in price for the day. I just can't see that happening. I'm so torn on this one. This is a tough day today. Getting the breakout. Yeah, I'm doing it. 554 to 854. Big jump there and change on price prediction. Yes, Tammy. Powell is speaking today. I'm going to be putting him on. He comes on at around, it'll be Ben Bernanke and Powell speaking this morning, and they come on at 11 Eastern, so I'll put them up at around 10. I'll probably do the numbers first, and then move on to listening to them. I know, Glenn. I know. I'm a little shocked in myself at my prediction. There's a couple things that I see that are kind of leading me towards that, though. Let's see here. Yep, Andrew got the right answer, Nana. 2 weeks. Yeah, I don't know. I'm so torn on my price prediction for this morning. Yeah. What if we had a battle for 701 for the day today? Wouldn't that be crazy? Combined. No, it's always been 2 weeks, Manjit. Always been 2 weeks. It's never been more than that. It's always been 2 weeks. Hey, I won last week, Glenn, so I'll let somebody else win this week, or I'll take a chance and risk it for the biscuit. My original prediction was what was it? 518 to 818. So we'll see which one's better, which prediction ended up being better. But I'm making a last minute judgment decision to raise this one. All right, guys, I will see you on the other side of market open.
T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery.
Go for launch, GC. Go. Got it. Go. Fido. Go. Bravo. Go. GC. Go. Max. Go. Eagle. Go. Ecom. Go. DeFeo. Go. Payloads. Go. Scan for the customer. Go. DPS. We're go. Eco. Go. Booster. Go. Surgeon. Go. PRS. Go. Okay. And let's see. We'll wait on GNC.
T-minus 60 seconds and counting.
Guidance, we cleared all of our
We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start.
MC, I hear you loud and clear. 5 mics. Now me. Have you loud and clear as well? Thanks, sir.
Go for auto sequence start.
And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, start, 2, 1, booster ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Separation confirmed. Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff.
Should have a good forward leg now in SM. Okay, you sound good.
Discovery Houston, negative return.
Copy, negative return. With the mustache and a supernova, tossed off the cliffs of Dover, washed up on a faraway shore in the arms of the daughter of the buffalo. Mama said he was a chosen one, Brave Ray said he was the other one. All that paid no mind inside his econo line. Swallow our planets, the prophets of doom. Quarterly projection, the prophets of doom. The prophets of doom. The prophets of doom. The prophets of doom. A caliph, rabbi, and a bishop walk into a bar. One says to the other, hey now brother, trust the white man driving the black man. He just saving all his voodoo for you, just for you. Never trust the white man driving the black man. He just saving all his voodoo for you, just for you. When the night's getting cold, you're needing a shoulder. Puff out your chest and be a little bolder. All we do is we buy and hold. There will be shills who wanna steal your thrills. There will be friends who hold till the end. There will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead. Panic and fear really are near. It's not ours to own. We have shown that all we do is buy and hold. Oh, there will be shills who wanna steal your thrills. There will be friends who hold till the end, and there will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead. So when the night's getting colder, you're needing that shoulder. Cause Ape's got your back, we got each other. All we do is we buy and hold.
Good morning, you filthy apes. Welcome to AMC and APE, where we buy, we hold, and we screw those hedgies. Screw 'em! That's right. That's where we like to fling some poo and eat crayons for breakfast. Rock strong. Good morning, everybody. Today, inverted yields with the bonds with falling inflation. A lot of people are kind of under the assumption that the market might be running and might be heading into a bull run in the marketplace. There are some things out there that would suggest that the market is going to start becoming bullish. However, I think historically speaking, I don't think that that would necessarily hold true. I do think there might be a case to be made that we're kind of entering into a period of time that has never been seen before by our markets. And I think will probably be unprecedented for anything that we've seen from the past. But let me take you along a little bit of a trip here. What did I start off with this morning? I can't remember which one I started off with. Oh yeah, I remember. I want to show you one. First, we'll start off with AMC. Give me 1 second while I pull up the chart here. I'm going to take a picture and show you guys a little history. On this chart is going to be exchange reported short interest in green. Obviously price in red and green, and then red, the solid red line is going to be the on loan amount. Actually, so I'm going to just take a new screenshot of this and just redraw everything. But what I want to point out is a couple different things from the past. And every time we've seen some major dips in the on loan amount, we typically see a run up in price not too long thereafter. Not always, but for the most part we do. What we see it more on is the on loan average age per day, so it really kind of depends on what kind of shares are being returned. Here's another spot right in here. There's a spot here. And this one right here was not so much the case. So we'll put an X on that one. But for the most part, and here's another drop down here as well, and there's also a run up shortly thereafter, right? So each one of these preceded a run up in price, except for this one right here, which I think a lot of this was probably actual real sell-off going on by actually, I can tell you that in November of 2021 is and I'll draw this out here for a minute for you. There's a real sell-off that occurred during this period of time by both institutions and I think retail at that time, more so on the part of institutions. Here's your run up here, and on this one, run up would have been here. Not very high. It's getting smaller and smaller and smaller. But we have our current rundown in on loan amount, and I don't really want you to kind of focus on necessarily the difference in on loan amount that's occurred. What I want you to do is instead focus on something entirely different. I want you to focus on the difference between the amount of short interest and the on loan amount. This is where brokers who are lending out shares are making their money. They're making a lot of money on these loaned out shares, and it doesn't necessarily have to all be brokers. It could also be shareholders as well. But this area in here, the larger this area is, the more money there is to be made in these areas. And so when you see price coming down to meet or support or find on loan amount of shares coming down, but then the estimated or not estimated, but the actual reported short interest is actually holding where it's at, then those are kind of the times where institutions aren't necessarily making as much money as they were previously. One of those key important times was right back here. Markets weren't making, brokers, institutions that were holding long shares were not making as much money, and they actually sold off a bunch of shares because this is the period of time back here that they were making some money. And in order to start making money again, what they needed to do is sell off their positions and get in at a lower price so that they could start getting institutions to start borrowing again. Once they started borrowing again, then they were able to create this spread or the difference between short interest that was there and the amount that was being loaned out. This is a really important thing. Basically, since November of 2021, we've been seeing institutions making more and more and more money through loaned out positions. So kind of keep that in mind. What's going to happen in our near future? And I think that we do have a price run coming here soon, 2 weeks. I can't tell you exactly when it's going to be, but I do think that there's, with this significant amount of drop of about, I think it was somewhere between 30 and 40 million shares that were sold back or returned back into the marketplace. The interesting thing about this is that what did not occur, son of a gun, I have you guys on the wrong page, I'm sorry. What did not occur during this period of time is we did not see short interest closing in like quantities. So when I pull the screen up over here, what you're going to see is short interest. It didn't take a big plummet right here. It really didn't. The short interest amount's still really high. Didn't come drastically down. Very much like we've seen from the past, where you get these periods of time in here where it pinches, right, like that. When it pinches, that's significant. So let me show you something else. We're going to go to the SPY. We're going to put it on a weekly. We're going to pull up our trusted Ichimoku cloud. And we're going to go back and do a little history. We'll get rid of this. What am I missing? No, okay, it's right. We're going to go back in history and we're going to look back here on a weekly chart here on the Ichimoku and notice that there's only two significantly large red clouds that we've seen from the past. One of the first ones starting in July of 2008. The other one starting in the end of April of 2001. So you have the dot-com bubble followed by 9/11 in here. And then you've got the 2008 housing crisis or mortgage-backed security crisis that occurred and caused the market to have a major correction. And what you'll notice is like usual, price of the market likes to drop down through thinner portions of green clouds and rise back up through red portions of red clouds. And you can see that's happened. There was an attempt in 2020 or 2001 to drive back through the cloud, but never quite made it. And then finally, on the backside of the cloud down here, price did start rising. And then it came back down through the backside of a green cloud and back up through the backside of a red cloud. And now you've got current right here. This date that started on was November of 2022, where the red cloud really started to form. And you can see here that price is starting to break through this cloud, and it's forming a green cloud in the future. You can already see it. This is a buy signal. For all intents and purposes, the lagging line is above price line, conversion's above base, and we've officially made it out of a red cloud. By all means, this is a buy signal in the market. This doesn't show as anything else other than a buy signal in this market. Is it going to continue to move up, or is it going to start to falter and finally, for the very first time ever, crash through the front side of a green cloud? We have never seen the market ever crash through the front side of a green cloud, always through the backside, especially on this weekly chart here. Never. It's not happened once since the charting has started on the SPY. Not one time, not a single one. So what's going to happen? Is this going to come crashing back down through the front side for the first time ever and show us something that we've never seen before? Or is it going to continue to rise? Is the market with an inverse yield on bonds, and with inflation still trying to be corrected, and one more and in here, and in 26 days the Fed are considering whether or not they're going to raise another 25 basis points, and we're now at 39.1% chance at seeing that increase of a 25 basis point occurring. Are they going to continue to raise rates with an inverse yield, bond yield? And are we going to see market moving up on that? Doesn't make sense. I think we may be seeing something unprecedented here. I don't think this has ever happened in the market history. A lot of people are kind of making an assumption that that this is the sign that the recovery, that we've hit bottom. This is the bottom over here, and that this is going to be the recovery at this point going forward. And by all intents and purposes, this is a weekly chart here that I'm looking at. I see strength here as well. I can't look at this chart and tell you that this looks like a bearish move. This looks all bullish to me. But there's so many other indicators that are saying no. I don't know. By the way, the green cloud in the future is for September, the middle of September. That's all I got for you guys. Oops, that's not what I wanted. There we go. I think next week is going to be absolutely pivotal in deciding whether or not this market is going to continue to move up or not. I'm expecting next week for there to be an outcome or a suggested outcome on whether or not the debt ceiling is going to be raised. And what happens after that's announced is likely going to be the determining factor as to whether or not this market continues to move up or if it moves down. And we will see. Bird Eye is saying compare that SPY chart with Bitcoin chart for the same time period since 2000. Give me a minute. It would take me a minute to set up, but I can do that. Because we're being heavily shorted. That's why we're trading sideways with the SPY ripping. I don't know if I would say the SPY. Well, let me see what it's doing right now. I mean, it's only up 0.25% right now. I wouldn't call that ripping necessarily. Oh, I know why. Crime. Let me pull up the chart though that was being requested from Bird Eye. Give me, I think, which one do I want to pull here? Trying to decide which chart I'm going to get rid of in order to put this up on. I guess I'll do it here. Here? Yeah, I'll do it here. Duplicate. Give me just a second. I'll put it up for you. Let's see, we'll do this plus this, and then add BTC USD. Actually, you know what? Let's get rid of that. Put it on you said same chart, so we'll do weekly. Okay, so I'm pulling up the chart, and I'm not sure exactly what it is that you're looking for. And I only get Bitcoin USD back to, it only goes back to 2011. But this is what the chart looks like from 2011 to current. 1 second, let me check something out. Yeah, I don't know why it's only showing to 2011, but obviously I couldn't. You can't pull Bitcoin any further back than you shouldn't be able to pull it back any further than 2009. So I don't even know if the 2 years prior to this would even be worth pulling anyways. But in regards to what Bitcoin looks like in contrast to the SPY, if you were to suggest that this was going to be leading the marketplace at all, if it's a leading indicator as to where price is going to be moving to, it's Bitcoin is starting to head back down here a little bit. So, but I don't really see any. To me, I wouldn't make that comparison. I don't see that here. I don't see a. I don't see exact. I mean, I can definitely see that there's some kind of leading indicator, maybe to some of the moves. Like this is leading into this drop right here. This drop is leading, maybe leading. I don't know if this drop's leading. That one's not very leading. There's nothing in here that is leading for me. This might be indicative of a lead into market movement here, and then you can see it driving back up as the market started to head down. So like almost an inverse kind of relationship, but then as the market does crash, it starts going back down as well. If it is a leading indicator, though, it is starting to head back down, and it is building a little bit of a head and shoulder pattern as of right now. And the one chart that I have, excuse me, the one chart that I have for Bitcoin on the daily is I have that pattern built out right now for a potential head and shoulder price failure. in the near future here, and I think it might be delayed 5 or 6 days beyond where I think it's going to happen, but it's right here towards the end of the month. Looking at seeing this rip down here. I don't know if it's going to be exactly on time, but it does look to me like it's building that head and shoulder pattern with a 6-day lag, a 6-day weird event that occurred back here that's gonna cause us to extend out probably 6 days later. So maybe the beginning half of first few days of June. I mean, Bitcoin is so new. I mean, I know 2011 doesn't sound new because it's like 13 years or whatever, but you know, it's uh, it's still relatively new that I don't think that there's any way to be able to look at a trend historically really far back and say like, yeah, here it's not doing what it's been doing from the past. It's still way too new for a huge macro look like that just yet. I don't. So Jordan, I don't do that. I don't. I think it's irresponsible to take data that's given to you and stretch it out. You'll never see me copy a pattern. I think it's okay to copy a pattern and uh, try and match it up, resize it, basically based off of its current sizing. But stretching it out like that, I don't think is going to help any. I think it doesn't. I don't think it's productive. It's skewing the data, and I think you can't. I don't think you can really. Anytime I see people do that, I cringe. I don't think it should be done. Because and I've said this on multiple occasions from the past, but you could draw 30 lines on a piece of paper for me, like just random scribbled lines, what you think is random scribbled lines, but I'm telling you that I can find consistencies that are going to be in the way that you write in those 30 random lines that you draw, and I can guarantee you that if I stretch and manipulate a pattern in a certain way that I want to, and lay it over the top of another one of any of your other random 30 lines that you drew, just drawing random 30 lines, I can show you the pattern, the same type of pattern that people use when they take price at movement and they start manipulating it both in time and in height. Because it's that's not. I mean, it's just you're just simply changing numbers, right? And you can't do that. You can't do that when you're doing pattern analysis. You have to look at the overall pattern and say, does it match or does it not, without manipulation to it. Which why is one of the reasons why I really liked TradingView or trading with emotions used to do his pattern analysis without manipulating the fractal parts that he was drawing. I love that about him. Probably one of the only guys that I know that does fractals that doesn't manipulate the fractal to meet his expectations. He simply takes previous known fractal units and doesn't manipulate size and places them on top of other portions of price movement and says, look, it matches. He's literally the only one that I know that doesn't do it. Exactly, Doug. That's exactly right. Manipulated pattern driving by human interaction. That's what it is. Your drawing of 30 lines is the exact same thing that the market's doing. It's human interaction that's occurring, and you can find those patterns. You can stretch them out, and you can elongate them, and I can show you how your pattern repeats itself over and over and over and over. But it's not an example of what's going to happen in the future. That's the problem. It's not indicative of what's going to happen in the future. It just shows you that you're consistent, right? That's all it shows. You or us in the marketplace, we're consistent. And this is why the market's able to trade with algorithmic computer systems that are set up to be able to predict what it is that we're going to do as a reaction, right? If I do this, the market should do this. And so that's what the market does. It tries to do predictive price movements to elicit a reaction. And we're supposed to respond a certain way. And when we don't, that becomes the problem. No, I don't think anything's halted right now. Let me make sure it's on the one. Yeah, it's on the 1 minute. Jordan says the volume of the market controls where we are following. Crypto solo volume extensions the distance in charts. I'm not sure what you're saying there, Jordan. I think I'm trying to follow with you, but I'm not that big brained. The volume of the market controls where we are following crypto. So low volume extensions the distance in charts. So I feel like what you're saying there is that you have to elongate it in order to match volume levels to previous volume levels, maybe? I don't know. It's hard to, I'm having a hard time with it. Hey, Jordan, I'm gonna say I'm the sorry one. I can't read into what it is that you wrote. That's my, I'm sure you said something really smart there. I just can't read into it. Albert says Kramer said markets are going up, and that's why it's still got bear tendencies to real experts. Yeah. Saying stretch chart of Bitcoin to match volume of SPY. Hmm. Are you saying compare price to volume? I don't know. It's 9:02, guys. It's time to take a look at our numbers. Yeah, BioLife even said numbers. Let's take a look at our numbers and see what we got going on this morning. So I'm going to take you guys over the other chart here. Remember, I'm not going to be able to see what it is you guys are writing until you see the big tramp back up on the screen again. So hold those specific comments, thoughts, questions, or concerns until you see that. Let's see here. Two-factor authentication. If you don't have it, you may want to consider getting it, as it could prevent somebody from getting into your account that shouldn't be in your account. When you do set that up, and by the way, I never had a problem logging into my account again yesterday at all after that first incident that I had yesterday. So we learned something new. And if you guys don't know what that is, there is multiple ways that you can log into your account with two-factor authentication. You can actually have them call your phone and give you the code to get in, which is what I ended up having to do yesterday due to a system-wide problem that they were having with Fidelity. Yeah, I'm still strongly supporting the idea that two-factor authentication is probably a really good thing, and I stand behind it still to this day. So, if your broker allows you to sign up for two-factor authentication, allows you to put in a secondary device to be able to receive the passcode, not a bad idea in case something happens to your primary. And please take pictures of your accounts, your portfolios, so that you can save it someplace special in case something happens between you and your broker, where they maybe tell you that you own something less than what it was that you had previously. Don't be that person that gets into this. Some of you guys are probably seeing or reading reports about Robinhood misreporting some of the data on their shareholders on what they held. And if you didn't have a picture taken beforehand and they just suddenly change your numbers, and you wouldn't know. How would you know? What if it's off by just a fraction of a hair? That's a lot of money in their pocket if they can get away with it. But you'll never know if you don't take pictures. So make sure you're not that person that's not taking pictures so you know what it is that you hold. All right. Starting in the top left-hand side of the page, today we are going for a tiebreaker. There's a four-way tie on points for the price prediction tallies. Remember, this is not financial advice. It is simply just for investors who are for apes trying to figure out where price is moving combined between AMC and Ape by the end of the day. I don't know. I started out this morning at 518 to 818, and I feel like I'm going to regret it, but I'm going to stay positive. So I changed it to the last minute to 554 to 854. Eric's going 513 to 813. Apex is 530 to 830. And Einstein is 497 to 797. There is about a 57-cent spread between the low and the high predictions, which is a little bit bigger than what we've seen most of this week. Short exempt volume on both AMC and Ape were up. AMC was at 161.2 thousand shares, Ape at 57.6. Utilization, we are on day number 88 straight trading days of 100% utilization on AMC, Ape at 54.23%, which was down quite a bit. Day over day price increase yesterday, AMC was down 0.59 and Ape was up 1.24%. Max Pain remains $8 for the day today. The reason it dropped from 10 down to 8 was due to the fact that there was a bunch of puts and calls in open interest that were closed out on Wednesday at some time. I think it was. Yeah, Wednesday, I think it was sometime. Let's take a look at that off exchange and EDGX volume here. By this time in the morning, I would expect about 44% going through off exchange. EDGX would be somewhere between 10 and 11%. Off exchange for AMC is at 52.18%. EDGX at 12.25. The combined total 64.43%, or about 10.43% higher than it should be. CHX volume is only 2 shares. Weird low number. Ape. Off exchange 50.16. EDGX 5.35. That is approximately 1.51% higher than it should be by this time of the day. So nothing unusual going on right now on Ape. GME, oh, by the way, CHX volume on AMC is 0 shares. On GME, CHX volume for the day today so far, wow, it's already high. 0.31% with a 30-day average of 0.21. So seeing a little bit of an increase there in volume. Taking a look at institutional ownership. Earlier this morning it was 139.096 million shares. It is now 139.385 million. I think I forgot to check this earlier this morning. So we have an increase by about 300,000 shares. That's putting us close to getting to about 27% ownership by institutions. It's good to see a rise on these numbers. I like seeing institutions coming back in to buy. It's not a bad thing. Not at these numbers anyways. Let's see. Taking a look at what's next here. Options. Highest amount of call volume for the day today is at a $6 strike. That's up from $5 yesterday. We have 1.6 thousand contracts so far. That's very low volume though. Highest amount of put volume is down $1 from 6 down to 5 from yesterday. And the hold on a second here. The volume so far for the day at a $5 strike is 2.4 thousand contracts. Very low volume for the day today in options. Normally, I would think that we would be around somewhere between 3 and 3.5 thousand contracts in volume for the largest strike. So this is low volume. Taking a look at the rest of the data here, let me move a couple screens around. I'll give you a little bit of interim music as I'm doing that. And we'll take a look at the rest of the data. This song's like 3 minutes long. I don't need 3 minutes to move a couple screens around. It's like I gotta take my time. Alrighty, let's take a look at what we got going on here. So whenever we have this sideways trading that happens in the aftermarket hours, I tend to feel like it's really not a breakout, right? So we have this really long descending wedge that we've been trading in here, and we finally broke out the top side. We found levels of resistance at least twice yesterday. And then in the aftermarket hours, we closed out inside the wedge, but in the aftermarket hours, it just kind of traded sideways. So I wouldn't really say that that's a breakout yet. And you can see that right as market was open, they brought us down right into the top side of this wedge here. We're really going to have to break past this. We're at $6.62. That's right where this Fibonacci retracement level is. We need to see a breakout of this, an actual real, legitimate breakout of this wedge here. Do note that I was expecting to see some consolidation during this period of time, but down here instead of up here, we are getting close to a consolidation period end this morning here, and that's coming up really shortly. Maybe we see the price running down and coming back down to the level where I was suggesting, and we see a closing down here around 646 combined by the end of the day, or maybe we continue to rise up in the later half of the day today. Borrowed so far on AMC for the day today, I'm showing 515,000 shares. That's going to raise the short share interest of the free float to 25.09%. Cost to borrow mins at 25.23. I just want to note that when we see really low numbers like this compared to our max, what I would suggest to me is that they are borrowing and returning shares all at the same time in the same day. That's how you get those really low borrow numbers, especially when it's really, really super low. Average cost to borrow is 45.7 and max is 356.8%. Utilization. This is our 88 straight trading days of utilization being 100%. Let me zoom in just a tad here. And on loan amount day over day, decreasing by 210,000 shares, even though it looks like it's flatline. It did go from 168.8 to 168.59. Ortex is estimating that about 52,000 of that was in closed short interest as of yesterday, bringing our short share interest to the free float from 25.07 to 25.06. On loan average age per day is still dropping. Day over day, that went from 96.85 days to 95.89, and security lending volume dropping slightly from 21.29 million to 12.17 million. Actually, almost dropped in half. Not quite, almost. Ape. Something's going on here. I gotta refresh this. On Ape. So far for the day today, we've had a return of 26,000 shares. Not very much. It's going to leave that estimated short share interest of the free float at 5.56%. No shares borrowed for the day today, which is why we have no cost to borrow, max, min, or average showing, being reported. Shares on loan day over day is now dropped below 20 million shares. The utilization dropped from 60.9 to 54.23. On loan amount dropping as well by that 3.7 million shares from 23.07 million shares on loan to 19.37 million shares. The estimated short share interest of the free float currently dropping as well from 5.78 to 5.56, and the on loan average age per day is jumping up. I think that was 2 days in a row of downwards momentum, and we're getting 1 day back up. If we get another day of upwards momentum on the on-loan average age per day, I'm going to give you guys a 15-day counter for potential increase in price incoming. Security lending volume day over day did rise from 821,000 shares to 3.79 million. Since we know 3.7 of that was in returned shares, that other portion of it, that the 30,000 shares was or the 90,000 shares were the borrowed shares from yesterday. Orders by Fidelity customers so far for this morning, AMC, APE, and GME are the only three that I'm looking for on this list. Due to low volume, none of which have made it. SSR trigger price for the day today is at $4.56 for AMC. APE is at 1.467. Shares available to borrow is up to 1.1 million shares. Earlier this morning, we had only seen about 150,000 shares having been borrowed, and it looks like they may have borrowed 100,000 shares since. So we're at 250,000 shares borrowed so far for the day today with fees at 68.6%. Currently, there's 331.8 thousand contracts out of the money on the calls versus 34.6 thousand contracts that are in the money. 293.8 thousand contracts are out of the money on the puts versus 192.2 thousand contracts that are in the money. NASDAQ is up 0.07, Dow Jones is up 0.2, S&P 500 is up 0.28. We have 3,611 advancers to 2,557 decliners. The market is more advancing than declining. Taking a look at some of our the biggest movers as of right now. Come on, refresh. It doesn't want to refresh. All right, there we go. Some of our biggest numbers, biggest movers. Silvergate, let me just make sure Silvergate's trading here. Okay, it is. Silvergate's down 17.39%. PacWest is up 5.05. Coinbase is down 2.9. Everything else is underneath 2.75, plus or minus 2.75%. Ethereum Classic is currently showing down 0.2. The US dollar is down 0.18. Oil is up 1.21. Mortgage-backed securities are down anywhere from 0.36 to 0.4. And SPY is up 0.29. Oops. VIX is down 0.19, VBR is down 0.05, VB is breaking even, Tesla is up 1.68, Amazon is down 0.92, Cinemark is down 0.79, Doge is down 0.15, Bitcoin is down 0.01 at 26.8K a coin, GME is down 1.17, HYMC is up 0.44, NCMI is down 1.53, HUD is down 0.64, APE is down 1.84, and AMC is down 0.89. Inflow versus outflow for the day-to-day, big difference. About 900,000. Oh, sorry, that's not right. $800,000 more inflow than outflow. Getting pretty darn close to almost $1 million more inflow than outflow. Let's see, 2.13 million shares traded though so far for the day-to-day. After 47 minutes worth of trading, puts us on a pretty low pace at about 17.67 million shares traded by the end of the day today. That is definitely really low volume. I suggested in the pre-market somewhere between 5 and 25. I don't expect to see that busted. On a 4-hour chart, we've got more buying pressure than selling pressure with an RSI of 37.91, which is below average. We do have a divergence on the vortex indicator that has occurred within the last 8 hours. RSI is at 37.91, which is below average. On a 1-hour time interval, more selling pressure than buying pressure with an RSI of 39.64, which is below average. On a 30-minute interval, more selling pressure than buying pressure with an RSI of 35.22, which is below average. On a 5-minute interval, there is more, it's a tough one. Selling pressure than buying pressure with an RSI of 42.22, which is below average. On APE, there's approximately $240,000, maybe 50, it's close. $1,000 more inflow than outflow. 865,000 shares traded so far for the day today. After 49 minutes of trading, puts us on a pace for 6.88 million shares traded on APE by the end of the day. That is definitely within the 1 to 20 million shares I suggested in the pre-market. On a 4-hour chart, there's more buying pressure than selling pressure with an RSI of 49.29, which is average. On a 1-hour chart, we've got more selling pressure than buying pressure with a lot of whipsaw going on right here, meaning a lot of back and forth and buying and selling pressure. It's undecided. And RSI is at 48.35, which is average. On a 30-minute interval, more selling pressure than buying pressure with an RSI of 47.8, which is just slightly below average. And on a 5-minute interval, we have more selling pressure than buying pressure than RSI of 47.41, which is slightly below average. And with that, we've got Jerome Powell in 40 minutes with Ben Bernanke speaking today. I think I'm getting his first name right. I still have not looked up his first name. I don't know why I didn't do that yet. Is it Ben Bernanke? Yep. Ben S. Bernanke. Albert says Silvergate on Silvergate SI on Yahoo Finance shows halted for days. Did I miss something? Hold on a second here. I think, and I might be mistaken on this, but I think that what's going on with Silvergate is that they may be closing out options contracts only. As you can see, there's no bid and ask order book over here on Silvergate, and so I think a lot of the change that we're seeing in price is likely due to any closing of positions that are may or may not be occurring on the options chain. I'm not positive. I think that might be what it is. SICP. Okay. I'm. That's what. Yeah, it's SICP. But like I said, there's no bid or ask. It's probably just mainly options that are closing out. Yes, I think that is the case, Albert. Yeah, it says no DJ, no drinking while trading. Bell Creek Laser says, I feel good about AMC today looking at the 4-hour chart. I mean, it definitely had a break, or at least it's about. I mean, it's looking like it's going to break this trend here going down, but we need the volume first, and we're just not getting there. Until we see that volume kick in, it's not going to break through here. But the 4-hour chart does look good, though. That's part of the reason. I'll be honest. That's the only reason that I even changed my price prediction for the day, because I had us closing at 504 originally my price prediction on AMC, but I changed it to 540 is just because of this 4-hour chart alone. That's the only reason that I changed it. This 4-hour chart here to me looks like it's like it wants to buck. I got a little overzealous probably on the 540, but whatever. But yeah, that's the main reason that I changed my price prediction from 504 to 540 for a close. And if I'm wrong, I'll eat it. I'll own up to it. What was I gonna? There was something else too that I saw that made me feel like there was oh yeah, it was the combined price of AMC and Ape. The combined price of AMC and Ape is hovering right at that top side of that on a 15-minute chart on the combined price of AMC and Ape. We're right at that. We're right at that point of we're seeing support at 663 currently, but we're right at that point to where like, is this going to break or not? And if it doesn't break, then it very well could come back down to levels around probably 643, maybe even a little bit lower to 641 combined. But I really think that maybe in the later portion of the day we may see some volume kicking in and maybe seeing price moving up. Glenn says Casey threw the price prediction so somebody else would win. If you knew me, Glenn, you would know that's not true. I don't like losing. I don't ever try to just give up for somebody else to win. That's not how I don't play like that. Glenn says, "Did you see price moving up? Me no understand this talk." Fling more poo. Eat more crayons. Man, I feel like I'm forgetting something today. I don't have any. We've got Powell talking in a little bit. Oh, I know what it is. I know what I'm forgetting. Movie review. Tendies Plus Plus sent me a message about a movie. I'd actually already seen this, but not what it is that he sent me specifically. But what I saw was an interview with the main actor from this movie that's coming out called The Sound of Freedom. And he was talking about how the proceeds are going to be used to try and help stop human trafficking. I think specifically with children. And I would like to support this. I'm a huge proponent of cleaning up this crap that's happening with kids. So I'm gonna go ahead and play the demo for this movie so you guys can see this. This was posted by Stand for Freedom. So it's like 9 minutes long. Maybe this is the one I saw because what I saw was kind of a little bit of a long one. But I'm gonna play this on here, guys, because I think that it's important, and I guess that's why it matters to me. It may not matter to you. You may not care. This may not even feel like it has anything to do with AMC at all, but it is a movie, and we do support movies, or at least a movie theater. So this. I think this is impactful, and let's take a listen to it. Let me turn up my sound to the appropriate levels. Turn sound on. I think we're good. I guess actually I'll put it over here. Try to minimize this down a little. Let's see if you guys can see all that. Should be good.
Somehow you have failed to bring me one real-world lead.
Or one American child, or one American trafficker. For what reason D.C. would let you within 1 million miles of it?
Glamour shots of Miss Cartagena don't count.
She has the girl.
And I say the girl's in Russia. Prove me wrong.
It's over, Tim. Close up.
get on the plane and come back home.
Bureaucracy is shit.
Yeah.
This is why I operate black. Have a nice flight, Timoteo.
You were a cartel guy.
Yeah?
Kept your mouth shut, did your time. Could have picked up where you left off. Bought yourself a condo on the beach. Instead, you're doing this. Why?
Really? I had that condo on the beach. 15th floor, marble everything, overlooking the whole bay. First night out of jail, I slept in my own bed. Day 2, I was back in business. Same old life. But it doesn't feel right. Not the drugs, not the hookers. But damn it if I didn't keep trying. So, one night, I'm leaving a bar all jacked up on coca, and I notice this young girl on the corner, fine looking, maybe 20, 25. Take her up to my place, we do the deed, pay the bill. She's putting on her shoes, and I notice something. I notice her foot. She's got these little pink cat faces painted on her toenails. And it hit me. She's not 25. And she glances up and her eyes connect. And it was like I was granted a glimpse into her soul. And all I saw was sadness. Out of nowhere, she starts talking. Turns out she's not 25, not even 20. This girl is 14 years old, Timoteo. She's been doing it since she was 6. Looks at me, smiles, takes the money, walks out the door. All of a sudden, I'm hit by this tidal wave. This tsunami of darkness. And I know I'm the sadness in her eyes. Me. I'm the darkness. And I know the darkness has to die. So I get my 45. Put it to my head. Put my finger on the trigger. Now, if there is a time to ask if God exists, that would be it. So I did. When God tells you what to do, you cannot hesitate.
thought about it? Of doing it on your own?
I won't be on my own. I just have to convince Pablo.
Okay. So, you quit your job, and you go and rescue those kids.
Resignations in your box.
Wait, you do realize you're 10 months away from vesting your pension?
I do.
You know I did everything I could, but the law is the law.
Did you know there were over 22 million new images of child pornography on the web this past year? That's a 5,000% increase over the past 5 years. 5,000%. The fact is, it is the fastest growing international crime network that the world has ever seen.
I agreed to it because we were working with the U.S. government. To back out now, this whole thing will blow.
It has already passed the illegal arms trade, and soon it's gonna pass the drug trade. And you wanna know why? Because you can sell a bag of cocaine one time. But a child, the most precious child, you can sell a 5-year-old kid 5 to 10 times a day. For 10 years straight. And everyday ordinary people, they don't want to hear it. It's too ugly for polite conversation. But meanwhile, over 2 million children a year are being sucked into the deepest recesses of hell. Trust me, man. If we do nothing, their pain is gonna spread and spread. So someday it's gonna reach the likes of you. And that will be a nightmare you're never gonna wake up from.
Sorry.
You suck, Pablo.
Oh, sir, the gentleman who just left asked me to give you this.
If you would like to help us expose the horrible reality of human trafficking by bringing this true powerful story to the big screen, express interest now at angel.com/freedom.
All right. So my understanding is, and this is not what I watched before, but my understanding is that some portion of the money that's going towards the proceeds for everybody who watches this movie goes to help save child sex trafficking kids. And so, the idea here is, let's support it. We go to the movies anyways. The interesting thing is that with my, I hadn't even really thought about doing this, but I have 3 movies because I'm a premium member, not premium, whatever it is, member. I just totally lost it. What am I? I am a, sorry. What is it? Hold on a second. I'm looking still. Due to that I'm an A-list member, I don't know why I couldn't come up with A-list member. Due to the fact that I'm an A-list member, I get 3 free movies a week. And I found out a while ago talking to one of the managers at one of the AMC's that if I sign up for a movie ticket, that does go towards money into the pockets of the people who made the movie. So I could go 3 times a week to that movie, never actually go, but the movie seat is taken and paid for. So I don't even have to go see the movie. I can just pretend to go watch it 3 times a week. And I'll do that for a good cause. And even if it gets the numbers up. But anyways, it's messed up stuff. Joe says, let's get the word going. Yeah, I'll tweet it out. Man, I'm gonna, I ain't gonna lie, dude. Lion King, I'm gonna have a hard time going 1 time, let alone like 3 times a week. There's no way. There's no way I'd make it through it, man. Ugh, there's no way I'd make it through it 3 times in 1 week. I would be a mess. Everybody would be like, "Why is Casey not doing his live stream today?" Oh, he got done with his third showing of that of the Sounds of Freedom last night. He couldn't make it. He's going to go do some he's going to go do some time someplace trying to help out doing some nonprofit fundraising elsewhere to help kids. Because dang it, the movie's called The Sound of Freedom. It comes out. It looks like I don't know. I'm having a hard time finding the exact release date. Some places I'm looking at says July 3rd. Some places are saying July 4th. So I don't really know which one it is for sure. But in July, I see some places saying the 4th. Maybe I know as an A-list member, sometimes I can get into movies like AMC will start showing it like a day early. Or not, yeah, a day early. So maybe like some people who can see it, on the 3rd, as early as the 3rd. Attendees, you're welcome, man. Frank, I read your comment. I'm sitting here over here going, gotta take a deep breath. As a dad of 2 preteen girls, I don't think I could watch it. I am of a dad of 2 girls that are teens. If I'm gonna have a hard time watching it, I'm not gonna lie. It's gonna be really tough. Josh says if I didn't have a wife and kids and wasn't such a wuss, I would pack up every gun I owned and head south to straight merc traffickers. I'm not sure. That sounds like some kind of like gangster talk for killing people. But yeah. There's a special place in hell for that kind of evil. I agree, man. I agree. Oh, it's gamer talk. Okay. I'm not. I'm not into the lingos. I'm not up to speed on gamer talk. Damn, Army bro. Frank Lehman, you guys are getting me in the feelers, man. That's gonna be tough. But you're right, though. can't, guys. It's hard. It's really hard to continue to talk through this. I can't, like, all the comments are coming in. It's just like, oh, man, it is so hard. I'm glad that 10ds++ recommended that I play that, because I'm glad that it gave me an opportunity to be able to let you guys know. Awareness is key. Albert says we can do our part by buying and holding. Remember, JP Morgan bankrolled those Epstein trips. I'm telling you, man, all this stuff is interconnected. A lot of it is very, very. I mean, I got to throw on a tinfoil hat. I don't even feel like I have to throw on a tinfoil hat. A lot of this stuff is really. I mean, look, wasn't JP Morgan responsible for some shipments of cocaine that was found on a shipping container? You know what I'm saying? Like these guys, there's so much of the stuff that's connected. It's not even crazy. It's not even funny. It's totally crazy. And you know, so I don't know if that you know ends up being your reason for one of your whys, which I think somebody put in here. If you need that for one of your reasons for your whys why you're holding on to this stock, let it be a reason. It's all dirty. It's all dirty money. It's 9:47, guys, and I forgot to go wake up Hunter. I need to go check upstairs real quick and see if he's awake. Because he said to wake him up at 9:30. So give me 2 seconds. I'll be right back. I gotta go check on him real quick. Be right back. All right, he's up. All right. I'm probably going to start numbers right now just because we're supposed to have Jerome Powell and Ben Bernanke talking this morning. Let me pull up the live. Let's see. Okay, they got their music going on right now. I'm not sure how I'm going to make this one fit the page. I can't do that. That might work. All right, I'm gonna pause that and not pause it, but mute it. And then we can run through the numbers real quick here and take a look at what's going on. Love how this market is just not moving anywhere. What is the 6 extinction? Yucca, anytime you ask any questions from now on, it's like I don't even bother to ask or respond. Because it's just kind of like I know where it's going. It's like pointless. Let's see here. Let's take a look at what we got going on here. Taking you guys over the other page here, I won't be able to see what it is you guys are saying until you see the big tramp back up on the screen again. So hold those personal thoughts, questions, comments, or concerns directly for me until then, until you see it back. We're seeing lots of shares being returned today, guys. Lots and lots of shares. What is happening? Starting with off exchange. By this time of the day, I would expect to see about 49% going through off exchange. EDGX to be somewhere between 11 and 12%. On AMC, we have approximately 51.22% going through off exchange. EDGX is at 11.95. The combined total on that 63.17%, or 3.17% higher than what I would expect by this time of the day. CHX volume is 0.05 with a 30-day average of 3.27, so nothing unusual going on there just yet. On APE, off exchange is 56.46. EDGX is at 4.03. The combined total 60.49%, or about 0.49% higher than I would expect by this time of the day, so nothing unusual going on there. It's right where it should be. CHX volume is 0. On GME's CHX volume, it is currently at 0.24 with a 30-day average of 0.21, so it's a little elevated. Taking a look at Ortex data for AMC. As of an hour ago, there was approximately 515,000 shares borrowed for the day today. It's now 889,000 shares. That's going to have the effect of raising that short share interest of the free float some more to 25.11%. Cost to borrow mins at 8.21. Average 57.19 and max is 356.8. Shares on loan day over day decreased by 210,000 shares. Ortex estimated about 52,000 of that was in closed short interest, bringing our shares on loan to 168.59 million shares. Taking a look at APE. As of an hour ago on APE, there was a return of 26,000 shares. That is still the same. No change to estimated short share interest of the free float at 5.56. No shares borrowed, so cost per average max and min is NA. Shares on loan day over day decreased by 3.7 million shares on loan for APE, bringing us to 19.37 million shares on loan. Taking a look at options. Highest amount of volume so far for the day-to-day on calls is at a $5 strike, which is down from $6 an hour ago. And we're actually starting to see it dropping pretty rapidly right now in price. We'll get back to it here in just a minute. There was 1.6 thousand contracts at 6 an hour ago. At 5, there's now 2.8 thousand contracts. And on puts, highest amount of volume is at a $5 strike. An hour ago, there's 2.4 thousand contracts. There's now 8.3. Definitely a huge uptick in put volume at a $5 strike. Combined price of AMC and APE is currently at $6.55. We are getting that push down back down into the. We're getting that drop. We're nearing the end of this this period of consolidation that I was suggesting, except for it was on the top side, not on the bottom side. Looks like we're going to be running back down to consolidate yet maybe once more, followed by this. Instead of going up, it may end up going down after we get this next consolidation period, so it might look more something along the lines of this. Like price might come down here. I can just take this, move it up. Price may come down to here and consolidate sideways, leading into the end of the weekend at about maybe like a Combined price of 646. Orders by Fidelity customers, AMC, APE, and GME are the only three that I'm going to be looking for on this page here. They are not on there due to low volume. SSR trigger price for the day today is at 456 for AMC, APE at 1.467. Shares available to borrow is up to 1.8 million shares available to borrow now. Let's see what's been going on here. Just mainly returns of shares. Closing of short interest is usually a good sign. It is bullish. Hopefully that's what's going on here as we're seeing closing of short interest. Fees are currently at a 66.7% rate. NASDAQ is down 0.01, Dow Jones is up 0.3, and the S&P 500 is up 0.26. We have 3,535 advancers to 2,656 decliners. The market's just fractionally more down than it was in advancers than decliners from an hour ago. And then banks, some of our biggest movers. Silvergate 4.35% down. PacWest is up 3.77. Coinbase is down 3.09. And that's it. Those are the biggest movers. Ethereum Classic is down 0.08, starting to head towards green. DXY is down 0.15. WTI or oil is up 0.97. Mortgage-backed securities are down anywhere from 0.3 to 0.34, and the SPY is up 0.22. VIX is starting to go green. It's at 0.25. VBR is down 0.12. VB is down 0.11. Tesla is up 1.65. Amazon is down 1.11. Cinemark is down 2.03. Doge is up 0.01. Bitcoin is up 0.03. GME is down 2.13. HYMC is down 1.97. NCMI is up 2.28. HUD is down 0.52. APE is down 2.45. And AMC is down 1.97. Inflow versus outflow for the day today, we have approximately what am I trying to say? $700,000 more inflow than outflow. 3.5 million shares traded so far for the day today after what are we at here? Almost 90 minutes. 88 minutes worth of trading. We're on pace for 15.51 million shares traded by the end of the day today. That is definitely within the 5 to 25 million I suggested in pre-market. On a 4-hour time interval, we've got more buying pressure than selling pressure with an RSI of 35.79, which is below average. On a 1-hour time interval, we've got more selling pressure than buying pressure with an RSI of 34.23, which is below average. On a 30-minute interval, we have more selling pressure than buying pressure with an RSI of 28.41, signaling oversold, and are touching the bottom side of a Bollinger Band here. We should see a return on this. On a 5-minute, at least a return to the simple moving average, which is around 509. On a 5-minute interval, we've got more buying pressure than selling pressure, marginally, with an RSI of 34.86, which is below average. On APE, $300,000 more inflow than outflow. 1.64 million shares traded after 89 minutes worth of trading, putting us on a pace for 7.18 million shares traded by the end of the day today. That is within the 1 to 20 million I suggested in the pre-market. On a 4-hour time interval, we've got more buying pressure than selling pressure with an RSI of 47.1, which is slightly below average. On a 1-hour time interval, more selling pressure than buying pressure by a lot, with an RSI of 44.78, which is slightly below average. On a 30-minute interval, more buying pressure than selling pressure with an RSI of 43.18, which is slightly below average. On a 5-minute interval, we've got more selling pressure than buying pressure than RSI, 42.81, which is below average. I'm seeing a news article here for AMC. So they're harping on return on invested capital. Yeah, that's it. They're just harping on that. They're harping on the fundamentals, which we know. We know they're not the best. It's 10:01, and they're speaking.
Support, helping other people, and so on. Tomas was one of the few people who scored high on both dimensions. On the CV side, beginning with his work with me, he had a tremendous input into the Federal Reserve's framework, working on inflation targeting, working on the more recent Fed framework. He did work, I'm sure John Williams talked about his work with Tomas on the natural rate. He worked on the effects of deficits on interest rates, again, another contribution. So a person who made a lot of intellectual contributions at important points. But as a person, he was just a very warm, kind, friendly, helpful person, and he was just a joy to work with. And I'm glad to be here to say this about him.
Thank you. Jay?
Thank you, Trevor. So first of all, let me say this conference is a very fitting tribute to Tomas, and I'm really delighted and honored to be part of it. And let me add my thanks to those of us who made all of this happen here today.
Tomas?
So I first met Tomas when I joined the board as a governor in May 2012, almost exactly 11 years ago. And in preparing to join the board, and then in the early years at the board, I was very focused on developing a deeper background in macroeconomics and monetary policy. Many people here at the board supported me in that process, too many to name here, but I will say Tomas really stood out. And it was during the process of reading, the literature and discussing it that I really started to get to know him. He had this great ability to communicate complicated ideas. He obviously loved talking about economics, and his great enthusiasm and willingness to engage with me, a new governor, was immediately evident. He was very gracious to me, and we had a lot of informative discussions. So rather than being his teacher, I was really his student in those early years. As you know, by the time, as you noted, Trevor, by the time I became chair in 2018, Tomas was the head of the Division of Monetary Affairs. And in that role, he was a trusted advisor to me and to the FOMC. His leadership was particularly important as the FOMC conducted our first ever public monetary policy review. He played a major role in organizing that, identifying key topics, and organizing the staff all through the Federal Reserve System. He also played an absolutely essential role during the critical period of the pandemic at the very beginning, when we were marshaling our forces and our tools to stabilize the financial system and protect the economy from even more dire consequences. And through it all, he did come through as, not just for his dedication, his great intellect, and his mastery of monetary economics, but also just for his kindness as a human being, and just as in being a terrific, great colleague and a great person.
Thank you. I think there's a lot of agreement for the sentiments that both of you have expressed. Appreciate that. Before we get to some questions on some current issues, I did want to ask you both about any formative experiences that you may have had that have shaped your views, particularly about your thinking about monetary policy. Paul Volcker, in his oral history interview, tells the story of his mother, who was adamant that he received the same dollar value monthly allowance when he was in college that his older sisters did 10 years prior. And of course, he was not too happy about that because inflation in the interim had obviously eroded the real purchasing power of that allowance. So as the story goes, that was the beginning of his personal commitment to price stability. So Jay, do you have any such stories to tell?
Maybe not quite that on point, but so I graduated from college in 1975 during what we now call the Great Inflation, and same college year as Ben. And I started working as a lawyer in the financial sector in the late 1970s. I recall from that time a growing sense that high inflation was essentially a permanent part of the landscape, just something that we all had to accept and deal with, and that the costs of getting rid of it were too high. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability. And one lesson from that era is that price stability is really the foundation of a strong economy, and that the economy doesn't work for anyone without price stability. Another is that high inflation when we have high inflation, it is the responsibility and the obligation of the central bank to restore and sustain price stability. So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation.
Somehow you have failed to bring me
in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Dan.
Well, I had mentors, Dale Jorgensen at Harvard and Stanley Fisher at MIT in particular, but I'm going to tell you about something that happened to me when I was 6 years old. I used to visit my grandparents in Charlotte, North Carolina during the summer, and I would sit on the front porch of their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down. And she told me that, it was a very hard time. A lot of the kids went to school in tattered shoes or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that you had the same productive capacity in 1933 that you had in 1928. And in 1928, people were dancing to Charleston. In 1933, they were in bread lines. And that really impressed on me, that economics can make really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. I know that's certainly a key motivation for many people in this room to be working so hard. Okay, let's now turn to some topics of more current interest. And I'd like to start with the nexus between the financial system and the macroeconomy. Both of you, during your tenures as chair, have faced very significant historic financial crises. Ben, obviously you confronted the global financial crisis, and Jay, the global pandemic. Those episodes were clearly acute, very vivid examples of the connections between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk. In particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, the good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion, and people looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that, and that caused people to begin to remove, deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course, but I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages, in that U.S. Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, if it does decline, U.S. Treasuries actually become more valuable rather than less valuable, and so there's kind of a counter-cyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to, say, the GFC or the Great Depression, overall, borrowers are in much better shape, than they were in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools and liquidity tools as opposed to more traditional monetary policy tools and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient.
What? Okay. I mean, he's literally reading off of papers, and I have a problem with this. I have a serious problem with the fact that he's having to read this off of a paper that he wants to state, first of all, that the banks are strong and resilient. Wow. You can't look us in the eyes and say that. You have to read it off paper. Okay.
Concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, the discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth.
He's selling us a script.
So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain. So,
okay, thank you. And of course, that I think the effectiveness of those tools is reflected in the fact that the FOMC has actually raised interest rates twice since the emergence of the banking strains. Of course, and the purpose of that is to confront the inflation issue, which brings us to our next topic. Which
That's ridiculous.
You know, in the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks, and in particular, the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic is going to look quite different than prior. Jay, maybe we can start with you.
Can you read your next part of your script, Jay, please?
Argued that we are entering a new period where supply shocks will be more frequent. Would love to hear your views on whether you think that's a possibility and what that might mean for central banks.
That's under paragraph 2.
It's a great question, and it's one I think we'll be dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now. But for policymakers,
sorry.
So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, we'd love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The opening led to a very extended rise in commodity prices, which was difficult to deal with. We had supply chain issues, which was pretty much a new thing, which was also a contributor to inflation. So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week, the basic mechanisms, I think, are still the same. But you have a bunch of bad shocks, that's going to give you a problem. But the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there that might, make big changes in our economy. We've got, green investment, things like that might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking that the inflation process has not changed, and it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
I think it's funny how Clown 1 and Clown 2 are going off of scripts in their hands. He keeps looking down over here somewhere. I doubt he's reading off anything, but I do notice he's looking someplace past these gentlemen, a little bit to their left of him, in front of him. But one of the things that I think is funny is it's more or less like these two guys are going off a script, and then it's his job to come in and just be like the, like, let me just dumb this down a little bit for you, kind of guy. Like, let me just kind of like add some general comments in here to make everything kind of seem more natural.
The problems with understanding what the natural rate of unemployment is, or is slack really not the key to understanding inflation in the first place? Ben, you want to take that one first?
As I was talking about before.
Oh, there it is. I knew it. I knew he was looking at something to the left of him. It's right there. There it is right there. He's got a prompter. Bernanke's looking at a prompt. I knew he was looking down and to the left of something over there. I wasn't sure what it was. I didn't think it was a prompter, but there it is. We can see it plain as day. He does have his prompter there.
So there has been some scrambling of those signals.
There it is. There's the look.
That being said, it's simply not true that, even in people who've understood since the 70s, that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, A, because we had oil price shocks, which the Fed did not respond to adequately, B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist. But the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistent. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to signal. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1 essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack. But the Phillips curve was once thought to be fairly steep after flattening. Relationships in the economy, like the Phillips curve, evolve over time, so I would not characterize that as a problem for our understanding of inflation.
Very good, thank you. Maybe we can pivot here to the topic of central bank communications. It's widely understood now that the better the public understands the conduct of monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communication, say, revolution began, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. If you go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication of what it's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public, and best way to do that is explain what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweet and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the Summary of Economic Projections, in which Chair Powell has taken to an art form. I think also, just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking about, the different aspects of the Federal Reserve's views, and again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you of course have continued to push forward on the communications and transparency fronts. Welcome your thoughts.
You know, I think the broader setting is that transparency is especially important today. Polling
like how you're reading off
show
a script?
that many important public and private
Is that
institutions
transparent enough?
globally have struggled to retain the public's trust and support in recent years. Now, we're an institution that serves a critical public mission, but to be here and work here is to know that the particulars of what we do and how we do it are not generally top of mind for most people. And on top of that, we have a critical and a rare grant of independence. And all of that, to me, means that we have a special obligation to explain ourselves clearly, what we do, why we do it, to provide transparency to the public and their elected representatives in Congress so that we can earn and deserve their trust and support. And that's a critical task if we are going to sustain our democratic legitimacy through this interesting period. My colleagues and I really take that as a primary and affirmative, proactive obligation and not something we see as a burden or of second-order importance. So in that spirit, to your point, we have followed the example of Chairman Greenspan beginning in 1994 with the first post-meeting statement, through Ben's innovations and Janet as well, in looking to foster greater transparency and accountability. And a couple of examples, we now do a press conference after every meeting, not just every other one. We have greatly expanded our congressional outreach to be certain that we hear directly from lawmakers on an ongoing basis, so that they have the information that they need to conduct appropriate oversight. As I mentioned, in 2019 and 20, we conducted a public review of our monetary policy framework, seeking input from a broad range of people and groups all around the country. We've also significantly expanded transparency beyond monetary policy. For example, we now publish semi-annual financial stability and supervision and regulation reports. Of course, there are always communication challenges, especially I find about communicating the uncertainty that attends our assessments of economic conditions and the outlook. And the good example of this is, despite our persistent efforts to explain otherwise, the policy paths from the SEP seem regularly to be taken as a firm plan or a committee decision, rather than what they are, which is a compilation of individual participants' best assessments on a particular day of appropriate policy under the assumption that conditions evolve in line with their baseline forecasts. So that's just a challenge that we constantly face in the context of great uncertainty. Despite that, I would say, though, that the summary of economic projections has actually been very useful during this tightening cycle, as markets have looked ahead and priced in future rate hikes, long before they're actually implemented.
Yeah, 2 weeks.
Your last point really brings up the idea of communications as being an effective policy tool. And I guess the key element of that is the use of forward guidance. Jay, in one school of thought, forward guidance is a tool that should really only be deployed when interest rates are at the effective lower bound. And so you can no longer provide accommodation by lowering rates further, and so you do so through communicating about the policy path in the future. But another school of thought, forward guidance should be just a regular part of communicating with the public to convey the committee's policy intentions, even far away from the effective lower bound. Where do you come out in that debate?
Well, I do think it depends on circumstances. I do think that forward guidance can be useful when policymakers have a materially different or clearer view of the likely path of policy than does the interested public. I would agree at the effective lower bound when we need to provide more stimulus by indicating an intent to keep policy accommodative longer than the public expects. There's a use case there. I also would say, though, that communication comes with a cost of misinterpretation, and it also may limit flexibility. So I think we should use forward guidance sparingly when the course of policy is either reasonably well understood or, on the contrary, is so dependent on uncertain future developments that little really can be said constructively about the future. And a good example of that was the March 2020 FOMC meeting. The pandemic shutdowns were just beginning. The level of certainty was almost unimaginable, and we chose not to issue an SEP at that point. Really, our view was that releasing a forecast at that time might have been more of an obstacle to clear communication than a help. In contrast, as I mentioned a minute ago, forward guidance has really been a useful and effective tool during the current tightening cycle, as financial conditions have tightened well in advance of actual rate increases. You know, the 2-year tightened between the September 21 meeting and liftoff in March of 20. It tightened by 200 basis points before we ever actually lifted rates, and that's significantly because of our communication. So in the current context, until recently, it's been relatively clear that further policy firming would be warranted, and our forward guidance has said so. Now, however, we've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate to return inflation to 2% over time. As I noted at the last press conference, that assessment will be an ongoing one as we move ahead, meeting by meeting. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Thank you. Jay, you mentioned that guidance can be useful at times when the public may expect a very different policy path than policymakers. How do you think about those sorts of situations?
You're right. So recently it has sometimes been the case that markets appear to be pricing in a different rate path than the committee expects will be appropriate. But I would say that that disconnect does not seem to reflect a misunderstanding of our reaction function or a lack of belief that we'll do what's necessary to bring inflation down. Rather,
this feels like an infomercial.
It appears to reflect simply a different forecast, one in which inflation comes down much more quickly than the committee participants think is most likely, perhaps due to a significant downturn. I would say also, so far the data have continued to support the committee's view that bringing inflation down will take some time. Moreover, something we often don't remember to think about
there's
is that
more.
Market prices always reflect both expectations and compensation for risk. And what market participants say in surveys of their expectations is actually closer to the views in the SEP than what is reflected in market pricing. So ultimately, my colleagues and I have our forecasts, and market participants have theirs. Our role is not to advocate for our forecast.
The sad part is that all the news reporters or all the people that are in attendance there watching look like they're as bored as hell as the people in an actual in an infomercial that's not really an infomercial that's on TV, but like one that you actually have to go and attend, where the people there are held captive and not necessarily there by free will. They look just as bored as I don't know if you've ever been to like a time co-op thing. That's what they all look like right now.
In forward guidance is a commitment forward guidance, which is rarely used, but typically at the lower bound, where the central bank promises to do something, and its credibility on the line, that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think.
It would be really funny at the end of this is if they said, like, if you guys would just like to call 1-800 the feds, you too can be a part of raising money to help keeping this economy going for just a low rate of, I don't know, a third of your paycheck. You too can be a part of making this thing turn.
Jay has emphasized, and I think should be emphasized. Another is people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some form of forward guidance, because the idea of transparency says, here's what we see, and here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counterexample, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think, just if I might editorialize one more minute, I think one of the issues is that the FOMC is so large and geographically dispersed that it's been difficult to come up with a collective committee forecast. We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other central banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish the staff forecast. So there are different ways to go about this, but again, I think that forward guidance is both an instrumental tool, but again, letting people know sort of how the central bank sees the evolving situation, even if there's lots of uncertainty, which you can say, normally is part of transparency.
Can you imagine if like you were a reporter that was genuinely into reporting on Fed actions, and you're like, I get to go sit in a meeting with Jerome Powell and Ben Bernanke in the same room, and I get to listen, and you're like probably all pumped, right? Like you're probably all pumped about, I'm going to hear something exciting here. This is going to be something cool to report on. And you get there and you just and you see this, and you're probably incredibly let down. This is like watching this is like going to an Aerosmith concert now, expecting to see I can't think, Steven Taylor doing the splits in his leather jeans, but he can't get more than 2 inches off the floor as he as he tries to jump. It's not everything you thought it was going to be.
So that statement has never been more apt than it is today. If you look back, the pandemic, the global shutdown, the historically forceful response and the reopening, all of that had no modern precedent. So it has been a time of historically elevated uncertainty and of unexpected outcomes. No advanced economy had ever faced a shutdown and a reopening, and now all of them would face it at the same time. So no matter
For whoever said you have AMC on both sides of your screen, it was more exciting. I got Ape up on the screen now. Maybe I should just put them both on AMC. It's more exciting. There's at least a little bit more movement going on. But thank you. I do appreciate that. Thank you.
Inflation through September of 2021, but then turned decisively against that expectations thereafter. And in response, we accelerated our policy firming, ultimately, as you noted, raising rates by 500 basis points in just over a year. Over this period, we communicated that the object was to reach a stance of policy that is sufficiently restrictive to return inflation to 2% over time. But we also communicated that the level of rates that would ultimately be required was highly uncertain. Now, until very recently, it's been clear that further policy firming would be required. As policy has become more restricted, the risks of doing too much versus doing too little are becoming more balanced, and our policy has adjusted to reflect that fact. So we haven't made any decisions about the extent to which additional policy firming will be appropriate, but given how far we've come, as I noted, we can afford to look at the data and the evolving outlook and make careful assessments.
Ben, when you became a policymaker, you were well versed in sort of the academic literature on decision making.
Yeah, I moved from that side to this side.
How does it work in practice?
I say uncertainty when you're an academic is trying to decide whether your error term is Gaussian or not. In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It's very difficult. I mean,
he's a good one. Oh, boy.
Got to laugh with that, but just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult, and unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as new information arrives.
Very good, thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically, but I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was at the beginning, very focused on the goods sector due to the rotation of demand from services to goods. And
wait a minute. Is he literally talking about going back and looking at it after it's all said and done? And it's going to be interesting instead of like, what are you doing to look at it right now? What are you doing right this second? Like, why would you need to go back in time later on down the road and say, how interesting that was that turned out that way? Or could you potentially do that right now? Aren't we already in the future? I mean, like every single minute that passes, every second that passes, we're already in the future. Hunter, you going to, oh, what do you got here? Oh, is this for you? Okay. Do I need to see this? Okay. Just leave that on the table for me. You about ready to head out here? All right, cool. Sorry about that, guys. Let's see here. I don't even know where I was saying. But I mean, like, yeah, like he's literally talking like this is going to be really interesting stuff to look at in the future when we look back on it and just see kind of how we got here. Or maybe you could do your job and do it right now and try and figure out how you got here so you can try and make changes that are going to work. Maybe.
Better, what the channels are, and to quantify the relationships so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you tremendously for sharing your perspectives with us today. It's been a highlight of our conference honoring Thomas Lobach, and so thank you very much. Round of applause.
Yeah, I'll give him a round of applause. Okay. Anyways, let's see here. We're about due for numbers in about 10 minutes here. Just about. Do you hear that, Powell? That's the sound of our children in the future booing you now. Oh, man. Look at that price action. That is something to behold on Ape. Amazing. By the way, guys, VIX is up 5.3% right now. Nope, take that back. 6.42%. VIX is up 6.42% now. Let's take a look at the DXY. DXY is down 0.47. Not a whole lot. SPY is now down 0.11. Let's see here. We've got crypto going green. Mortgage-backed securities just started going green. I bet you banks are probably starting to look real red. Let's see what the banks are looking like here. Oh, yes, they are. Banks taking a little bit of a hit and going on right now. We'll take a look at the numbers, though, here in about 10 minutes. 7.41% in the VIX. Good times. It's only the kind of picket fence, Andrew, that a true homeowner of that picket fence could love. Everybody else looks at it and goes, yee. Katie says, he said that 18 months ago that they would be able to know if they did the right thing until hindsight. Let's see. Ape is down 2.36% at 1.592. AMC is down 1.58% at 499. 4999. That was such a wonderful. I feel so let down. I feel so let down by that. I literally thought that was going to be a better talk. I feel like we missed out on. Well, I'm supposed to open the back of the Big Tramp later today. I'll open up the back of the Big Tramp after I go on my first break, come back and do my numbers. So maybe around like 12:30, we'll open up the back of the Big Tramp. 12:30 my time. Pro Driller says we need Captain Hindsight to talk to us in 3 weeks to tell us what happened. You know what, Dr. Zeno, I did. I really, truly, and honestly did. I didn't expect it to be that bad. It was pretty bad. They went off script only at the very end right there, and I think I missed part of it because I was pausing. CensoredContent says driving forward using only rearview mirror to see who you missed. Hey, look. The kids are still standing. Oh, nope, never mind. There were kids that were standing over there. Oh man, feeling the speed bumps along the way, right? Looking up in that rearview mirror, seeing what did you miss? That's a point. CensoredContent doesn't need it, but he's getting a point. I don't care. I got AMC customer support, Maggie and Roseanne, and CensoredContent all for a point for next Monday. We got to do movie trivia quiz, or not quiz, but poll to see what our movie is going to be for next week. That way I don't have to have you guys vote twice in one day for a movie. So let me go back here and see what's next. We just did Austin Powers, The Spy Who Shagged Me. Next, Arthur, The Truman Show in 2001. I think it was 2001 was the one I left off on. Let's see here. Well, I can't find my movies. They're so high up. So we have movie choices for next Monday is going to be A River Runs Through It. Equilibrium. True Grit, the new one. And Tron. The new one. I think it was the new one we decided on. Who picked that one? CensoredContent, did you want us to do the new Tron or the old Tron? I don't remember. I can't remember off the top of my head. I think you wanted. I thought you wanted the new Tron, but I can't remember because most of your movies were older, I think, except for Wreck-It Ralph. Either? Okay. All right. Well, I put new. Plague says we should all get 5 points for actually listening to that whole meeting. You're right. 5 points for everybody, which is going to cancel out everybody's points. So I'll just say 0 going into Monday. Because you're all even. So, yeah. But yeah, 5 points. 5 points for grinning through that. Now, I know Barr's supposed to be testifying again on yesterday? Yeah. Excuse me. Woo. Yeah, I think it was yesterday he was supposed to be testifying. Let me look and see here. Yep, there it is right there. I'm gonna see if I can find that and pull it up. I think. I don't know. Maybe I'll do the back of the big train. I'm not sure what I'm gonna do. Give me a second here. I'm looking. Calendar would have been the 18th. So I'm pulling it up right now, and I think I'd like to watch this. This should be with the senators, maybe. Let's see here. Why didn't it pull it up for me? Maybe I got to go to YouTube and find this. Give me 1 second. Here we go. I found it. How long is it? Oof. It's rough. It's like almost 3 hours long. I don't know. We can take it in small little chunks as we go. A little bit here and there if you guys want. About 3 more minutes and we'll take a look at the numbers. The VIX is all over the place right now, guys. It's showing up 3.3 now. It is extremely. It's jettisoning up, and then falling right back down again. It was at it had a low this morning of 15.9, and shot all the way up to 17.24, and is now starting to come back down. I always mention to you guys that some of the biggest, I feel like some of the failures that we've seen from the past in the marketplace, you have the most amount of volatility that occurs just prior to the market failure, and it's because the market can't. These changes or the swings happen so fast that they can't keep up with the moves on which way the volatility is going. So, and maybe that's what we're seeing right now. I mean, 15.9 to 17.24 from, let's see, what time is that? 10:22 to 11:40, and now it's already back down to 16:45 here. Volatility is very quickly moving. Okay, so you DM me about Sixth Instinct. I don't recall doing that. No, I didn't. What I sent you, Yucca, was the fish guy. I can't remember what his name is. I sent you a link. He was doing a live stream last night, and you were supposed the Y-Files guy. He was doing a live stream last night on YouTube from 6:40 p.m. and I sent it to you so that you could go watch it. And it had nothing to do with anything that I was doing, but it was something that it was for you because I know you guys like watching the Y-Files guys. So I just put it up there for you. But it sounds like you missed it though. Pro Jeweler says we need some violent swigs. Yeah, the fish guy. I don't know. I couldn't remember what it was. It's the Y files. I like the fish too. The fish is pretty funny. I like that. I like the fish. It's good little comedic value. All right, let's take a look at these numbers. See what we got going on here. I ain't got nothing else going on anyways, so let's take a look at this, and that way I can take a break. I'll probably turn on while I'm gone the. Maybe that's what I'll do. Instead of music from now on, I'm going to play some of these Senate hearings. All right, remember, I'm not going to be able to see what it is you guys are writing until you see the big tramp back up on the screen again, so hold those personal thoughts, comments, questions, or concerns until you see that happen. Two-factor authentication, if you don't have it, you may want to consider getting it, as it could prevent somebody from getting into your account that shouldn't be in there. When you set it up, you may be able to put in a secondary device to receive the code. If that's the case, do so. You never know when something's going to happen to your primary. Also, please take pictures of your portfolios or video footage so that you know what it is that you hold in your possession, so that in case something happens between you and your broker, you won't be sitting there going, I don't remember what I had, and your broker is going like, oh, well, we'll just make it up. We have data logs, we'll tell you. Don't do that. It already happened to people this last weekend, so it starts. Let's take a look at what we got going on here. Starting with off exchange, by this time of the day, I would expect to see about 62% going through off exchange and EDGX combined. On AMC, we've got 49.85% going through off exchange. EDGX is at 12.89. The combined total on that 62.74 or 0.74% higher than I would expect by this time of the day. CHX volume is 0.1 with a 30-day average of 3.26. On APE, 47.07% going through off exchange. EDGX is at 4.41. The combined total is 51.48%. That's 10.52% less than it should be by this time of the day. CHX volume is a little elevated right now at 0.36% of a total daily volume with a 30-day average of 0.18. Or sorry, 0.1. Sorry. 0.37 is what it is now. 30-day average is 0.1. It's only 7,500 shares though, so not a whole lot. And CHX volume for GME is at 0.29 with a 30-day average of 0.21. Options. Oops, nope, not options. Vortex. Highest amount of total volume in borrowed shares for the day today was 889,000 shares. An hour ago, it's now 923,000 shares. It's going to have the effect of lowering or raising that short share interest of the free float maybe slightly to 25.09%. Cost per borrow min 1.04. It means a lot of shares are being returned and borrowed in the same day. Cost per borrow average is 48.17 and max 356.8. Shares on loans at 168.59 million shares after being reduced by 210,000 shares as those were returned. Hunter's going to say goodbye. Sorry about that. Let's see here. Where was I? Oh yeah. Of the 210,000 shares having been returned in loans, 52,000 of that was in closed short interest day over day. Have a great day. Taking a look at APE, an hour ago there was 26,000 shares having been returned for the day, has not changed. 5.56% is the total amount of shares or 5.56 is the total amount of short share interest of the free float. Cost per average has not gone anywhere because we have no borrows for the day-to-day. Shares on loan was down 3.7 million shares returned yesterday, putting us at 19.37 million shares on loan. Taking a look at options, highest amount of call volume for the day-to-day is at a $5 strike. An hour ago there was 2.8 thousand contracts. There's now 5.5. And on puts, highest amount of volume is at a $5 strike. There was 8.3 thousand contracts an hour ago. There's now 11.4. Combined price of AMC and APE is currently at $6.58. It is finding a little bit of consolidating right now. I need to move this back just slightly. And I was suggesting that we may see consolidation for this time period in here before seeing a rip. This would probably lead into the end of the day. So we may see this price kind of consolidate out till the end of the day today. That would be my guess. And we're going to stay in this wedge perhaps maybe at least one more day. Unless we get some kind of crazy run at the end of the day. Which would be nice. It could happen. You never know. Orders by Fidelity customers. AMC, APE, and GME are the only three I'm looking for. Due to low volume, none of which are on this list. SSR trigger price is at $4.56. APE at 1.467. Shares available to borrow has dropped yet again. They had 1.8 million shares having been returned, and have borrowed another 800,000 shares so far for the day-to-day, putting us at 1.05 million shares traded or borrowed so far, according to Stocko Tracker, and fees are at 65.2%. NASDAQ is down 0.31, Dow Jones is down 0.38, and S&P 500 is down 0.22. We have 3,444 decliners to 2,763 advancers. The market's done a flip-flop on advancers and decliners, definitely more declining now than it was an hour ago. Taking a look at the banks, some of the biggest movers, we've got Silvergate down 13.04, PacWest down 3.94, Western Alliance down 5.23, Zion is down 4.15, Coinbase is down 4.56, and those are the biggest movers. Ethereum Classic is currently up 0.11. The US dollar is up 0.48. I said up, down 0.48. Oil is up 0.25. Mortgage-backed securities are down anywhere from 0.04 to 0.06, and SPY is down 0.25. VIX currently showing up 3.3. VBR is down 1.09. VB is down 0.96. Tesla is up 1.08. Amazon is down 1.46. Cinemark down 2%. Doge is up 0.32. Bitcoin is up 0.37. GameStop is down 4.61. HYMC is down 1.3. NCMI is up 1.56. Hood is down 1.33. Ape is down 2.39. And AMC is down 1.57. Inflow versus outflow for the day-to-day on AMC, we have approximately, let's just call it $1.1 million more inflow than outflow. 4.98 million shares traded, though. Not very much volume after 159 minutes worth of trading. That puts us on a pace for 12.21 million shares traded by the end of the day today. I suggested somewhere between 5 and 25. I think we'll hit that. On a 4-hour time interval, there is more buying pressure than selling pressure with an RSI of 35.22, which is below average. On 1-hour time interval, more selling pressure than buying pressure by quite a bit, and RSI at 37.11, which is below average. On a 30-minute interval, we've got more buying pressure than selling pressure with an RSI of 34.14, which is below average. On a 5-minute interval, more buying pressure than selling pressure with a divergence in the vortex indicator with more of that being buying pressure. RSI at 49.1, which is average. On APE, there is approximately $100,000 more. It's really like $90,000 more inflow than outflow. 2.24 million shares traded so far after 160 minutes worth of trading. Putting us on a pace for 5.46 million shares traded by the end of the day today. I suggested somewhere between 120 million. I still expect that to be the case. On a 4-hour chart, we've got more buying pressure than selling pressure than RSI of 46.87, which is slightly below average. On a 1-hour time interval, we've got more. I think it's more selling pressure than buying pressure, but it's really close. And RSI at 44.78, which is below average, slightly below average. On a 30-minute interval, there's more selling pressure than buying pressure than RSI at 43.4, which is slightly below average. And on a 5-minute interval, more selling pressure than buying pressure than RSI at 44.83, which is slightly below average. Question is are they going to close us out sideways, or are we going to see a bunch of closed out put positions before the end of the day is over? Next week could be a really interesting week if there's a bunch of puts that are exercised. Oh, son of a gun. It was the movie. It's the movie trivia for next Monday. My bad. I don't know how I missed putting the question in there. Vortex indicator. What's the question, DJ? Like, are you asking like what is it exactly, or? Let me pull it up here for you. So I know a lot of people who like to look at trading indicators. Some people prefer to use. I think the more popular one is VWAP. Is what I like to refer to it as. Some people say VWAP, whatever. VWAP is probably more of a more desired indicator for I think a lot of traders. I find it kind of confusing, and I feel like it's a way easier. Vortex indicator for me is a way easier indicator, and I can put them side by side for you here on the page. Let me put it up on the page. I do have, if you search in my tabs for Vortex indicator under some of my videos, I'm pretty sure I spent like a whole day like talking about it and why I think it's a good indicator. But let me pull up VWAP real quick here and just show you what the differences are. Sorry, not VWAP. I meant MACD. Sorry, I don't know why I said VWAP. MACD. So on a MACD, it's a trading signal that kind of gives you like a good idea in regards to when there's going to be a momentum swing in buying pressure and selling pressure, and so I'm not an excellent. I understand how MACD works, but I don't. For me, I feel like there's times where I see signals that are showing in here where to me it looks like large quantities, and I'm going to take AMC to a daily on this and show it on a daily to kind of give it like an idea. But I feel like there's large amounts of like this. To me, this looks like a big. I see this as a really big swing here when I'm looking at MACD. Like this looks like a very, very big swing to the downside. But if you look at price in here, I mean, I don't know if I would really say that was a huge swing in price. In contrast, I mean, if you look at if we draw out like a, let me see here. Let me get rid of my Bollinger Bands real fast. 1 second. Bollinger Bands, where are you at? For example, this downwards momentum here, and we'll chart it. This downwards momentum was a 59.14% decrease in price, right? If I pull up this one over here, well, actually, let me leave it up there. this one, right to here, was a 54.94% move. So this one was slightly less of a move, but it was more violent, right? It happened in 34 days. This one happened in 36 days. So it went down faster by 2 days, almost as much. You can see that on the vortex indicator. You can see the buying pressure fading out and the selling pressure increasing. And you can see the vortex indicator signaling the crossover on the daily right around like 313. Whereas on the MACD, it actually the signal crossed on about 3.7, around 3.7, right? And so in some cases you would look at this and you'd be like, okay, yeah, but this signaled like way late here. And it's like, yeah, but if you already see that it's turning, if you can see that there's a bottoming out of the on the vortex indicator, you know what's coming. You know it's more than likely going to cross, or that it's definitely heading in the downwards direction. So the signal's almost at the same time. It's just that I read this much different. And I've kind of compared these two in terms of like how you would read these to, and if you know anything about music, to me it's like reading this is like guitar tablature, very straightforward and cut and dry and simple. 2 lines showing you buying and selling pressure, and that's it. White line being buying pressure and orange line being selling pressure. If you pull this indicator up on your platform, it might be different colors, but the VI plus and the VI negative. Over here, you're looking at some of that in terms. You're having to read it in multiple directions because you're looking at the volume profile or the histogram, the volume histogram, along with the profile of the signal in the MACD. And so you're looking at like many different things all in one chart. And for me, I feel like it encompasses everything that you need to see in a much more detailed 2-line graph. And I can show you times where the signal will cross the MACD, giving you the idea, or the MACD crossing below the signal, that there's going to be a sell-off period, and it never happens on smaller time intervals. Usually it's much better on a larger time interval, but on smaller time intervals, if you're looking at like the 1-hour charts, you might get signals that don't actually produce much of a sell-off. For example, like this one right here. Here's a great example of that. You've got the MACD crossing underneath the underneath here, whereas on the vortex indicator, it had a very brief period of time where it crossed over and then it immediately went back, and you would have seen this before you saw this signal, and it would give you an idea that, yeah, this may not necessarily be heading the right direction. This is still not a buy yet, right? Like I don't see a good strong buy signal in here. Here's one. This one's pretty obvious. This one jets up and it kind of levels out, right? I feel like this is a much better signal. It tells me what I need to know. I've made so many mistakes in the past on trades following MACD where it signals for what appears to be a good buy-in point, or perhaps maybe a sellout point, and then ends up being wrong. So I prefer this. It's simpler, it's easier to see, and I think it really kind of comes down to personal preference. In terms of let's see, I'm pulling it up here. I don't see. I can link you to, like the quick and easy Investopedia page, so you can look at it if you want to. But I mean, you can just look that up on your own too. It's not that hard. But this is my preference, right? If MACD works for you and you prefer MACD and it makes sense to you, great. But I played a game with Adam one night, or Park Air. You know him on YouTube here as Park Air, and we took price out of the equation. We took price out. All we could see was our indicator of MACD. He saw MACD and I saw a vortex indicator. And we tried to chart the price movement based off of that signal or that indicator alone, and then took it and dragged it up to where actual price movement was. And we were both surprisingly really accurate on price movement. But when I look at MACD, I can't do it. I can't draw price movement looking at MACD because it doesn't make sense to me. But I can when I see vortex indicator. So that's why I would say, like, whatever works for you, use it. So for me, I replace MACD with vortex indicator as a buy and sell. I guess a buying and selling volume oscillator. Which basically just tells you, like, when you're going to see some kind of reversal occurring. I hope that helps. I spent like 12 minutes talking about, or 20 minutes talking. I don't know. I don't even know if that helps you or not. I probably could just link you to the video for the time frame that I talked about it on the day that I talked about it. But there was a period of time where I was going over different technical indicators to kind of, help, I guess, teach a little. And so I spent some time on a bunch of different indicators, and that was definitely one of them. Another one that I would use too, in conjunction with vortex indicator, TTM squeeze, which I didn't used to use this in the past. This is kind of a new one for me. But if you can find, if your platform offers TTM squeeze, it's essentially MACD, but the nice part about TTM squeeze is it kind of gives you like different shaded area to show you when the downside of the peak has been reached and it's starting to move the other direction, which you can't see that on MACD. So if you take this and you incorporate it into a vortex indicator, I feel like it's the same exact thing, but more robust than just using MACD alone. So I would prefer to use TTM squeeze and vortex indicator in conjunction with each other for buying and selling points, for a great place to make a position. Those are way more, for me, they're way more accurate. Rich, I don't know if I've seen the hamster one. I've seen the fish, I think. I don't know. I feel like it was, I don't know. I can't remember if it was a fish or not. I feel like it was a fish. All right, I'm going to head to break. Glenn says MacD on McDonald's sounds good right now. I just like calling it MacD. I think it's funny. Just like I'd call it VWAP. VWAP. Shoop wop wop. Shoopity boop boop wop wop. Let's see here. Yeah, I'm going to break. I'm starting to sing. Arthur, enjoy whatever movie it is that you're out there seeing. Hope it's a good one. Let me put up the message and we'll get that. Oh no, we'll get that hearing played so you guys can listen to that because I know you're really interested in that instead of music. All right. Hearing, Senate hearing. Where's it at? Where did I put it? Here it is. Can I just open in a new window? Nah. Good news.
Right after the
Gary Busey, we're already about 16 minutes into this, and Gary Busey hasn't started yet. So we already knocked off
their own
there he
compensation.
is. There's Gary Busey. All right, I will see you guys in a bit. We'll have Gary Busey get up here and chat at us for a little bit, and I will see you guys back in a little while. Is this playing? Yeah, should pop on. There it is.
The Senate Banking, Housing, and Urban Affairs Committee will come to order on Tuesday. We heard from the former executives of Silicon Valley Bank and Signature Bank, their obsession with stock prices and their own compensation. There's this profit at all cost mentality led their
Dang, he's hitting them up
banks
hard.
off a cliff, putting the paychecks of small businesses and workers at risk. We heard over and over they just couldn't have known the Fed would raise interest rate, despite regulators and other banks and investors warning over and over about interest rate risk. They just couldn't have known. They couldn't have predicted the social media panic, despite knowing for years that their customer bases were concentrated and posed a risk. They just couldn't have known that growing so fast to grow their bonuses would put their banks at risk, despite repeated warnings. It was basically the dog ate my homework for 3 long hours. These bank executives failed at banking 101. Their banks grew too fast. They doubled down on risky bets and riskier lines of business, never stopping to worry about whether their decisions made any sense as long as the profits kept going up and up and up. This spring, those bad decisions finally caught up with them, though not before they tried, as we all know, to cash out. Just a few years earlier, they complained about supposed regulatory burden that they felt was unfairly foisted upon them. In 2015, Silicon Valley Bank CEO Greg Becker said, quote, because SVB's business model and risk profile do not pose systemic risk, imposing the numerous Dodd-Frank requirements that were designed for the largest bank holding largest bank holding companies would place an outsized burden on us with minimal corresponding regulatory benefit. 3 years later, Signature Bank co-founder Scott Shea, raising the stakes on Becker's comments, said, we find it ridiculous and unacceptable that by virtue of growing one day past $50 billion, we'll be burdened with rules intended for the mega too big to fail banks. We strongly believe we're not even in the same zip code as being systemically important to the U.S., to New York, even to Midtown Manhattan. Turns out they were both very, very wrong. On Tuesday, we also heard a lot of blame placed on regulators. We know that regulators warned these banks over and over there were glaring risks on their balance sheets. It's fair to say, though, that regulators should have been tougher and stronger. They should have, as Senator Tester said in this hearing 2 days ago, they should have dropped the hammer. But let's think about why the hammer didn't come down so hard. The strongest hammers were taken out of their toolbox. It's not a coincidence that both banks' rapid growth started in 2019, right after the Trump bank regulators rolled back rules for banks of that size. Bankers like Greg Becker and Scott Shea and their lobbyists begged for weaker rules, begged for lax oversight. And lo and behold, weaker rules and lax oversight are what they got. The former FDIC chair said that if bankers feel examiners are overstepping their authority, quote, let us know. The former acting controller said the OCC is trying to improve its, quote, responsiveness to our customers, which are the banks. Think about that. The regulator in charge said the banks are their customer. We're all friends here. That was the mentality. It was the weaker rules on the books, and it was the culture they created in the top and allowed to fester. Former vice chair of supervision said, Vice Chair Barr's predecessor said, markets are always ahead of the regulators. Frankly, that's how it should be. It's analogous to the advice that my father provided me, that if you don't miss at least 2 or 3 planes a year, you're spending too much time in airports. He continues, if the regulators aren't a little behind the market in a few areas of any given time, they would be stifling innovation and evolution. In other words, it's better to let wealthy Wall Street profiteers go unchecked because they might figure out another creative way to boost their stock prices and pad their pockets. Regulators they didn't just miss the plane, they allowed a couple of plane crashes. Let's be clear, banks are not regulators' customers. They're not your friends, they're not your clients. Regulators serve the public, or at least they should. You are the ones who are supposed to police these powerful banks and give people peace of mind that their money is indeed safe. The purpose of these hearings isn't just to place blame, it's to actually fix what went wrong. We need to undo the damage the last administration did as they weakened rules and preached about it, I might add. We need to strengthen our guardrails like capital and liquidity and stress tests. We need to address some of the issues that regulators have identified in their reviews on the failed banks, like staffing, which is a result of years of budget cuts and shifting priorities under the former administration. The examiners and regulators need to have the tools and the resources and the support they need to protect the public. We need to consider options for deposit insurance reform to protect stabilities in consumers and small businesses. We need to improve our merger policy so that failed bank acquisitions by mega banks are only a last resort. We need to restore the culture of supervision that puts the public interest ahead of bank executives' stock portfolios. Of course, it's good for our economies and our economy and our communities and the public when we have successful banks. No one disagrees with that, of course. What we have seen in too many cases, though, isn't just banks being successful, banks turning a reasonable profit. SVB and Signature's profits soared, and so did their executive compensation, always linked in these banks, as they push for even more uncontrolled growth. Profits can't come at the expense of everything else. Regulators, you can't allow them to. Banks must be well managed and resilient and put their customers first. We must hold everyone responsible for these failures accountable. At the top of that list must be the CEOs and executives who ignored warnings and ran their banks into the ground. I'm working with members of this committee in both parties. I hope there will be bipartisan support on legislation to strengthen your ability to hold bank executives accountable for their wrongdoing. I want to see meaningful punishment and deterrence, not just slaps in the wrist or paltry fines, barely a speed bump in their race for profits. I urge you to use your authority to protect the public and the many bank and credit union executives out there who are doing right by their customers. That's most of them, of course, by holding failed bank executives accountable for their failure, for their greed and incompetence. Our witnesses all know you work for the American people. I look forward to hearing how we can strengthen financial stability, stay ahead of risk, protect workers, families, and small businesses that power our economy. Senator Scott.
Thank you, Mr. Chairman. Today's hearing is about regulatory supervision and congressional oversight, something that we all take very seriously. I hear a lot from my friends on the left that this is somehow a legislative failure, that you didn't have the power needed to supervise the banks. There's nothing further from the truth than that concept, that you did not have the legislative power necessary to do your jobs. That's just false. We can point to S-2155 all day long, but if you read S-2155, you come to the conclusion that the supervisors had the ability to enforce a regulatory regime to keep America's financial institutions safe. You did not use the tools in the toolbox to do the job that was necessary. People at home take this opportunity to view the 6 alphabet soup agencies and try to figure out what we're here talking about. We're talking about the safety and the security of the greatest financial system in all of the world. For the average viewer at home, they're asking real questions about, is the system safe for me? For those who are unbanked or underbanked, who have challenges having confidence in the banking system, this is a challenging day. For those who want to have more confidence in a system that they've never had confidence in before, this is a serious day. For those who look at this situation and ask themselves, why do they have to pay higher interest rates or higher fees on products from banks because bank execs didn't do their jobs and regulators weren't paying attention? So far, we have no answers. Each of you are working on broad proposals and regulations that will affect our financial institutions, and I expect we'll hear a lot about that today. But what I'm concerned about is that we won't really get to the fundamental question about why, when you had an opportunity to do the job assigned to you, it just wasn't done. When we look at the failures of both Silicon Valley Bank and Signature Bank, we come to a couple of conclusions. And I've said this a few times before, but I think it bears repeating. That the situation that we saw that led to 2 of the largest bank failures in American history were caused by 3 things: bank mismanagement, supervisory failure, and soaring inflation caused by the Biden administration. Today, we're here to focus on the supervisory failures. From the beginning, regulators called these failures idiosyncratic events. This implies that they just popped up out of nowhere, like mushrooms after a rainstorm, that there's no way in the world you could have forecasted what was going to happen. But after listening to the CEOs on Tuesday, the one thing we walk away with from Signature's CEO, Mr. Becker, is that for 20 years, they had the same business model that had over 80% of their deposits uninsured. 2 decades, the deposits were uninsured over 80%. That is not idiosyncratic to me. It seems pretty much like the norm. We also heard from Mr. Becker that the flashing lights, the warning lights, had been going off since the first quarter of 2022. That's a long time before March 9th of 2023. And then your reports reinforce the fact that the warning lights were going off well before the first quarter of 2022. You all have failed, many of you have failed the American people. Failed the American people in keeping their confidence high in our financial system. I want that to sink in. You get to come to Congress. You spend 5 minutes answering questions from each one of us with the ability to play dodgeball for those 5 minutes. And then you go back to your respective agencies and you hold no one accountable. Even though your reports say that there was failure within your midst, failures within your agencies, and yet not a single employee or yourselves are held responsible. Mr. Barr, it seems like, as we talked about last time you were here, about the reports that were going to come out on May 1st and what it would find. The one thing that's clear is found that the Federal Reserve didn't do their job. And yet, here we sit again. Your report says you acknowledge that the supervisors of the Federal Reserve failed to act swiftly and do their jobs, but in the next breath, you point the blame at Congress and S-2155. And I read through the legislation just to make sure that I did not misunderstand what part of the legislation withdrew your ability to provide the supervisory responsibilities. I couldn't find it because it's not there. I find it ironic that the ultimate takeaway was ask for more authority, not less, more authority, as if somehow it was stripped away. And it simply was not. But that to me is exactly what happens in Washington when something bad happens. No one takes responsibility, and we take more authority in the regulatory framework of this country. And what happens when we take more authority in the regulatory framework of the country, Mike, you know, and I certainly know it as a small business owner, the more capital that you push to the sidelines in hopes of solving a problem that had to do with liquidity and not capital, you actually rob small business owners, women small business owners, minority small business owners, everyday small business owners, rural small business owners, from the capital necessary to borrow the money to create a more sustainable, more resilient, healthier community. When the failure happens, ultimately, the new level of supervision that says we're going to put more capital on the sidelines only impacts entrepreneurs, only impacts seniors hoping for a better return, only impacts everyday Americans living paycheck to paycheck, trying to figure out how to make this economy and this system work for them. I don't know how we explain to the small business owner who can't get a loan because we've improved the capital standards by having more cash on the sideline so there's fewer dollars to loan out. That, because you didn't do your jobs, sounds like doubling down and making the average person in the country pay a very high price for your failures. I think you're making it more and more difficult for the average American in the average place to contribute to a thriving economy.
Thank you, Senator Scott. I'll introduce today's witnesses. Federal Reserve Vice Chair for Supervision, Michael Barr, welcome. FDIC Chair Marty Gruenberg, welcome. And CUA Chair Todd Harper, welcome. All three of you been here many times. Acting Controller of the Currency, Michael Sue, welcome back. New York Department of Financial Services Superintendent Adrian Harris, welcome to the committee. California Department of Financial Protection and Innovation Commissioner Chloe Hewlett, welcome. Mr. Barr, please begin your testimony.
Chairman Brown, Ranking Member Scott, and other members of the committee, thank you for the opportunity to testify today. Overall, the U.S. banking system remains strong and resilient, and depositors should be confident that all deposits in our banking system are safe. At the same time, recent stress in the banking system shows the need to be vigilant as we assess and respond to risks. My review of Silicon Valley Bank's failure demonstrates that there are weaknesses in regulation and supervision that must be addressed, and I am committed to doing so. I am also committed to maintaining the strength and diversity of the banking system so that it can continue to provide financial services and access to credit for households and businesses. As we consider adjustments to our rules and supervisory practices, I am sensitive to how changes may affect banks in the current economic environment. My written testimony and accompanying supervision and regulation report provide detail on conditions in the banking sector and supervisory and regulatory efforts of the Federal Reserve over the last 6 months. Let me turn to the SVB review. Immediately following SVB's failure, I led a review of the Federal Reserve's supervision and regulation of the bank. Staff who were not involved in the supervision of SVB conducted the review. The resulting report takes an unflinching look at the conditions that led to the bank's failure, including the role of Federal Reserve supervision and regulation. There are 4 key takeaways from the report. First, SVB's board of directors and management failed to manage the bank's risks. Second, Federal Reserve supervisors did not fully appreciate the extent of the vulnerabilities as SVB grew in size and complexity. Third, when supervisors did identify vulnerabilities, they did not take sufficient steps to ensure that the bank fixed those problems quickly enough. Fourth, the board's tailoring approach impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. The 4 key takeaways show failures by SVB's board and senior management and failures by the Federal Reserve. I will outline how we can strengthen both our regulation and supervision based on what we have learned and based on the Federal Reserve's existing authorities. On the regulatory side, SVB's failure confirms the importance of strong levels of bank capital. While the proximate cause of SVB's failure was a liquidity run, the underlying issue was concern about its solvency. Stronger capital will guard against the risks that we may not fully appreciate today and will also reduce the costs of bank failures. In addition, we need to reconsider our prudential requirements. These include evaluating how we treat available for sale securities in our capital regulations, how we supervise and regulate a bank's management of interest rate risk, how we supervise and regulate liquidity risk, and how we oversee incentive compensation practices. Any adjustments to our rules would, of course, go through normal notice and comment rulemaking and have appropriate transition periods. I also plan to improve the speed, force, and agility of supervision. Supervision should intensify at the right pace as a bank grows in size or complexity. Once identified, issues should be addressed more quickly, both by the bank and by supervisors. Moreover, we need to ensure that we have a culture that empowers supervisors to act in the face of uncertainty. I want to reiterate that the banking system remains strong and resilient. Recent events demonstrate that we, as regulators, must do better, and we will. Thank you, and I look forward to your questions.
Thank you, Mr. Vice Chair. Chair Grunberg.
Thank you, Mr. Chairman. Chairman Brown, Ranking Member Scott, and members of the committee, thank you for the opportunity to appear at today's hearing on oversight of financial regulators. The U.S. banking industry has proven to be quite resilient during this period of recent stress. Early reports from first quarter 2023 indicate that first quarter aggregate bank net income was roughly unchanged compared to the fourth quarter of last year, excluding the effects on acquirers' incomes of their acquisitions of failing banks. In addition, asset quality metrics remain favorable, and the industry remains well capitalized. Recent declines in medium and long-term interest rates have reduced somewhat the volume of unrealized losses on securities. Still, insured depository institutions will continue to face significant challenges in the near term. Risks to the outlook include the potential for weakening credit quality and profitability that could result in further tightening of loan underwriting, slower loan growth, and higher provision expenses. Commercial real estate loan portfolios, particularly loans backed by office properties, face challenges should demand for office space remain weak and property values continue to soften. The FDIC continues to monitor liquidity closely, including deposit trends across the industry, and will publicly release data on the first quarter of this year as part of its quarterly banking profile later this month. Last week, the FDIC Board of Directors approved a notice of proposed rulemaking providing for the special assessment required by law to recover the loss to the Deposit Insurance Fund attributable to covering the uninsured deposits of Silicon Valley Bank and Signature Bank. Under that proposed rule, the FDIC would apply an annual special assessment rate of about 12.5 basis points to an assessment base that would equal an insured depository institution's estimated uninsured deposits reported as of December 31, 2022. The assessment is defined in such a way that no banking organizations with total assets under $5 billion would be subject to the special assessment. On May 1st, the California Department of Financial Protection and Innovation appointed the FDIC as receiver for First Republic Bank. The FDIC was able to market and sell First Republic concurrently with its closure by entering into a purchase and assumption agreement with J.P. Morgan Chase Bank, following a competitive bidding process to assume all of the deposits and substantially all of the assets of First Republic. The FDIC estimates that the failure of First Republic will cost the Deposit Insurance Fund about $13 billion. The FDIC recently released 2 reports on the FDIC's supervision of Signature Bank and options for deposit insurance reform. The report on Signature Bank, conducted by the FDIC's Chief Risk Officer, found that the root cause of Signature's failure was poor management, but also identified areas where the FDIC's supervisory efforts could have been more timely, forward-looking, and forceful, findings that will be matters of close attention by the FDIC. The report on options for deposit insurance reform identified increased targeted coverage for business payment accounts as capturing many of the financial stability benefits of expanded coverage while mitigating moral hazard effects. Finally, the failures of Silicon Valley Bank and Signature Bank demonstrate the implications that banks with assets of $100 billion or more can have for financial stability. The prudential regulation and supervision of these institutions merit additional attention, particularly with respect to capital, liquidity, and interest rate risk. My prepared testimony goes into all of these matters in considerable detail. The FDIC remains committed to engaging with the public, industry stakeholders, and members of Congress on the policies and priorities outlined in my testimony. That concludes my statement, and I'd be glad to respond to questions.
Thank you. Chair Harper.
Chairman Brown, Ranking Member Scott, members of the committee, thank you for the invitation. My testimony outlines the state of the credit union industry, some of the NCUA's recent efforts to strengthen the system, and several legislative requests. So I will focus here on only a few key issues. Overall, the performance of federally insured credit unions remains stable. Total loans, assets, insured shares, and deposits all increased last year. What's more, the system's aggregate net worth ratio rose to 10.75%. Significantly, 9 out of every $10 in share deposits within federally insured credit unions are insured. That has contributed to stability within the credit union sector in recent months. The NCUA's Share Insurance Fund also continues to perform well. Although the fund's equity ratio is 3 basis points below the desired operating level, no premiums are expected at this time. That's because the system is currently well positioned to handle any dislocation resulting from a moderate recession. Nevertheless, during the last year, we have experienced growing interest rate and liquidity risks within the system, including at several billion-dollar-plus institutions. Aggregate cash positions have declined and are below pre-pandemic levels as well. Further, unrealized losses in securities limit their utility as a source of liquidity. The recent increase in these risks underscores the value of the NCUA's Central Liquidity Facility. Otherwise known as the CLF, the facility acts as a shock absorber to contain or avert liquidity crises before they escalate. However, with the termination of the temporary CLF statutory enhancements last December, more than 3,000 credit unions, each with less than $250 million in assets, lost access to the CLF, contracting the facility's capacity by almost $10 billion. With risks rising in the financial system and at individual credit unions, now is not the time to cut a liquidity lifeline. As such, the NCUA board fully supports restoring the ability of corporate credit unions to serve as CLF agents on behalf of a subset of their members. Notably, the Congressional Budget Office has scored these reforms at no cost to the taxpayer. Additionally, with increased industry concentration, intensifying cyber threats, and greater outsourcing of core business functions, the Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Inspector General have all recommended congressional action to restore the NCUA's statutory examination authority over third-party vendors. I fully agree and respectfully request that Congress close this growing regulatory blind spot. Lastly, the NCUA defers to Congress on determining what statutory changes, if any, should be made to deposit insurance coverage levels and account types. But if Congress does act in this area, the NCUA has 2 requests. First, we ask Congress to maintain parity between the share insurance coverage provided by the NCUA and the deposit insurance coverage provided by the FDIC. And second, because an expansion of coverage will generally increase resolution costs, the NCUA requests greater flexibility for administering the share insurance fund. This flexibility, which would be more in line with the FDIC's current administrative powers, includes allowing the NCUA board to establish a higher normal operating level and modifying the current limitations on assessing premiums. Together, these changes would better enable the NCUA board to build reserves during economic upturns so that sufficient money is available during economic downturns. In sum, the credit union system currently remains well capitalized, stable, and well-positioned to handle a relatively broad range of economic outcomes. And the NCUA stands ready to respond to any economic uncertainty and will continue to work through the supervisory process with any individual credit union experiencing problems. In doing so, we will be forward-looking, risk-focused, and ready to act expeditiously. Consumers, therefore, should remain confident that their insured share deposits at federally insured credit unions are safe. And the NCUA stands ready to work with Congress on any legislative reforms to strengthen and safeguard the system. Thank you again. I look forward to your questions.
Thank you, Chair Harper. Controller Sue.
Thank you, Mr. Chairman. Chairman Brown, Ranking Member Scott, members of the committee. I'm pleased to appear today to offer my observations about the recent market stress and to answer any questions you may have regarding the activities and priorities of the OCC. Since March, I have worked especially closely with my peers at the other banking agencies to maintain financial stability and confidence in the financial system. Adequate levels of capital going into the recent turmoil have helped to limit the risk of contagion. Despite the market stress, the federal banking system has remained resilient, and national banks and federal savings associations have remained well-positioned to serve their customers. None of the 4 large banks that failed were regulated by the OCC. Notwithstanding, we are closely monitoring the conditions of the institutions we supervise and working with them to ensure that their liquidity and capital positions remain sound and that they are on the balls of their feet with regards to risk management. Many have taken steps to reduce risk in light of market conditions, and to date, the vast majority of OCC-supervised banks have not experienced stress with regards to their depositors or business customers. Over the past 2 years, I have consistently emphasized to bankers the importance of guarding against complacency and having strong risk management policies and practices in place. Most OCC-supervised banks have heeded this message and successfully navigated the rise in interest rates and changing economic outlook. OCC examiners will continue to actively monitor market conditions and engage with banks to help ensure that they are prepared to meet future challenges. Based on my perspective as acting comptroller and 20 years of experience as a financial regulator, I want to share some observations on steps that can be taken to restore full confidence in the banking system. First, supervisors need support to act in a timely and effective manner. Supervisors at the OCC and the other banking agencies play a critical role in keeping the banking system safe and sound by exercising discretion. The degree to which supervisors feel empowered to exercise that discretion impacts their will to act in a timely and forceful manner. Clear support to empower supervisors to exercise discretion and act when needed will help keep the banking system safe and sound. Second, regulations regarding the resilience and resolvability of large banks need to be strengthened. Stronger resiliency requirements for large banks with regard to capital and liquidity would have reduced the probability of recent bank failures. Stronger resolvability requirements would have facilitated orderly failures with less government involvement. The OCC is working closely with the Federal Reserve and FDIC to address these issues. Third, deposit insurance coverage should be updated. The FDIC's recent report on deposit insurance is worth careful consideration, especially its conclusion regarding targeted expansion. In the meantime, we've been working with our banks, especially those with significant levels of uninsured deposits, to ensure that their cash holdings and borrowing capacity can meet depositor withdrawals. We remain committed to supervising banks so that depositors can rest assured that their money is safe. Finally, the diversity of the banking system must be preserved as the industry evolves. The OCC has been working on updating the analytical frameworks related to the bank merger guidelines that the federal banking agencies and DOJ must follow when considering bank mergers. The recent turmoil has increased the urgency of these efforts. The OCC is committed to being open-minded when considering merger proposals and to acting in a timely manner on applications consistent with the requirements of the Bank Merger Act. As the industry evolves, I believe strongly that we must preserve the diversity of the banking system, from community banks to mid-sized banks to regional banks. Going forward, continued industry and regulatory vigilance is critical. Banks and supervisors must be attentive to the most salient risks today, as well as those beyond the daily headlines. That will help ensure that the banking system remains a source of strength to the U.S. economy. Before closing, Mr. Chairman, I want to be very clear. Our customer is the American people, not banks, period, full stop. Thank you. I would be happy to answer any questions.
Superintendent Harris, welcome to the committee.
Thank you so much. Good morning, Chairman Brown, Ranking Member Scott, and members of the committee. On Sunday, March 12th, 2023, Signature failed after experiencing a propulsive run on deposits on Friday, March 10th. The run was instigated by the self-liquidation of Silvergate Bank on March 8th, and then the failure of Silicon Valley Bank on March 10th, following an unprecedented run on its own deposits. In order to avoid a disorderly midday Monday shutdown and further contagion across the banking system, on the evening of Sunday, March 12th, DFS took possession of Signature and appointed the FDIC as receiver. Before its failure on March 12th, regulators had documented liquidity-related regulatory concerns to the bank, beginning with the 2018 report of examination. Despite orders from regulators, the bank was slow to remediate supervisory recommendations, and many issues identified by the regulators remained unresolved when the bank failed. Signature's inability to remediate the outstanding liquidity management issues undoubtedly contributed to its collapse. However, the immediate cause of the bank's failure was an unprecedented run on deposits instigated by the self-liquidation of Silvergate and the subsequent failure of SVB. On Friday, March 10th, Signature experienced a runoff of $18.6 billion in deposits in a matter of hours, reducing the bank's deposit base by 20%. Throughout the day, Friday and into the night, the regulators worked closely with each other and Signature to find sufficient liquidity to satisfy the significant volume of customer withdrawal requests. After avoiding a default on Friday, regulators had time over the weekend to assess Signature's condition and come to a considered view as to whether the bank could open safely on Monday. DFS had one objective that weekend: to preserve the safety and soundness of the financial system. 3 paths were identified for the bank in order of preference. The first was to find a way for Signature to open in a safe and sound manner on Monday and continue as a stable institution. The second was to find a purchaser for the bank on an open bank basis. Third, DFS and the FDIC worked in parallel to prepare for the last resort scenario of taking possession of the bank and appointing FDIC as receiver. The regulator spent the weekend collecting and evaluating information from Signature in order to make a data-driven decision about the bank's viability. Signature's inability to provide reliable data and a credible liquidity strategy to operate in a safe and sound manner on Monday led DFS to take possession of the bank and immediately appoint the FDIC as receiver. At the time DFS took possession, the bank had $4.27 billion of certain liquidity available for Monday morning to cover known withdrawals ranging between $7.4 and $7.9 billion. These withdrawal estimates do not include additional unknown withdrawals that could reasonably be anticipated on Monday in light of market conditions. Taking possession of the bank was the option of last resort to avoid a disorderly Monday shutdown and stop any further panic and contagion across the broader banking system. DFS-regulated financial institutions are safe and sound today, but the department has instituted heightened monitoring of banks with higher risk profiles and is implementing recommendations made by our Office of General Counsel to modernize the supervision of the global financial system. Thank you, and I look forward to your questions.
Thank you, Superintendent. Commissioner Hewlett, welcome.
Chairman Brown, Ranking Member Scott, and members of the committee. I appreciate the opportunity to testify on behalf of the California Department of Financial Protection and Innovation. My name is Clotilde Hewlett. I've served as commissioner since December of 2021. Building on over 100 years of state regulation, the current department was restructured in 2020 to strengthen California's financial oversight. DFPI has broad authority touching every aspect of the financial sector in California, including banks and credit unions. Through regulation, supervision, and enforcement, DFPI promotes safety and soundness and consumer protection. State-chartered banks like Silicon Valley Bank are regulated by both state and federal regulators. State regulators play a vital role in maintaining the strength of the dual banking system, particularly for local banks that serve diverse communities throughout the community. State regulators supervise almost 80% of all banks in the U.S., which equates to more than 3,800 banks and $8.5 trillion in assets. This includes overseeing 2/3 of agricultural lending and half of small business lending. The localized supervision equips state regulators to better understand the unique demands faced by banks in local communities. In California, DFPI supervises 99 state-chartered banks with an average asset size of approximately $4 billion, nearly under $1 billion in assets, and 9 of our banks are over $10 billion. The department also supervises 113 credit unions with an average asset size of $1.4 billion. For nearly 40 years, Silicon Valley Bank was an important service provider to California's tech economy, the life sciences and healthcare sector, nonprofits, and small businesses. On March 8th, the bank announced a loss of $1.8 billion and a capital raise. Depositors reacted by initiating withdrawals of $42 billion, or approximately 25% of total deposits, over a 24-hour period, causing an unprecedented run on the bank. At the end of March 9th, the bank had a negative cash balance of approximately $958 million. We determined the bank was insolvent. On March 10th, DFPI took possession of the bank and appointed FDIC as receiver. The DFPI examined the bank in coordination with its primary federal regulator, the San Francisco Federal Reserve Bank. Federal examiners led the examination of Silicon Valley Bank's compliance with federal regulations related to enhanced prudential standards and review of SVB's liquidity and interest rate risk. The department and SFED flagged concerns about the bank's liquidity management beginning in 2021 and interest rate risks beginning in 2022. Though it is typical to provide time to remediate, the timelines were not acceptable. The department has conducted and published an internal review of the supervision and the closure of Silicon Valley Bank. That review and the recent failure of First Republic Bank highlight the need to make changes to promote safety and soundness of state-chartered banks. The DFPI is committed to working with federal legislators to develop stronger and more effective systems to promote and promptly remediate deficiencies and better allocate staff according to risk. The DFPI will increase its focus on a bank's level of uninsured deposits and require banks to evaluate and account for emerging risks posed by technology-enabled activities such as social media and real-time withdrawals. I look forward to working with Congress, our federal regulatory partners, our California state legislature to implement changes that strengthen our financial system. Thank you very much.
Thank you, Commissioner. As outlined in the failed bank reviews you conducted, regulators identified risks like interest rate risk, liquidity risk, and corporate governance issues. As any good banker knows, when regulators point out problems, you fix them right away. Once issues were identified by the regulators, the CEOs of SVB and Signature suggested at our hearing on Tuesday that their leaders corrected deficiencies in a timely way. Mr. Barr, Mr. Grunberg, Ms. Hewlett, Ms. Harris, answer yes or no if you would. Is that true? Did they quickly fix the problems your examiners identified?
They fixed some problems, but most of them not. There were 31 outstanding matters requiring attention or immediate attention at the time that they failed.
Mr. Grunberg?
No, Senator.
Ms. Harris?
No, Senator.
Ms. Hewlett?
No.
Thank you. This goes to all six of you. Will you commit to improving both examinations and enforcement to crack down harder and faster on bank executives that just don't listen? Mr. Barr?
Yes.
Yes, Mr. Chairman.
Yes.
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 Thank you. In response to Senator Round's question on Tuesday about removing hedges from SVB's investment portfolio, Greg Becker, the CEO of SVB, as we know, threw up his hands and, pardon my cliche, but this one actually fits, pushed his employees under the bus. Of course, the CEO of a bank is all responsible for crashing his bank. Chair Gruenberg, is it difficult to hold senior executives of large, complex institutions accountable and ban them from driving another bank into the ground?
Oh, Senator, we certainly have the authority to do that and have done that in the past and have to be prepared to do that going forward.
Controller Sue, do you agree?
I agree.
Okay. We need to close these gaps, and I know many members of this committee on both sides of the aisle agree. I listened to pretty much all of them with Mr. Becker and with the two executives from Signature. I'm working on legislation to make sure executives of big banks like Silicon Valley can't hide behind their subordinates, to avoid accountability. Let me follow up on the impact of fast growth, a subject that most of you have touched on and was the subject of much of the testimony on Tuesday. Your reports explain that the problems of SVB and Signature got worse because the rules for larger, more complex banks do not apply immediately as banks grow larger. A prominent bank lawyer recently testified in a House hearing that these rules need to be revisited Because essentially, long transition periods allow a $200 billion bank like SVB to be treated like a $50 billion bank. This question is for Vice Chair Barr and Commissioner Hewlett. How did the transition period that SVB had before the large bank rules kicked in contribute to its condition and ultimate failures?
Well, under the prior approach, they would have had heightened prudential standards applying to them as they grew in size over the last 3 years. Because of the way the tailoring rule worked at the Federal Reserve, they basically had
That was Mr. Quarles. That was Vice Chair Quarles' tailoring rule, correct?
But the board as a whole made the decision to put that rule in place in 2019.
But he had your job at that time, correct?
He did. He was vice chair for supervision.
And he led on that effort. And typical culture at the Federal Reserve is if someone's empowered to do certain things, whether it was Lael Brainerd on CRA or Mr. Quarles in that job, the Fed generally follows, correct?
The vice chair for supervision has explicit statutory authority to take the lead in supervision and regulation.
Okay. Ms. Commissioner Hewlett, your comments on that?
Yes, there was a new program, regulations put in place by our federal partners, the large foreign bank organization program. Silicon Valley Bank was the first.
What is she on? What is wrong with her?
Bank, due to its rapid growth, to move from being a regional bank into that program. And the transition, because it was the first, took a much longer time.
I think she's drunk.
What it normally would have taken if the program had been in place.
Hiccup.
And that transition is
hiccup.
a lot of what contributed to the delay.
Thank you. It sounds like the so-called tailoring rules advocated by the former vice chair for supervision were set up to fail. And as I think all of you remember, neutral observers who don't see the banks as customers or clients in the regulatory process warned about Mr. Quarles weakening those rules. And I think we will see a lot about fixing that in the future. This is for Mr. Grunberg and Ms. Harper. Mr. Harper, I'm sorry. Earlier this week, the failed bank executives gave a lot of excuses, but failed to take responsibility for their mismanagement and their incompetence. The community banks and credit unions I talked to know that dangers were not hard to spot, like a high concentration of uninsured deposits and aggressive growth. As we know, 90% of top deposits at SVB were uninsured, unlike any other bank that I know of comparably sized, certainly in my state. Neither SVB nor Signature looked like an ordinary bank, in part because of that. Chair Grunberg, and I'm running out of time, so and Chair Harper, if you would, we've seen the risk develop from an over-concentrated uninsured deposit base. What tools do the regulators have to make sure banks manage those risks?
We certainly have supervisory authorities to review and set limits on concentrations. I think that's one of the key areas we need to look at going forward, concentrations of uninsured deposits at institutions. It clearly poses a liquidity risk that we need to focus on going forward, Senator.
Thank you, Chair Harper.
We also have concentration limits as well as our liquidity rules that are in place, although if I could reemphasize here the importance of acting on the central liquidity facility reforms so that we can make sure that small credit unions across the board have access to the facility. That would be an important reform for Congress to make.
Thank you, Senator Scott.
Thank you, Mr. Chairman. I find it interesting that
you're drunk. Mr. Scott says, I find it interesting. I think you had too many. My gosh, she seriously seemed like she might have a few too many alcohol drinks today. Let's take a look at these numbers, guys. That was crazy. I mean, somebody said Xanax. I don't think I've ever had an opportunity to be able to be around somebody who's been on Xanax before. So I don't really know what that's like or what it looks like. I could imagine, I guess, if you were kind of tire that it would kind of be something like that, maybe. I don't know. But let's take a look at our numbers here. Let's see what we got going on. Oh boy, these people. They make it easy. They make it really, really easy to just kind of, poke fun. But it's really in good nature, guys. I don't really mean any harm by it. Excuse me. Off exchange. By this time of the day, I would expect to see about 63% going through off exchange and EDGX combined. On AMC, we're at 44.28%, EDGX 11.5%, combined totals 55.78%. That is 7.22% less than it should be by this time of the day. CHX is 8.36% of our total daily volume, with a 30-day average of 3.34, which means there's still a need of returning of failure delivers 539,000 shares having been returned. That is a significant amount of shares. On APE, 50.38% going through off-exchange. EDGX is at 5.31. The combined total, and that's 55.69%. That is 7.31% less than what we would usually see. CHX volume today is 0.25% of the total daily volume. You know what? These numbers don't look updated. Hold on a second. All right. I guess they're updated. CHX volume is 0.25% of the total daily volume with a 30-day average of 0.1. But it's only 7,500 shares. So it's a high percentage amount. Due to low volume, it's not very many. On CHX, for GME, it's at 0.21 with a 30-day average of 0.21. So it's right where it should be. Or at least it's at where it's averaged for the last 30 days. Taking a look at Ortex data, an hour ago there was approximately 923,000 shares having been borrowed for the day on AMC. It's now only 197,000 shares, which means shares have been returned. That's going to cause the estimated short share interest of the free float to drop to 25.07%. Cost per borrow mins at 8.21, average 58.19, and max is at 356.8. Shares on loan day over day dropped by 210,000 shares. Vortex estimating that about 52,000 shares of that was in short interest that was returned or closed, leaving our shares on loan at 168.59 million. On APE, still just 26,000 shares having been returned today, so that's going to keep that short share interest of the free float at 5.56. No borrows for the day today, hence the reason for no numbers for average, max, and min on cost to borrow. Shares on loan, 3.7 million shares were returned yesterday, putting shares on loan for APE at 19.37 million. Options. Highest amount of call volume for the day today has been at a $5 strike. There was 5.5 thousand contracts an hour ago. It's now 8.3. And on puts, highest amount of volume is at a $5 strike. It went from 11.4 thousand contracts to 16.4. Do note, there are put options being purchased in the money again at a $10 strike of 3,000, almost 3,100 contracts. 0 call options at a $10 strike. Yeah. Combined price of AMC and APE is at $6.61. We're retesting the top of this again here. Wants so badly to break out, but not able to just yet. Not enough volume. Gonna need to see more volume to get the break. Orders by Fidelity customers, AMC, APE, and GME are the only three I'm looking for on this list here. I doubt that any three of those will be on the list due to low volume quantities for the day today. AMC, APE, and GME are not on the list. SSR triggers at $4.56. Holy moly. Lots of activity in here today. Another 100,000 shares. They returned about 300,000 shares earlier and then borrowed another 100,000 for the day today. So we're at 1.15 million shares borrowed. Fees are at 65.2%. NASDAQ is down 0.14. Dow Jones is up or down 0.21. S&P 500 is down 0.07. We have 3,351 decliners to 2,885 advancers. The market's just slightly more advancing than it was an hour ago. Banks, big movers. Silvergate down 12.17. PacWest down 2.83. Hold on a second. This keeps adjusting on me. Western Alliance is down 3.45. Zion is down 3.19. Coinbase 4.58 down. Those are the big ones. Ethereum Classic is currently showing down up 0.17. DXY, or the US dollar, is down 0.47. Oil is up 0.73. Mortgage-backed securities are down anywhere from 0.11 to 0.13, and SPY is down 0.08. VIX up 4.74. VBR is down 0.95. VB is down 0.81. Tesla is up 1.91. Amazon is down 1.41. Cinemark is down 1.59. Doge is up 0.47. Bitcoin's up 0.42 at 26.9K a coin. GME is down 4.51. HYMC down 2.16. NCMI is down, or up rather, 1.97. Hood is down 0.87. Ape is down 2.15 at 1.595. And AMC is down 0.79 at 503. Inflow versus outflow for the day-to-day on AMC, about $1.2 million more inflow than outflow. 6.41 million shares traded so far after 236 minutes worth of trading. Putting us on a pace for 10.59 million shares traded by the end of the day today. I suggested somewhere between 5 and 25. Looks like we'll hit it. On a 4-hour time interval, we've got more buying pressure and selling pressure than RSI of 37.91, which is below average. On a 1-hour time interval, more buying pressure than selling pressure with an RSI of 43.54, which is slightly below average. On a 30-minute interval, more buying pressure than selling pressure with an RSI of 44.57, which is slightly below average. And on a 5-minute interval, more buying pressure than selling pressure with an RSI of 58.59, which is slightly below. No, that's above average. Sorry. On Ape, we have $110,000 more inflow than outflow. 3.14 million shares traded so far after 237 minutes worth of trading, putting us on a pace for 5.16 million shares traded by the end of the day today. That is within the 1 to 20 million shares I suggested in pre-market. Nothing but a bunch of sidewards trading today. On a 4-hour time interval, we've got more buying pressure and selling pressure than RSI 46.87, which is slightly below average. On a 1-hour time interval, more selling pressure than the buying pressure with an RSI of 47.05, which is slightly below average. On a 30-minute interval, equal amounts of buying and selling pressure with an RSI of 46.87, which is slightly below average. On a 5-minute interval, more selling pressure than buying pressure with an RSI of 53.75, which is slightly above average. I don't know what happened to Trenton because I didn't see it, but Trenton, I hope everything's okay. Bird Eye says May 10th, Robinhood tweeted that 24-hour trading would roll out May 16th. May 15th, they tweeted 4 times your portfolio value may show up different. We're working to fix it. No tweet since. I heard sometime next week. Missed what happened. Yeah, me too. I missed what happened as well. Let's see here. What? Why did we let the guy from a foreign country select the movies for trivia? That sounds kind of racist. Because everybody's equal here, that's why. Let's see. I'm not sure what Pirate Porn's talking about in regards to Bigfoot. All right. So, anybody up for leaving off where we left off at with great answer, Casey. I mean, it's true. There's no differences here. It's all people equal, man. That's why we call ourselves apes to begin with. And if you got problems with people from different race or different sex or different anything, you're not in the right place. I hate to break it to you, but you're literally in a place where we call ourselves all people equal. So, I don't know what to tell you, man. Don't know what to tell you. Are we good with going back to the Senate hearing? Because I don't really have anything to cover right now. Let me look at sugar real quick. I just want to see where sugar's at. Honey, honey. Every time I say sugar, I want to start singing honey, honey. Bum, 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 bum. Ah, honey, honey. Let's see. What else we got going on here? I'm looking just to see if there's any weird things happening in the marketplace. Bond yields. I think I kind of wanted to talk about those yesterday, and then I never really got around to it. Showing those. Let me check something. That and one other thing that I was going to pull up for you guys and show you. Two things. Where is it? Where is it? Let me find it. This always happens to me. It's like in my head, I'm going like, oh, I want to share this with everybody, and then I don't like copy it or like it or link it. I'm just like, oh, I'll just find it when I get back on. Of course, I get back on and I can't find it because it doesn't want to show up anywhere. Let me see if I can do it the old-fashioned way. Hold on one second. Let's see here. What is this one? I think. Let me try this. I'm going to start mouth breathing here in a minute. Sorry, guys. He's working. We can tell he's mouth breathing. Hold on a second. I'm sorry. Cracking myself up. What am I looking up again? Oh yeah, I just found it. It is, what is this called? No. Mm. Mm. Maybe this is it. This might be it. This is it. This is definitely it. That can't be right. the number that I saw was lower than this. So I'm wondering if I'm not pulling up the right chart. Oh, wait. It's maybe I'm looking at the wrong. I think I'm looking at the wrong time interval. Nope, it just shows up the same way. Alrighty. Well, hooey. I think I'll just show it to you anyways. What I'm seeing. I saw a reporting on online of a value that was a little bit lower than this. That I think was like somewhere around like 35 billion or 25 billion. I can't remember exactly what it was. But this is this Treasury deposits with Federal Reserve banks and how much is left here. The Treasury showing 184 billion on this chart left. So they're running out of time here. Not a whole lot in the coffers to I don't know to this can't be accurate. I think it might be. There's so much. All right, yeah, not a whole lot left here in the coffers. So, and I think raising the debt ceiling here is what's supposed to help this go back up. They can print more money. Perhaps this will go back up here, but I might be on the wrong chart because I feel like this number is supposed to be a little bit lower than where I'm looking at right now. So, but I saw reporting. Richard is saying 44. Yeah, that sounds a little bit closer to what I saw. I saw something lower. But I'm not able to find the chart right now, and I'm looking for it, and I don't know what it's called. So I'll have to try and find it again some other time. Not a big deal. Just thought I'd throw that up there, and it's down there. They're getting really, really close. And I think one of the things that I would say is that next week, I think they're probably going to have it ironed out by next week. In regards to raising the debt ceiling. If they don't, I don't know. I don't know what's going to happen. Who knows? Catastrophe, I would say. Yeah. I'll tell you what. I'm going to start looking for the chart while I'm on break. Also, I heard the price of gold was starting to shoot up. Let's see here. I'm showing 1980 for gold right now. Is this the daily? This is the daily chart here. Gold is doing a little bit. Gold opened up today at 1957, and it's currently at 1980. So it has definitely moved up a little bit today. Up 1.17%. Not incredibly huge amounts, but it definitely has moved up. I think that's it. Those are the only other two things I wanted to talk about. If words bother you, I don't know how you get through life. Is that to me? Let me just tell you, it's not easy. It's not. It really just isn't easy. Nikki, good afternoon. It's not easy, but I try to make the best of it. All right, let's get these guys going back up here. Get all of our blood pressures nice and boosted up a few points here.
Today is May 18th, 2023. Time is 10:22, and I've not wondered recently, but listening to this hearing, I think the American people may be asking themselves, what is the definition of scapegoat? If we were looking for a definition of scapegoat, please watch this hearing, because literally what we're hearing today is scapegoating. I keep hearing about the predecessor, who left in December 21. Mr. Barr, you started in July 2022. According to Ms. Hewitt, the liquidity and interest rate risk manifested itself in 2021, which means it was already there. Coming into a new job, you have an opportunity to take responsibility for a very important role in maintaining strength and health in our financial system. Yet we continue to hear about the predecessor. One of the most important values of being an American is taking responsibility. It's that simple. When I was a kid, not doing well in high school, I wanted to blame somebody else for my failures.
Me too.
Wanted to blame my mom because she was working long hours, my dad because he was not around. I had a mentor who taught me.
No, I just accepted that I sucked at because I didn't care about the subject matter that I was learning about at the time. So, no, I owned it. I straight up knew I could probably do better if I wanted to, but just didn't really care.
Actually, look in the mirror. Blame yourself. Because if you want to find the solution, you've got to find the problem. And today we're dancing around the obvious problem that we're not looking in the mirror and blaming yourselves. There are things that could have been done to eliminate the risk. But instead of that, we are playing a game of scapegoating. And I don't think that the American people buy it. And if we all wanted to know why the ratings of politicians in this country are so darn low, watch this banking hearing. It's pretty clear. I'm struck.
Okay, but what are you going to do about it, though? Like, I mean, our politicians, like, I feel like what he's saying is that our politicians have no power to make anything happen. That's what it sounds like to me, right? And he's talking about scapegoating, but it's like, well, what are you guys doing to legitimately hold these bankers and those who are providing the oversight of the banking system, the holding them accountable, right? You want to talk about scapegoating? He's not wrong. Watch this hearing because they're all doing it. Every single one of the people on this camera here are scapegoating. Do something. Stop talking about it.
By the fact that the Fed was able to issue 31 supervisory findings with the tools they already have. And yet somehow they need more. Your cover letter, Mr. Barr, says that the Silicon Valley Bank's failure highlights the importance of stress testing and other supervisory tools. Yet one of your first actions as vice chair was to pilot a climate scenario analysis exercise. Additionally, in your first speech as vice chair, you highlighted a number of priorities, which included financial risks from climate change, but crucially, did not note any of the risks that actually led to the failure of SVB. In fact, the day we learned about the failings at SVB, March 9th, you were giving a speech. The banks we regulate, in contrast, I assume to crypto, are well protected from bank runs through a robust array of supervisory requirements. In other words, we have the tools we need to do the job assigned to us. But today, we're hearing scapegoating. It's frustrating.
Tell us about it.
All the people.
No, is it?
330 million of them.
Do it. Do something
on
then.
us just to do our jobs.
What's your
when
job?
We don't do our jobs.
What?
To take responsibility for not doing them. Today, that's not the conversation we're having. But the result of us not doing our jobs and then asking for more power, more control over the economy is, according to the survey, lending standards are tightening, and that further restricts access to credit. And the way we translate that at home in North Charleston, South Carolina, is access to the American dream. It starts to wilt away. Because if the American dream is synonymous with home ownership, the American dream is synonymous with starting a business, there seems to be a leak, and we can detect where the leak is coming from. Are you concerned about the ripple effect of the potential new regulations on those at the lowest end of the credit quality spectrum, given the tightening that we're seeing in the marketplace? And more regulation means less capital, which means fewer loans, which means fewer people achieving the dream. Mr. Barr.
Thank you, Senator Scott. First of all, let me be absolutely clear. I accept full responsibility with respect to the supervisory failings at the Federal Reserve.
Then who are you firing, and whose money are you pulling back from bonuses that just got them right before everything went crap? What do you you can accept full responsibility, but you got to do something.
I've been clear about that from the start, and I remain clear about that today.
Thank you, Mr. Barr.
The buck stops here.
Thank you.
And I am committed to fixing the problems that we've had in supervision and regulation going forward.
Thank you, sir. Who did you fire?
Yeah.
We have not fired someone as a result of this review.
No
We
kidding.
plan to conduct further review of our supervisory structure, and as we do that, we'll be making sure we have the right personnel in place to get the job done.
I hope that includes making room for the right personnel by removing the wrong personnel. Thank you.
Hey, Mr. Scott, I'm just throwing this out here in case you hear this. We're looking at you next. Because if you don't follow up and make sure he doesn't do the right job, then you're the next one to get the blame pointed right at you. So you're going to be the next. Follow up, Mr. Scott, and don't sit there and let him just walk away from your Senate hearing and do whatever the F he wants to do with his oversight. You got to follow up too. Every single one of those people sitting up there, follow through.
Senator Reid of Rhode Island is recognized.
Well, thank you very much, Mr. Chairman, and thank you, panel, for your excellent testimony. I want to just take a moment to look back at, we had a hearing last week on the Safe Bank Act, and it's designed to provide access to banking for the cannabis industry. I'll be technical. But in that provision, Section 10 of the Safe Banking Act, there is language that would prohibit supervisors from requesting that a bank cut ties with customers in any industry, even if those customers present a high risk, unless there's only one exception. The bank has broken the law by maintaining the relationship. Mr. Barr, will this adversely affect regulation?
Well, thank you, Senator Reid. I think it's important that Congress is taking on this issue of the potential conflict between state and federal law. Let me say, with respect to Section 10, on the one hand, I don't think it's the federal supervisor's job to tell a bank who to lend to or who not to lend to. On the other hand, I would be concerned about any language that would limit the ability of a supervisor to take prompt action, to take aggressive action, to ask hard questions. I think one of the things we've seen with respect to the institutions we're talking about today is we need supervisors to do that, not to hold back. And so we'd be happy to work with the committee on any reforms that are needed with respect to that provision.
Thank you. Mr. Sue, your position as acting comptroller.
I agree with Vice Chair Barr. It's vitally important that supervisors have discretion to identify risks and to act on those in a timely manner, and that includes requiring remediation. And so I'm not comfortable with any limitations on supervisors' ability to enforce compliance with rules such as the BSA, AML Act, and CFTC rules.
Thank you very much. Mr. Barr, capital stress tests were put in effect by Dodd-Frank. The Federal Reserve organizes, creates the test. It proposes the test upon the banking institution. The results are made public so that everyone can know. That is not the case with liquidity testing. Is that correct?
Yes, the framework for liquidity stress testing and for interest rate stress testing are internal to the supervisory process. They're not a public exercise.
And in fact, when several times SVB was noted by the Federal Reserve privately of failing its liquidity test. Is that correct?
Yes, that's correct, sir.
And no action was taken?
Action was taken, but some of it was quite counterproductive with respect to the actions taken. So, for example, one step that the bank took with respect to liquidity risk is when it saw that it was breaching its liquidity limits, it changed the modeling assumptions to make the test less conservative.
So yeah, so it took the test, it failed the test, then it rewrote the test and passed the test, which is, good if you can do it. I presume and hope that the Federal Reserve is looking closely at adopting stronger liquidity rules, i.e. very similar to the capital rules. And
yes, Senator.
let me ask one other question. The president of SVB, Mr. Baker, was also on the board of the San Francisco Fed.
Yes, that's correct.
Did that in any way influence the treatment of this bank?
The evidentiary record that the review looked at did not find evidence of that. Of course, the structural issues are there.
Oh, no, absolutely. It's, again, you've got a bank that's changing the test because they failed, and then you've got a bank being inspected by someone who is, in a way, directly accountable to the president of that bank.
The board structure, the way it works under the Federal Reserve Act, a third of those members are selected by the local bankers and our bankers. They're forbidden from having anything to do with supervision as a matter of policy and law. And so that's the structural way that the Reserve Act intends to deal with those issues.
Yes, but rather than structural or institutional in the human dimension, if someone's sitting on your board, and even though they have no legal rights, there is a certain sensitivity, I would expect, by the inspectors.
Again, the evidentiary record we have from the review does not show that in this case.
Well, I think that's another area where you might look at. Thank you very much, Mr. Chairman.
Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and thank you all for attending today and participating. Vice Chairman Barr, the Federal Reserve issued an MRA, matter requiring attention, for SVB's interest rate risk. This was in November of 2022. The supervisory findings stated that the firm's interest rate risk simulations were unreliable and that they gave a false sense of safety in the rising rate environment and really masked the need to take actions earlier in the rate cycle. Greg Becker, who testified before us, the former SVB CEO, told this committee on Tuesday that findings in writing are done in some cases months after the initial verbal feedback is given. Vice Chair Barr, when did the Fed give the initial feedback regarding interest rate risk to SVB, and why was simply an MRA issued as opposed to an MRIA?
I believe in that case the writing was actually quite close in time to the finding of difficulty with the interest rate risk modeling. As you suggested, the basic problem was that the model was showing that the firm would be earning more money when interest rates rose, and the opposite was actually the case. In terms of the timing for remediation, I think that one of the findings of the review is that the Federal Reserve staff could have pushed harder on the firm to move faster with respect to remediation. Of course, the time frame between November and March was pretty tight, and the firm failed in March.
Was that perhaps because SVB actually had about 15% in the ratio for their Tier 1 capital on hand at that time, which is a pretty high amount of capital?
They did have a high amount of capital. It didn't really help with respect to their particular interest rate risk and liquidity risk.
It was a liquidity issue, not a capital issue.
The solvency of the firm, as I said in my testimony, was what drove the liquidity risk. That is, depositors looked at the balance sheet of the bank, and despite its regulatory capital being high, they viewed it as insolvent. And one of the reasons for the view of that is that under the capital rules that were applied to SVB did not have to pass through its unrealized losses into its capital treatment. And so its capital treatment was really a little bit higher than it ought to have been if it had passed through those unrealized losses.
And if we would have been talking and focusing on the liquidity issue, in particular because basically under the rules that they were following, the liquidity became the issue at the time. At one point, their capital was up, but they were not recognizing the losses that would have occurred if they had to convert those bonds that they were carrying.
Correct.
Yeah, okay. Also, on Tuesday when he was in here, the former SVB CEO claimed that as of early 2023, all but one supervisory finding was remediated. Is this true? And if so, was this interest rate risk one of those that was remediated?
That is not true, Senator Rounds. At the time the institution failed, they had 31 outstanding matters requiring attention or immediate attention, including those that are related to interest rate risk and liquidity risk, as well as broad issues of risk management at the bank. It was rated deficient 1, not well managed at the time it failed.
They still had 31 supervisory findings when it failed.
Correct.
Mr. Greenberg, I'm just curious. You have a clawback authority right now, and if I understand it correctly, for the most part, it has to show that there was wrongdoing or basically criminal activity involved in the clawback for executives, with one exception, and that is if the secretary, as I read it, if there is a written recommendation by the Federal Reserve and the FDIC, the Treasury Secretary, in consultation with the President, shall appoint the FDIC receiver of a covered financial company if, among other determinations, the financial company is in danger of default. The failure would have serious adverse effects on financial stability, and there is no viable private sector alternative to failure. And this was apparently met. And therefore, after such an appointment, the FDIC may recover losses from the compensation of any current or former senior executive or director who is substantially responsible for the failed condition of the institution. Recoupment is limited to a 2-year period preceding the date on which the FDIC was appointed as receiver, and the FDIC must weigh the financial and deterrent benefits of recovery against the cost of execution. Mr. Greenberg, are you recouping or clawing back the bonuses that those executive officers received in the SVB bank failure?
Thank you for the question, Senator. Under the Federal Deposit Insurance Act, we have authority in the case of a failed institution to investigate the executives and the board of the institution for any wrongdoing, and we have authority to order restitution if there was improper conduct. We also have authority to ban individuals from the business of banking.
Did you invoke this?
No.
And use the clawback provisions?
No.
I mean, we are pursuing investigations. We obviously have to determine the conduct, what conduct occurred, to determine if there was misconduct that would give us the authority to, to.
Hold on a second here, guys. I gotta look this up. I can't listen to them and not look this up. Hold on. March 10th. March. 2 months? 60 days? How long does it take to investigate something like this? 60 days isn't enough time? Just thinking. 60 days.
With the chairman's indulgence, I'd just like to finish this line of questioning if I could.
Yeah, sure.
Look, you've got executive officers in a bank who not only received bonuses for showing a better rate of return because, in part, they eliminated the hedging which was protecting those deposits. And at the same time, there was a change apparently within their guidelines during this period of time in which they actually received a higher rate of return based upon the amount of income or return. So by eliminating the expense of protecting the assets of these depositors, they bumped their bonuses. And I guess my question is real simple. Are you in the middle of an investigation, and do you plan on pursuing, if no other reason, deterrent to others who might think this is a cool way to make a lot of money, like millions of dollars? Or are we going to just simply wait back and this thing just kind of floats away?
No, the answer to your question, Senator, is yes.
Thank you, Senator Menendez from New Jersey is recognized.
Mr. Barr, your report identified major weaknesses in Silicon Valley Bank's incentive compensation program, noted that it, quote, encouraged excessive risk-taking to maximize short-term financial metrics, close quote. It goes on to say that SVB's compensation practices, quote, did not adequately reflect longer-term performance, non-financial risks, or unaddressed audit or supervisory issues. So, Mr. Gruenberg, Mr. Harper, Mr. Sue, with a simple yes or no, do you agree with Mr. Barr's analysis?
Yes.
Yes.
Yes, Senator.
Okay. As I noted in our hearing with the executives on Tuesday, the incentive structure SVB put in place rewarded breakneck growth and profitability, while kneecapping efforts to manage growing risks to the firm. Mr. Barr, in questions for the record following your confirmation hearing, I asked if you would work with the other financial regulator to develop and swiftly implement a strong incentive-based compensation rule, a rule that is required under Dodd-Frank that is more than 10 years overdue, so that we can prevent the type of situation we saw at SVB. So, Mr. Barr, if the 2016 proposed rule on Section 956 had been implemented, would that have mitigated some of the problems with SVB's incentive compensation that you noted in your report?
Yes, I think it would have assisted in that effort.
Mr. Barr, Mr. Gruenberg, Mr. Sue, and Mr. Harper, can each of your agencies have a role to play in finalizing this rule? Will you commit to acting on this rule quickly, since it's already 10 years overdue?
Yes.
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 Yes, Senator.
Well, I appreciate that, because I have a sense, having sat here through the great recession, almost the financial collapse, listening to all we were asked to do as members of the banking committee back then, that when we pass things, we seem to get a veto by omission, which means maybe the regulators don't like what we say, but it's the law. And then nothing happens. A decade.
Yeah.
At some point, gentlemen, you have responsibility.
So do you.
So I hope
you've been
we'll
sitting up on that bench.
Get to that quickly.
You've been sitting on that bench for 10 years, too.
Vice Chair Barr, your report on the supervision of SVB reveals that federal examiners gave the bank's management satisfactory ratings, quote, even after supervisors began identifying and communicating issues with governance and risk management in 2018. The Fed continued to award management satisfactory ratings, despite identifying significant concerns year after year. Why are supervisors apparently so reluctant to downgrade the bank's ratings? What changes, if any, do you plan to make to ensure banks are rated accurately when significant risks are identified?
Thank you, Senator. I do think the report identified that the supervisors were very slow to change ratings when they found problems. Part of that had to do with the standards that were set. Part of that had to do with the fact that it is, as a supervisor, hard to push back on a bank when they're earning a lot of profit and growing rapidly and the economy is doing well. So we need to have a way to make sure that our supervisors feel empowered to take action promptly. We need to give them the tools to do that, and we need to change the supervisory culture. One of the first things I did when taking this job was to go talk to supervisors around the system, telling them I wanted to make sure that they were asking the hard questions, being tough, that they were standing true, and that they were agile, looking for new risks in the system. I think we have to keep at that and change the culture.
Well, another item from the report that concerns me is that supervisors, quote, saw financial performance and the lack of realized risk outcomes during this period as offsets to underlying concerns related to governance and risk management. Now, to me, this shows that the Fed examiners fundamentally misunderstood their role in enforcing a safe and sound banking system. Your job is to identify risks proactively and ensure that they are fixed before they impact performance. Since we've seen time and time again that the banks themselves do a poor job of it. Can you commit to us, Mr. Barr, that you will sharpen the focus of your supervisory efforts on proactively identifying and ensuring banks fix vulnerabilities? I mean, from my mind, the purpose of regulators is to act as the cop on the beat, not to give everybody a pass.
Yes, I fully commit to that. I think we need to make our supervisory system much more agile, much faster, and much more forceful, and we will be doing that.
And I hope the other regulators do so as well. Thank you, Mr. Chairman.
Thank you. Senator Vance of Ohio is recognized.
Great, thank you, Mr. Chairman, and thanks to the panel for tolerating this.
What? You can wear T-shirts? This dude straight up looks like he just woke up, rolled out of bed, and decided he was gonna go sit in. Look at this. This is crazy. I didn't know you could wear T-shirts in there. I didn't think they'd let you in. Oh, we need more of this. We need more people like this guy in here. We need more people like this guy in here sitting in on this stuff. Let's get some real Americans in here, real people sitting on these, listening in. I love it. It's awesome.
Arctic condition they've put this hearing room in. It's really cold in here. But I want to ask, direct my question to Mr. Barr. And, one of my concerns here is that we have a San Francisco Fed that clearly was asleep at the wheel. I think a basic examiner's review would have said that Silicon Valley Bank had some serious problems. And the fact that we didn't identify it until the bank effectively blew up is a serious problem. So one of the things we've seen is the San Francisco Fed is clearly focused on diversity, equity, and inclusion initiatives and also climate risk. And I, as a person who recognizes that if you're focused on one thing, you're fundamentally not as focused on other things, I want to sort of target this particular thing. So instead of focusing on the safety and soundness of our banking system, the San Francisco Fed was busy publishing economic letters and research on a number of social justice causes. Some of the selected titles include Disappointing Facts About the Black-White Wage Gap, How Are Racial and Gender Gaps Limiting the Full Potential of Your State's Economy, hosting seminars and publishing primers on racial equity, making a commitment that their equity goals would help to drive their approach to hiring, and that's not to mention their involvement in the Fed's Racism in the Economy series. Now, that's just after a quick scan of the San Francisco Fed's website. I worry that when you have the San Francisco Fed sounding a little...
Sorry, I can't help myself. This dude in the background sitting behind him, the senator, looks like he is growing like the biggest shit grin you've ever seen in your whole life. Starting with when he started to take a sip of it, and this grin just keeps getting bigger and bigger. I can't. And he's like trying so hard not to look at the camera. Like, I feel like I'm looking right at you, buddy. I see you. I see you in your shitty ass grin. I love it. Some of the people in the background crack me up.
A little bit more like an Ivy League political science or economics department, that you miss some things. And Mr. Barr, could you explain how this research and these activities support the Fed's monetary dual mandate or supervisory charge to ensure safety and soundness in the banking sector? How does this actually help?
Senator, let me start by just talking about the particular case of SVB. The review did not find any evidence that the supervisors were distracted by other activities. They were focused on the right set of risks in the bank with respect to liquidity, risk management, and interest rate risk. But the findings were that they didn't act forcefully enough to get the bank to move quickly enough to change those factors. So that's the basic backdrop. With respect to your question, the Federal Reserve banks do have a wide range of freedom being able to conduct research that they think is important to understanding economic drivers in our economy. And some of those economic drivers include the issues that you discussed.
So Here, I guess is the question is it your view, Mr. Barr, that if the Fed is doing these seminars on climate risk, on diversity, equity, inclusion, and so forth, instead of seminars on risk management, because again, there's only so much time in the day, do you just think that it doesn't have any effect on their focus and on the things that they're thinking about when they're doing their basic job?
The evidence in the review is that the supervisors were focused on the right set of risks. They were focused on basic, risk management at the firm in terms of interest rate risk, liquidity risk. They found that the bank was not well managed with respect to its activities. They were graded a deficient 1. So the issue, at least with respect to SVB that we saw, was that it was about the forcefulness of action that the supervisors didn't take in time to change the nature of the firm.
I appreciate that, Mr. Barr. I understand that the review didn't find that this was distracting enough.
Like half the time, I feel like he's thinking in his head, "Don't look at the camera. Don't look at the camera. Don't look at the camera." And then you see his eyes, like slowly, like point towards the camera, and then he makes eye contact, and it's awkward. He's like, "Oh, look away."
But I just wonder, separate what the review found and think about the way that human minds work, where if we're focused on one thing, we're fundamentally not focused on something else. There's only so much cognitive bandwidth the average human being has. I really worry that the more that the regulators are focused on things that have nothing to do with systemic or individual financial risk, the less and less safe our financial system is going to be. And I understand that the point that you're making, the review found that the focus was not a problem here, but this is all overdetermined. It's incredibly difficult to say with any conclusive evidence, either in my direction or in your direction, that the focus on these non-risky financial issues caused a problem. But are you worried that we reach a sort of tipping point where the focus on building progressive politics into our risk assessment starts to actually harm our ability to really analyze whether these banks are a problem?
I don't think politics should play any role in risk assessment. And as I said, in this case, we don't see evidence of that in the record.
Well, I agree with that point. The politics shouldn't play any role here. And Mr. Chairman, I'll yield my time, but just to say that, I'll say this a third time, actually. We can only do so much in a given day, and the more that we distract ourselves from focusing on financial risk and instead focus on climate risk and other things, I worry it's going to cause our financial system to be much less safe. Thank you, Mr. Barr.
Senator Tester of Montana is recognized.
He gave us the hard, quick stare at the very end, like, "This is my last chance. I got one last chance. The camera's gonna go off. You won't be able to see me. I got you." I wanna give that guy a hug so bad. I wanna be like, "Dude, you made my day, man." I just gotta tell you, I'm gonna find out who that guy is, and I'm gonna be like, "Dude, you just made my." I'm gonna send him an email. I'm figuring who is. I gotta go. Hold on, I'm going back just a second here. I don't know what senator this is. Oh, I done screwed up.
I'll say this a third time, actually. We can only do so much in a given day, and the more that we distract ourselves from focusing on financial risk, and
it's funny because it looks like it says Mrs. Britt, but it's actually, I think he's Mr. Vance. I'm gonna look him up here. This kid's probably more a it's probably a intern. Is it JD Vance? Yeah, that's who it is. Let's see here. All right, I'll keep playing it. I'll look this up on my own time.
Instead, focus on climate risk and other things. I worry it's going to cause our financial system to be much less safe. Thank you, Mr. Barr.
Senator Tester of Montana is recognized.
Thank you, Chairman Brown and Ranking Member Scott. Thank you for being here. My guess is last night probably the only two people that slept well were Harper, but thank you all for being here. This morning, the good senator from North Carolina, Senator Tillis, and I are calling for an independent, comprehensive investigation into the recent bank failures. The stress these recent failures put on our financial system is having negative effects on community financial institutions, small business, hardworking families. And I believe we must get to the bottom of the recent failures to ensure our financial system isn't left on the hook for risky behavior by reckless executives and lackluster agency oversight. This is a question for all of you, and you can nod or raise your hand. Would all of you support an independent review?
Yes, Senator.
We've been clear that we welcome additional reviews of all kinds.
All right, good. Let the record reflect. It's unanimous. Mr. Barr, I want to read you some your testimony, and then I want to ask you what this means. It's on the third page in my copy anyway. Finally, the fourth key takeaway is the Federal Reserve Board tailoring approach in response to the Economic Growth, Regulatory Relief, and Consumer Protection Act, and a shift in stance of supervisory policy impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. Absent these changes, SVB would have been subject to supervision within the LFBO portfolio and subject to heightened standards beginning in 2019 throughout the bank's period of rapid growth. Is it fair to say that every bank would have been subject to those same standards, not just SVB, but everybody?
Sir, referring to the approach based on the size of the asset class of institution. So other banks that were of a higher asset size would also have been subject to that rule, but not every bank.
No, but everybody in that asset size. So let me ask you this. Fundamentally, do you believe that the regulation should fit the risk?
Yes, I do, sir.
Okay. So if you looked at 2155, which is the other name for the longer title I just read, isn't it pretty clear the tailoring is allowed, even to the smallest community bank? If they had a risky portfolio, you could drop the hammer on them, as the chairman said, correct?
We have ample discretion under S2155 to take a risk-based approach to supervision.
Thank you for that. So the question becomes, Vice Chair Barr, are you going to propose new regulations in response to these failures?
I expect both in response to these failures and our broader review to look at changes in both supervision and regulation going forward.
So, but isn't your report relatively clear that it is not a regulatory failure? That if the tailoring would have been applied correctly, as 2155 talks about, as I believe Congress intended, that this problem could have been stopped?
The report found that both supervision and regulation played a role in contributing to a reduced resiliency at the bank, and we'll be looking at both.
Yeah, but the point is here, and I don't mean to bat you around on this, it's just a matter of fact. I think regulation needs to fit the risk. I think when 2155 was put up, it was put up with the idea that if you had a risky portfolio, regardless of size, that the Fed and the other agencies had the ability to tailor those to whatever threat that those risky business dealings done, right?
Senator, I agree. We're not seeking any change in law from this committee.
Okay.
We believe we have ample authority under existing law to provide a better approach to supervision and regulation going forward, and I am committed to doing that.
So one of my main concerns, and it was one of the things we talked about several years ago, is that I come from a rural state. You know this. I mean, I don't need to tell you guys what's going on here. You guys deal with rural areas, state, we don't have. I mean, there ain't a lot of banks every other block. It ain't walking down the street in LA or New York City. Okay. And my concern is that these community banks that don't have a risky portfolio will end up paying the price for a CEO, by the way, that told this committee a couple days ago that they took care of all the problems, and you just pointed out that they have 31 of them that they didn't. So how do you protect the folks who are doing an honest job, providing capital, supporting agriculture, supporting Main Street businesses, supporting working families? How do you protect those? Because in 2008, I stood up here along with Brown and others, and we railed on regulators. We railed and railed and railed because they didn't do their job. And you know what they ended up doing? They ended up regulating the hell out of the banking industry to the point where we made the bigger banks bigger. Talk to me.
I agree with you, Senator. It's absolutely vital that we have a strong and vibrant community banking and regional banking sector as we do today. Community banks around the country and in states all over the country are serving their communities well. And we're highly attentive to that when we think about new approaches here. The kinds of rules that I'm talking about are for large banks, not community banks.
Okay, I just want to make sure that doesn't bleed down, okay? Marty, just one last thing with the chairman's indulgence. Senator Rounds brought up some very good points on a president of a bank who may not have acted appropriately and tried to pad his own pocket. I'm not making that accusation, but as you do your research, I hope you hold them accountable. It sets a very bad form if you don't.
Understand, Senator.
Senator Kramer's recognized.
Thank you, Mr. Chairman.
He's like, I got them after the end of his little speech there. All right, guys, let's take a look at numbers and see what we got going on here. I like that look on his face. I told them. All right, well, we'll see what they do in the next decade. Oh boy. Starting with off exchange. By this time of the day, I would expect to see about 64% going through off exchange and EDGX combined. On AMC, we have 44.39% going through off exchange, 11.49 through EDGX. That is approximately 8.12% less than what it should be at 55.88%. CHX volume for the day today is at 7.64% of our total daily volume with a 30-day average of 3.34, more than twice the amount. And the quantity is 541,000 shares, which is quite significant. It's a very large number. Off exchange for APE is at 51.19. EDGX is at 5.67. The combined total is 56.86. That is, what did I say? 54, right? Yeah, 54. That is 2.86. Whoa, wait. That's 12.86% less than it should be by this time of the day. CHX volume is 0.22 with a 30-day average of 0.1, which is definitely elevated, but it's not very many shares. It's only 7,500 shares. It's just because we have low volume. GME's CHX volume is 0.2 with a 30-day average of 0.21, so it's kind of averaging about where it usually does. Let's see here. Ortex in the last hour had a bunch of shares returned, putting us at 197,000 shares having been borrowed. It's now a return of 650,000 shares. That's going to drop the short share interest of the free float to 24.91%. Cost borrow mins at 8.21, average is 59.2, and max is at 356.8. Shares on loan did dip from 210,000 shares, or 210,000 shares were returned. 52,000 of it Ortex estimated to be in closed short interest day over day, putting us at 168.59 million shares on loan. Taking a look at APE, an hour ago there was 26. All day long, there's only been 26,000 shares having been returned. No borrows, keeping the cost to borrow out of the reporting out of the loop. Short share interest of the free float at 5.56. 3.7 million shares returned yesterday of APE, putting us at a total of 19.37 million shares in total on loan. Options. Highest amount of call volume at a $5 strike an hour ago was 8.3 thousand contracts. It's now 11.5. On puts, highest amount of volume is at a $5 strike as well. It went from 16.4 thousand contracts to 19.5. Market still suggesting a closing price somewhere around $5 by the end of the day today on AMC and APE, or AMC, I mean, rather. Combined price of AMC and APE is $6.62. We are breaking out of the wedge here, but not upwards. With this current consolidation, we're not seeing, we need the volume, which may come in at the end of the day, and we might see a little bit of a break upwards towards the end of the day, since we are kind of moving out of this 14-day wedge that we're in, descending wedge. Orders by Fidelity customers, AMC, APE, and GME are the only three that I'm looking for, but due to low volume, none of which are on the list of most heavily traded stocks. SSR is trips at 456 for AMC, APE at 1.467. Shares available to borrow has looks like they did borrow some more. 300,000 shares borrowed more. So 1.45 million shares borrowed so far for the day-to-day, according to Stonko Tracker. Fees at 65.2%. Nasdaq is down 0.31. Dow Jones is down 0.33. S&P 500 is down 0.21. We have 3,544 decliners to 2,714 advancers. That's about where it was, I think, an hour ago. Banks, the big movers. We've got Silvergate down 4.35. PacWest is down 2.78. Western Alliance is down 2.94. Coinbase is down 5.16. Ethereum Classic is up 0.27. DXY, or the US dollar, is up 0.44, or down 0.44 rather, sorry. WTI is up 0.85. Mortgage-backed securities are down anywhere from 0.17 to 0.22. SPY is down 0.22. It's about where it was an hour ago. VIX is getting a good little bump up here, 7.91% up for the day today. Vanguard is down 0.1 or 1% rather. VB is down 0.85. Tesla's down up 1.83. Amazon is down 1.74. Cinemark is down 2%. Doge is up 0.31. Bitcoin is up 0.36 at 26.9K a coin. GME is down 4.47. HYMC is down 2.49. NCMI is up 3.72. Hood is down 1.1. Ape is down 1.84. And AMC is down 1.08. Inflow versus outflow for the day today. We have approximately 170,000 shares more, or dollars more inflow. 6.96 million shares traded so far after 296 minutes worth of trading, putting us on a pace for 9.17 million shares traded by the end of the day today. On AMC, that is definitely within 5 to 25 million range. So I suggested in the pre-market. On a 4-hour time interval, more buying pressure than selling pressure with an RSI of 37.2, which is below average. On a 1-hour time interval, more buying pressure than selling pressure with an RSI of 41.57, which is below average. On a 30-minute interval, more selling pressure than buying pressure. Currently with RSI at 41.35, which is below average. On a 5-minute interval, there's more buying pressure than selling pressure with an RSI of 52.9 or 69, which is average on Ape. There's approximately $50,000 more. No, $5,000. Holy crap, it's low. $5,000 more output than there is input. Really close numbers. And let's see here. 3.57 million shares traded so far after 298 minutes worth of trading, puts us on a pace for 4.62 million or 4.67 million shares by the end of the day today. That is definitely within the 1 to 20 million. It is so low volume. 4-hour chart, we've got equal amounts of buying and selling pressure with an RSI of 50.78. On 1-hour chart, we've got more buying pressure than selling pressure with an RSI of 49.44, which is average. On a 30-minute interval, we have equal amounts of buying and selling pressure with an RSI of 50.09, which is average. And on a 5-minute interval, more selling pressure than buying pressure with an RSI of 54.2, which is slightly above average. Good times. I feel like we need some music. I'm about ready to pass out. I'm just having a ball over here. Man, you guys have got to be probably pretty tired too, you know, I can imagine. I got a break here. I'm going to take a break. Put some more of the Senate hearing on for you guys, and I'll come back. We'll do toast, read the numbers. Jack says I'm ready to Z. Yeah, me too, man. I mean, this is boring as hell to watch. VIX is still launching up here. Let's take a look at VIX real quick. It's all over the place. Don't worry, Shad, just 10 more years to go. I'm ready. Almost as boring as watching golf. Almost. All right, I'll see you guys back here at 2:10. Or, yeah, 2:10.
Thank you, Mr. Chairman. Thank you to all of the witnesses. Frankly, I love the temperature in here. I don't think there's any question that while we aren't all exactly in the same place, we do share two concerns. One, that supervisors didn't do enough, and two, managers did the wrong thing. So I was a soccer referee before I took up this other crazy job. And when I would do particularly collegiate men, if I didn't pull out my yellow card at the first reckless act, that was like a license for them to go crazy. But when I did put up my yellow card with the first reckless act, everybody on the pitch knew that if somebody else did it, or if they did it again, it could be a red card. If I warned them gently, they often just kept playing rough. More rules and regulations without appropriate regulating will get us nowhere. But we could beat this to death, I suppose. But I do have something that we haven't talked about that I want to ask about. What role, or maybe a better way to put it would be, what if there hadn't been a run on SVB? What if everything was the same? We know they did some things, made some sales that raised some concerns legitimately. But what if there hadn't been a social media sort of pitch that caused this run? Would we even be here today? Is it possible that nothing would have ever happened, and had there not been this sort of panic, fear? Fear is a real deal. And maybe start with you, Mr. Barr, on that. Am I crazy to think that maybe this wouldn't have even happened?
Senator, it's obviously difficult to know in any circumstance what shock is going to come to the financial system. What we focus on as supervisors when we're doing our jobs right are the vulnerabilities that a firm faces, and making sure that the firm is addressing those vulnerabilities and making sure we have resilience in the system with good rules on capital and liquidity, so that if there's a shock that nobody anticipates, they're not hit in a way that causes contagion in the financial system. So I take your point very much.
I agree with all of that. I just worry that in today's social media world that fear and panic gets accelerated, gets elevated, and highlighted. And I don't know what we're going to do about it, but interested in your view on it. One other thing I want to ask Mr. Grunberg and Mr. Sue, maybe could comment on this. There's been a lot of talk about the sale of the assets, the sale of First Republic to J.P. Morgan. Speaking of big getting bigger, the irony is rich. The lack of transparency in that, could each of you sort of tell me, I know the bid price is the big thing, right? That's the easy go-to in an auction. But is there more to it? Should we have considered other factors in approving that sale when there were other bidders? Start with you, Mr. Grunberg, and then Mr. Sue. I know you both play a role in that.
Thank you, Senator. The statute under which the FDIC works in these matters is clear, and it really gives us one factor to consider, which is least cost. And that was the only factor we were allowed to consider under the law in reviewing the bids that we received for First Republic.
So does the OCC have additional leeway with regard to the soundness of the system that could be considered?
So the factors that we're subject to are laid out by the Bank Merger Act. And those statutory factors relate to competition, convenience and needs of the community, financial stability, BSA AML, managerial financial resources, et cetera. We also have guidelines that we've released that articulate the frameworks for reviewing those. In a failing bank case, especially where there's a larger institution, we also have to take into account the financial stability factor becomes quite important. And it's very important for us to ensure that the actions we take ensure coordinated and timely government action, support minimal cost to the diff, and really check the risk of contagion and uncertainty. Those are very important.
Timeliness in a crisis is critical, and I understand that as well. hope the right incentives are in place. Since I have a few seconds, I just want to wrap up with what Senator Vance was talking about, Mr. Barr. You kept saying that the report finds that the supervisors were focused on the right things, but not forceful enough, sort of in regarding their findings. Or focus and forcefulness sort of go together in my mind. If you're focused, that implies exactly that, focus, but it also would imply that you'd have a forceful response. I think there is a distraction. I think it's impossible to say in the course of an 8 or 9 or 10-hour day, 40, 50-hour week, with limited resources, that you can just do all things intellectually, socially, culturally. It'd be better if regulators focused on the thing that they're supposed to focus on. All three of you have articulated your parameters very, very well. Let's stay within the parameters and focus there. Thank you, Mr. Chairman.
Senator Warner from Virginia is recognized.
Well, thank you, Mr. Chairman. I had a really good question that I was actually going to say something nice about my friend Senator Kennedy, but and maybe I'll get to it. But I want to pick up where Senator Kramer started, which was, no, don't worry, I may still talk about you later. If the Chairman gives me a little discretion. But I think what you mentioned, we can talk about how we got here and what standard was appropriate, what the regulators did right or wrong. And I was going to compliment Senator Kennedy on how he described the quality of the management at these institutions. But in the case of SVB, $42 billion in 6 hours on that run, I don't know what regulatory structure. At that point, at least on calculations I saw, that was the equivalent of 25 cents in every dollar. Nothing would have stopped that. And I don't think we've really, and frankly, Vice Chair Barr, I give you a lot of credit for your report. You had a short period of time. I think you did a good piece of work. I've got a couple of follow-up questions. But this run, and I'm going to ask to start with Michael and Marty, but I welcome everyone. But I ask this most focused to my Republican colleagues. There were laws back in the 30s that if you accelerated a bank run, there was a penalty paid. Candidly, I think some of the folks from my old industry, the old venture industry, very irresponsibly, the Wednesday night before the run, exacerbated that. And they were as familiar with the institution as any entities around there. And I still would like to know where some of that money ended up going. But we've not really talked about that. We've not really talked as well. And this is where I may get the nods to go and no. I know you guys feel that the SEC leadership has got too many items on our docket at this point. But one that's not gotten a lot of attention is a fulsome look at short selling. I think back in the 2008 crisis, then SEC Chair, Republican former House Member Cox, put a hold for a couple of weeks on short selling. Later analysis showed it didn't really work that much. But maybe a fulsome look to your analogy about if your short sellers inappropriately not disclosed, that's going to not get you a yellow card. It may get you a red card. Might be something that we could collaborate on. I want to start with Mr. Greenberg. This internet-driven run, exacerbated by folks who are very familiar with the institution, shout and fire in a crowded theater on that Wednesday night into Thursday morning. Tools we've got, suggestions.
It is an area that I think is worth exploring. The speed of that run, the ferocity of that run was something that I don't think anybody had ever seen. As you pointed out, $42 billion in a few hours, another $100 billion lined up the next day. So in less than 24 hours, losing basically 85% of the deposit base is unprecedented. I do think that, it's worth looking at that in relation to our banking tools, that the issues that you raise with respect to other actors is really an SEC matter.
Senator, I think we learned some hard lessons about liquidity risk in this episode, and there are probably three things I'd point to. One, not only the reliance of the institution on uninsured deposits, but those uninsured deposits were concentrated in particular among a relatively small number of depositors. So the ability for those deposits to go fast, I think was really underappreciated. Second, obviously online banking facilitates that kind of liquidity risk significantly. And the factor, as he suggested, of social media can broadcast that out much more quickly than in the past. And this is a set of realities that we're really going to have to come to grips with going forward. We issued a report on deposit insurance, and we talked about those things as matters we're going to need to work on going forward.
Anybody else on the panel want to weigh in on this?
Senator, I think you've highlighted an important issue that we need to focus on. The good news is we have in the past, liquidity risks do change over time, and we do need to be responsive to those changes. There have been examples in the past in wholesale funding markets where we have made adjustments to catch up and make sure that we can address those in a safe and sound manner.
Yeah, I just, candidly, I appreciate what everybody said, but we've all said this, but I haven't heard of that many worthwhile policy recommendations. You know, I don't think we're going to put in place the kind of speed bumps on taking money out that we've got in the stock market. I do think if we put a little bit more to Senator Kramer's position about a yellow or red card on short selling inappropriately, that might put some hesitancy there. But I do think we have to look at, is there any responsibility, particularly for somebody who's been a long-term position of capital in these institutions, that does this, and SVB's model was so focused on VC, they pulled the ripcord, but I would ask you all to think about this. My time has expired. I just want to make one last quick comment, Mr. Chairman. If I'd had another question, I would have asked Vice Chairman Barr, you put a lot of recommendations saying it's going to take you a couple years for the regulators. I don't think we can wait that long. I think particularly when so many of us at least think this was we all said banking 101 mismatch, making sure that information gets higher prioritized and to the management, to the board. I think there's work we need to do there, and I look forward to working with you on it. Thank you, Mr. Chairman.
What about the Kennedy compliment?
The Kennedy compliment was going to be, I was going to talk about how the executive said they'd done everything, they loved their institutions, they were so smart, and you and that kind of...
Senator's time's expired, Senator.
Why way always said to them, you called them out for being just
Senator Britt of Alabama.
over the top.
You're a fine American, Senator.
This is 1 minute off your time, Senator Kennedy. Senator Britt, Alabama.
Thank you, Mr. Chairman. I appreciate all of you being here today. On Tuesday, we heard from the top executives of SVB and Signature Bank, and unfortunately, it was disheartening to hear the lack of responsibility taken from these individuals regarding the decisions they made that put their financial institutions, their depositors, their broader banking sector across the nation in a position of unfathomable risk. I have significant concerns around their actions, but today we are here to talk about yours. I was disappointed when I read the report, Mr. Barr, the Barr report that you put out, because in my opinion, in reading that, you didn't take adequate responsibility for what I believe is under your purview. I read and saw where there was blame placed on the San Francisco Fed, where there was blame placed on your examiners, blame on your predecessors, blame on 2155, but I didn't hear the blame being put on yourself. That's the one entity or person that I didn't see in the report. I will say I really appreciate your candor today and saying that the buck stops with you. I believe that you have to take some personal responsibility for what you've done, and I appreciate you doing that today. I will say, Mr. Barr, on the day that SVB failed, how long had you been in your current role?
I joined in middle of July of 2022.
Okay, so about 10 months? Maybe?
I haven't done the math. It
Okay.
sounds like 7 months.
Okay, 7 months, 10 months to today. That makes sense. So in that short time, the ranking member mentioned this. Obviously, Mr. Vance, Senator Vance mentioned this as well, but you spent considerable time, speeches and other things, talking about climate issues and a number of those remarks. And what I fear is that we're seeing a shift of priority, a shift where someone like you who, as I looked on your website, it says that your job is to promote the safety and soundness of the banking system, to foster stability in the financial markets, and ensure individual banks are complying with laws and regulation under its jurisdiction. The focus is not there. The focus needs to be on the 31 outstanding the outstanding supervisory findings, and making sure that we have proper answers on those, not on climate risk or changes, but on what your actual job is. And so on that note, well, you mentioned earlier that the day that SVB failed, there were 31 supervisory findings that were outstanding. Is that correct?
Yes.
And so of those, my question is why your people didn't do more. It is my understanding they could have downgraded their supervisory ratings, which obviously would have resulted in more frequent supervision and exams, or they could have taken enforcement actions like prohibiting dividends to shareholders, requiring immediate capital increases, fines, other things like that, but they did neither. Is that correct?
The supervisors had downgraded the firm in the summer with respect to broad-based problems in governance and controls, risk management functions, to deficient 1, which means the firm is not well managed. And as a result of that, the firm was subject to a 4M limitation, which meant that it could no longer merge with or acquire non-banking entities. And the staff were also in the process of developing a detailed memorandum of understanding, which is the first level enforcement action after a deficient downgrade occurs. So the steps were in train. What the report found is that our supervisors were not moving fast enough with respect to those actions.
So they had the tools in their toolbox, but they weren't using them with the force that they could have.
Yes, I think it's fair to say that the tools were there.
The tools were there. They just they didn't use them with the force. I'm hoping moving forward, I don't think we need new tools. I just think to your earlier point about creating a culture where those tools are used, you can do that internally. That's a leadership issue. That's not something that we don't need more rules or regulations to do that. And I am almost out of time. Mr. Grutenberg, my question is for you. Do you agree that if Silicon Valley Bank was sold while it was still an open bank, it would have been better for the economy, the consumers, and other banks who have now had to foot the bill to replenish the diff?
Yes, Senator.
Okay, so did you have any interested parties with interest to purchase SVB the night before SVB failed?
I'm not aware of any, Senator. We weren't the primary regulator, so we wouldn't have been the ones necessarily contacted in regard to that.
Okay, but if there were interested parties and we find that there were, that certainly should have been done the night before versus afterwards, it would have saved us all $35 billion at this point.
If there were opportunities for an open institution solution, that would have been preferable.
Well, if we find that, I certainly hope that in the future we make those types of choices instead of ones that ultimately cause institutions all over the country to have to pay. Thank you.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So earlier this month, when First Republic Bank collapsed, multiple banks were interested in buying the failed bank. Banking regulators chose J.P. Morgan Chase, America's biggest bank. The result was that a gigantic, poorly supervised bank was swallowed up by an even more gigantic bank, and now the biggest bank in the country is about $200 billion bigger than it was before. So in order for the deal to go through, two separate regulators had to sign off. When the FDIC sells a failed bank, the law requires it to choose the highest bidder that will result in the lowest cost to the deposit insurance fund. But the law also requires sign-off from the OCC. And the OCC's job, by law, is to consider whether the merger would pose, quote, risk to the stability of the United States banking or financial system, end quote. Acting Controller Sue, OCC regulations include a list of factors that the OCC must consider when evaluating, quote, risk to the stability of the banking system. Do you know the first item on that list?
It relates to the financial stability, whether there's a threat to financial stability in the U.S.
Whether or not, and what is the item you're supposed to consider? The very first one on the list.
I believe it is whether the merger will have financial stability impacts.
Because of?
Because of the merger.
No, it's whether the proposed transaction would result in a material increase in risks to the financial stability due to an increase in the size of the combining institutions. It troubles me that you don't remember this. So how do we know if a purchasing bank poses more or less risk to the banking system? Well, one metric that regulators use is the GSIB score, which estimates the impact on our financial system of the failure of each of our largest banks. The size of the bank is a big factor in its GSIB score. So let's look at the GSIB scores and figure out if JP Morgan, according to the OCC's own analysis, presented more risk to the banking system than the other bidders that have been widely reported in the press. So PNC tried to buy the failing bank, but you approved JP Morgan instead. Acting Controller Sue, is the GSIB score for JP Morgan bigger than the equivalent score for PNC?
It is.
How much bigger?
I don't know the exact magnitude of it off the top of my head.
Do you want to make a guess?
It's bigger.
8 times bigger, does that sound right? Yeah. Let's take a look at another bidder, Citizens Bank. Is JP Morgan's GSIB score, that is the score that shows risk to the banking system, bigger than the score for Citizens Bank?
It is.
How much bigger?
Significantly bigger.
14 times bigger?
Perhaps. I don't know the exact scores in front of me.
Controller Sue, your job by law is to determine risk to the system from making big banks even bigger. And you have a clear metric for doing that, the GSIB scores. So how do you explain approving a sale to a banking giant that increases the risk to the banking system by somewhere between nearly 800% and 1,400% more than selling to other bidders? Did you just ignore the fact that a failure at JP Morgan would blow a hole in our banking system that would be 8 times more than the destruction to the financial system and let them grow by $200 billion?
Senator Warren, for every merger application, we follow the law, we follow our guidelines, we follow our policies and procedures. Under the financial stability prong of the Bank Merger Act, there are a number of factors. You named one. Had we followed a strict GSIB score methodology to the exclusion of everything else, I fear that there would have been greater financial instability that weekend. When we make these decisions, I have to take into account a range of factors, including.
So if I can, I know I'm nearly out of time, but if the chairman will let me pursue for just a minute here. Are you telling me that there are other factors that weighed against the other bidders that weren't there for JP Morgan Chase, and that's how it is that you went with the biggest bidder, even though the biggest bidder, by your own GSIB scores, increases risk to the financial system?
What I'm saying is that a GSIB score approach to that factor that weekend would not have been a wise one.
Because that's why we're here to exercise oversight. You can't just say, I decided on something else without putting some facts behind that.
The GSIB score framework is not part of the framework that is listed there. There's a number of factors there. We're taking into what's very important, especially when there's a failing bank situation, is that the government act in a coordinated and timely manner, that we minimize losses to the diff.
You had one job to do, and I appreciate. I'm out of time here, and I appreciate your forbearance here, Mr. Chairman. But I do want to say the single biggest threat to the U.S. banking system is concentration. We're all pushing harder for merger guidelines so that we don't get more concentration in the banking system. You are the one person who was supposed to use judgment on the question of, as between multiple sales, which one was the right one to go with and which one presented more risk to the banking system. According to your own metric, you chose the one that gives us more concentration in the system. I am very troubled by that decision.
Senator Tillis from North Carolina is recognized.
Thank you, Mr. Chairman. I wanted to start. I know Senator Senator Tester and I sent a letter today talking about an external review. I believe that for the most part, did he ask you the question about whether or not you think an external review would be helpful?
Yes,
You
sir.
answered in the affirmative. Great. Then I look forward to us being able to move forward with that. Also, Senator Warner spoke about the fact that really no bank, even a bank that's well managed, well capitalized, could actually withstand the pressure that SVB went over in terms of deposit flight. I think what we've seen here now is maybe the narrative. There was a couple of months ago, it was all about bad management. It was all about bad supervision. Now I think what we're seeing is maybe there was a little bit of that, plus the external factors. And I hope that as we get a report, we can understand it's not as simple as some people have made it to be. And I'm looking forward to see to what extent, if any, some have said that S2155 was the root cause of the failure. I think an external review is probably going to debunk that myth that's been shared by some of my members here. But Mr. Barr, I wanted to talk with you. When we had Mr. Becker here before the committee, he mentioned that he had 31 open MRAs or MRIAs. Seems like a large number. So how is Congress supposed to view the effectiveness of Fed supervision when the Fed allows a firm to rack up those number of MRAs and MRIAs, particularly a bank whose activities and portfolio is very different from the vast majority of banks?
Senator Tillis, the MRAs and MRAs are a sign that the supervisors are attempting to hold the bank accountable. What happened in this case is it failed before it finished addressing those concerns. That kind of level of MRA and MRA is 3 times the peer average for that kind of institution. So it showed the institution had serious problems. The supervisors had downgraded their risk management to deficient, which meant the firm was not well managed. They had entered into a 4M obligation, which meant that were restrictions on their non-bank activities. And the supervisors were in the process of putting in place the first level enforcement action, a memorandum of understanding, when the bank failed.
I don't want you to respond, but I do want to we'll submit a question for the record, because I'm trying to get some sense of, it seems like some of these were issued a year earlier. If I recall, it was sometime in 2022. Is there any sort of aging or follow-up on how, particularly for matters requiring immediate attention? And how well did SVB do compared to their peers on clearing and addressing these MRAs?
They were slower than they should have been at addressing them. They were not consistent with what we see from most banks. Most banks, most of the time, respond quickly, and they're able to fix their problems quickly. And in the case of SVB, they did not fix their problems quickly, and there were serious risks in the institution with respect to interest rate risk, liquidity risk, and basic blocking and tackling of risk management.
I've spoken with a number of banks over the past couple of weeks, and I also, it seems like after SVB's failure, there has been an expansion, or I should say a dramatic increase across the industry in terms of MRAs and MRI. I don't know about MRIAs, but I do know that the typical flow of MRAs seems to have gone up industry-wide. Am I right in that trend, or have you had an opportunity to take a look at that?
Senator Tillis, it is a terrific question. I have not looked at that, but I will examine it after the hearing.
I was in a meeting with probably 20, 25 banks represented, asked for a show of hands. How many of you have seen a significant influx since the SVB failure? Every hand was raised. So I think it would be something helpful for us to see. There could be various reasons for doing that. You learn from the problems at SVB, but it seems odd that given the unique nature of SVB, that suddenly we would see this trend across the industry for a very wide variety of institutions. So reporting back to that would be helpful. We will submit some questions for the record. Thank you all for being here.
Senator Cortez Masto is recognized.
Thank you, Mr. Chairman, and thank you all for being here.
Mr. Barr, let me start with you. As you've heard, we had the executives before us just a couple of days ago, and not one of them took responsibility for their actions or lack thereof of bad management, and we're basically throwing others under the bus. And just yesterday, Greg Becker, the CEO of the failed Silicon Valley Bank, testified that no Federal Reserve supervisor raised interest rate risk with him prior to the failure of SVB. What I'm hearing from you is that is not correct.
Senator, that's simply not true. I'll just give you, one example. I'll just read from this letter that the supervisor sent to Silicon Valley Bank dated November 15th. It's addressed to Mr. Greg Becker, the CEO of SVB. It begins, "Dear Mr. Becker." The first line of the executive summary says, "The firm's interest rate risk simulations are not reliable." It goes on to say, "Changes in net interest margin, net interest income, and earnings are directionally inconsistent with internal projections. Unreliable IRR modeling directly impairs management and the board's ability to make sound asset liability management decisions. It includes a matter requiring attention." And the letter says quite clearly what is the impact of this. Unreliable RR modeling outputs impair management and the board's ability to make important asset liability management decisions. In the firm's case, simulation results gave a false sense of safety in a rising rate environment and masked the need to take actions earlier in the rate cycle. This letter was sent to Mr. Becker on November 15th. It memorializes a conversation with Mr. Becker and other senior executives on November 14th.
Thank you. And I have a copy of that letter. And Mr. Chairman, I'd ask to submit this for the record.
Without objection, Sword.
Can I ask you, Mr. Barr, based on that analysis, was that a cause for some individuals to do a run on the bank?
The cause ultimately of why individuals chose to run on the bank seems to be related directly to its solvency. And the solvency problem was because of poor interest rate risk management outlined in the letter.
Thank you. And isn't it true for all regulators? You're always concerned about a run on a bank. Isn't that correct? That's what you're trying to prevent, correct?
Yes, Senator.
Right. So it's nothing new other than you have social media out there now that helps to amplify and connect individuals with information just like this, which may cause a run on the bank, correct?
Yes, Senator, that is correct.
But I am concerned about this moral hazard issue because at what point do we continue to bail out individuals who should know better? It's investors who invest money in banks without the insurance, the appropriate insurance. Should they be bailed out? And I guess this is a question, Mr. Grunberg, that I have for you. What should we be doing here?
Well, I think the weekend of the failures of Silicon Valley Bank and Signature Bank really posed, I think, a tough judgment for the agencies to make. I think our initial view when Silicon Valley Bank failed was it was a idiosyncratic failure, and we did not necessarily believe a systemic risk exception was warranted. I think when Signature Bank failed immediately following, and we got reports of serious liquidity stress at other institutions, it really became apparent that there was a contagion effect here. And I think there was a judgment made under the statute. You know, we have
and I get that. I only have so much time, but
Yeah.
let me ask you this, and I think it was Mr. Sue who said this, is that we should be looking at deposit insurance coverage, and it should be updated. Should we be looking at different, at this insurance coverage, and what should we be considering here?
So, you know, the FDIC issued a comprehensive report on this. We outlined some options. The one we thought had the most promise from both a moral hazard and a financial stability standpoint would be arguably increasing coverage for business payment accounts. Those are accounts that businesses rely on. They can't really hold accounts at multiple institutions for operational reasons, so it doesn't pose the moral hazard risk. But because of the business payment function, it can have financial stability concerns. So if we're going to look at an option for adjusting deposit insurance coverage, and it would require legislation to do that. Perhaps increased coverage for business payment accounts might make some sense.
Thank you. And Mr. Chairman, I'm going over my time, but one final thing that I think needs to be pointed out here. I think we're all in agreement here that there's enough blame to go around, whether it was the bad management, lack of supervision, a combination of things. We have to learn from it. But one thing that is missing in all of this, and I am hearing this from others, including my bankers, the failures of First Republic, of Silicon Valley Bank, of Signature Bank, is having a direct impact in hurting families, small businesses, right? Workers, community banks. What I am hearing is that it has caused banks to reduce their lending, resulting in less credit available to individuals and businesses. Does anybody disagree with that? No. So again, this is having an impact on working families and businesses and community banks, and we have to address this. It is something we need to come together, figure out what went wrong here, prevent it from happening, but put the regulation in place, make sure that everybody who was responsible for it is held accountable, not just the regulators, but those executives as well. Thank you, Mr. Chair.
Thank you, Senator Cortez Masto. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman. Vice Chair Barr, I'd like to start with you. The recent case study of the Fed's supervisory failures at Silicon Valley Bank frankly highlights a fundamental tension that exists between the Fed's competing priorities. Congress has given the Fed a dual mandate, of course, and monetary policy mission to target both low unemployment and stable prices. And it's a balance that evidently has been pretty difficult to manage in the current environment where rates have been driven so high so fast given the massive inflation that we've incurred during this administration. The primary mandate of monetary policy, however, also highlights an inherent tension with your supervision responsibilities. And I understand there's a firewall between monetary policy and supervision at the Fed, and there undoubtedly should be. But this conflict seems to be more pronounced than ever, because the Fed raises rates, which then creates bank solvency risks that relates to your supervisory role. So, Vice Chair Barr, how can someone in your role objectively vote to raise interest rates to advance the Fed's important inflation mandate, while also serving as prudential supervisor of bank safety, which obviously also will be impacted by your interest rate decisions? Is there an inherent conflict here?
Senator, I don't believe there's an inherent conflict in either roles, and I think it's important that when we're engaged in monetary policy, we're focused on our job at the Fed, at the FOMC, which is price stability consistent with maximum employment. And that's what we've been doing, and I've voted to do that in each instance. So that's our job. Our job is to understand.
You also wear a second hat, though, and that second hat is supervisory role. And they're two completely different functions. I won't take more time with it now, except to say it's something I think that we ought to take a hard look at. This potential conflict is a dynamic that I think requires more consideration here among our colleagues in Congress. Chair Grunberg, I want to turn to you. On Tuesday, in front of the Banking Committee here, former SVB CEO Greg Becker said that he tried to assist the FDIC in navigating SVB's balance sheet and facilitating a sale, but his efforts were rebuffed. First, I want to know if this is true. And then second, if that's so, why would the FDIC not enlist the help of somebody that would have been intimately familiar with the balance sheet, be able to perhaps better position the assets for sale and perhaps reduce the cost to the American taxpayer?
Senator, thank you for the question. It's my understanding that FDIC staff actually did meet with Mr. Becker on, I believe it was the Saturday, get input from him on the condition.
Interesting. That's contrary to what he said.
No, I'm just reporting the information I have. And to get information from him on the institution, as well as got input from him on potential acquirers.
Okay, we'll need to get to the bottom of this conflict, and very interesting. A different point, something that is deeply concerning to me and has come out with many, many bankers that I've spoken with now, and that's regard to our posture on mergers and acquisitions within the banking sector. As you know, last year the FDIC sent a request for information about bank mergers. And a request for information sounds benign, but when you look at what was imbued in this request, it was full of ideological opposition to the concept of mergers. If you think about it, from the heavy emphasis on the so-called financial stability factor to this president's executive order across all agencies on consolidation, the reductionist posture that the FDIC has taken on bank mergers is quite troubling to me. And the market certainly recognizes your agency's ideological position. If you just look at First Republic, it was clear that this bank was under major duress in the weeks leading up to its failure, yet no buyer emerged. I don't think it's a controversial opinion to state that America would have been much better off had a buyer first purchased First Republic rather than waiting until the bank was taken into receivership, leaving the American taxpayer to pick up a tab to the tune of $13 billion, and that's not to mention the $22 billion the FDIC had already taken from the DIF in March. But if you think about the market's perception of regulators' positions on M&A, it's not surprising to me that no acquisition took place. So I want to ask you, in light of your comments to Senator Britt and where we are today, do you agree that an acquisition or merger before a bank fails is better for the system and better for the American taxpayer?
Yes, I do, Senator.
And if so, the stance of the FDIC has changed in regards to the benefits of mergers and acquisitions in the banking sector. Could you update me on the status and the time frame of the FDIC's merger guidance?
We are undertaking a review of the Bank Merger Act. There has not been a review, as you may know, for 25 years. We're doing it in conjunction with the other bank regulatory agencies and with the Justice Department, which, as you know, also has a statutory role under the Bank Merger Act. And from my standpoint,
I think I'm out of time, but I think it's important to note that you are in agreement that a merger and acquisition before a failure is a better outcome for the American taxpayer. I hope that that will be very clear in your review, and I hope that we'll see that manifest because the banking community, the industry needs to get this sort of certainty. Thank you, Mr. Chairman.
Thanks, sir. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Thank all of you for your testimony here today. And Mr. Chairman, I'd ask unanimous consent to put in the record a Financial Times article, which I included in the hearing the other day as well, entitled "Executive Pay at Silicon Valley Bank Soared After Big Bet on Riskier Assets."
Without objection, so ordered.
And Mr. Chairman, I also ask unanimous consent to put in an article entitled "Silicon Valley Bank Execs Enjoyed Generous Compensation in Recent Years with CEO and CFO Packages Up to 30% from 2018."
Without objection, so ordered.
Thank you. Now, Mr. Barr, I'm looking at the report that you and your team did on Silicon Valley Bank, and on page 74, you have a section entitled "Coverage of Incentive Compensation" at SVB-FG. And it reads in part here, "Supervisors concluded that the bank's incentive compensation decisions were primarily based on their financial performance with minimal to no linkage to risk management and control factors." You go on to say that risk management deficiencies identified by independent risk factors or through regulatory examinations have not been meaningfully considered by SVB-FG's incentive compensation decisions. And it goes on to point out that they goosed their profits in order to get their return on investment up. Reading your explanation, it's an anodyne version of what the Financial Times says pretty bluntly, which is that they manipulated their profits in a way that increased their risks and had no compensation tied to the fact that they were increasing risk. So the bottom line, as I see this in their compensation structure, they profited by taking a lot more risk. Is that your conclusion?
Yes, Senator. The supervisors found that the way the board structured compensation for the firm, it did not include any appropriate risk management. That was one of the reasons why the supervisors downgraded the firm's governance and controls to deficient. The firm was not well managed, and they did not have a compensation scheme that was appropriately taking risk into account. And as you suggest, in several instances, they chose to take actions that exposed themselves to more risk because those increased profits. For example, they took off interest rate risk hedges in March through July of 2022 at a time when interest rates were rising rapidly. Instead of protecting themselves from that interest rate risk increase, they took the profit from selling the hedges.
Well, exactly. They made a decision to boost their bonuses by taking measures to boost their profits that added a lot of risk to everybody else. And, you know, this would be one thing if you had a private enterprise where the only people who are on the hook here were the executives and their shareholders. But in this case, you have all the depositors that are at risk, and the FDIC came in with public money. So do you agree that we need to better align executive compensation rules and packages for banks that are FDI insured with the risks that are being taken? In other words, do you agree that we need to take a much better look at what we should allow or not allow, and that we should not allow executives to be getting these big bonuses and through their own negligence then seeing their banks collapse? Do you agree with that proposition?
Yes, Senator, I think we need to take a good hard look at that, and the agencies are working together on a rulemaking under the Dodd-Frank Act with respect to that.
Right. So I think you're referring to Dodd-Frank 956 rules. So I would just urge you by the end of the year to get this done. Congresswoman Nydia Velázquez and I sent you all a letter with some very clear ideas for how we can better tie compensation to safety and soundness and not have the kind of situation we have here today. It's outrageous. I hope we will find a way to claw back compensation in these kind of situations that we've experienced to date, but even better, to prevent it from happening again, where people see CEOs and executives walking out with these huge bonuses weeks before their banks collapse and the FDIC and the public has to come in to support the depositors. So I just hope we'll look at this as a big part of the reform effort. Thank you, Mr. Chairman.
Yeah, I bet we all wish we could wish in one hand and poop in the other and have the wishing fill up faster. That's not going to happen. Let's see here, guys. It's time to toast out the end of the day here. I'm actually going to save the toast for you guys because I'm going to open up the back of the big tram for the last few minutes of the day here after I get done with these numbers. But I wanted to just quickly share something with you guys that I retweeted just a little bit ago here. Nick Grelly coming back through again with another one of his tweets, his amazing tweets on what's going on with the housing market. Realtors are officially quitting. The growth rate in realtors registered with the NAR officially went negative in May 2023. That's the first contraction in the number of realtors in America since the 2008 crash. And this is the picture graph that he's got going here. Realtors year over year percentage rate or percentage amount, and it is now in a decline of year over year. Let's see here. He says realtors are quitting because home prices are now on the decline. You can see the very tight historical relationship between home prices and realtors in the graph below. It's wild how closely linked they are. Yeah, that is pretty wild. And I almost would suggest that the realtor rates are not steep enough because the decline in home prices, the gap between the amount of realtors and where home price growth was at is far greater than any other point in history that I'm seeing on this graph here. Wow, it's pretty crazy. However, despite the recent quits, the overall number of realtors is still very high, just over 1.5 million, way higher than the previous peak in the mid-2000s, indicating that we are still in the very beginning stages of this housing downturn. Number of realtors in America. The big issue for realtors is commissions. Right now, the average realtor only earns $58,000 in commissions per year. That's close to lowest level on record in inflation-adjusted terms, and well below the good times of the mid-2000s and pandemic eras. But that's just an average. The reality the reality is that there's a handful of whale realtors who take a disproportionate share of the commissions, and then everyone else, many of whom likely struggle to even get that 58K in commission level. So we're likely just in the beginning stages of realtors quitting and investigating behavioral indicator to track for the economy housing market overall, because realtors quitting shows that reality is setting in. The data in this tweet thread came primarily from NAR. They release their realtor member count every month. You can also see the breakdown by state, which he provides a link for. Yeah. All right. Well, let's take a look at the end of the day numbers. Let's do this. Oops, hold on 1 second here. I think I may have to log back into my account. Well, actually, I'll just say, I'm taking you guys over the other page. I won't be able to see what it is you guys are writing, so hold those personal thoughts, comments, questions, and concerns until you see the big tramp back up on the screen again. So wait for that to happen. Two-factor authentication. If you don't have it, you may want to consider getting it, as it could prevent somebody from getting into your account that shouldn't be in your account. Actually, I'm not going to read you the rest of that, or I said read. I'm not even reading it. I'm not going to say the rest of that to you guys, because I actually didn't have to log into my account, so I guess I caught it in just enough time. All right, let's take a look at what we got going on here. Off exchange, by this time of the day, 66% combined is what I would expect to see. Numbers look a little bit low here. Off exchange is at 44.19 on AMC. EDGX is 11.28. Oops, hold on a second here. Combined total is 55.47%. That's about 10.53% less than what I would expect. CHX volume is hogging up some of that additional volume because it's 6.85%, more than double what it normally would be by this time of the day for an average for the last 30 days. And that's equating to about 553,000 shares going through that exchange. So a lot of closing out of positions going on. On APE, 52.1 is the percentage of volume going through off exchange for APE. EDGX is at 5.61. The combined total is 57.71. That's about 8.29% less than what I would expect to see. CHX volume is 0.2, still 7,500 shares. Double what you would expect to see usually going through that amount, which means we'll probably see some higher levels of return shares by the end of the day going through Ortex. GME CHX volume is 0.2 with a 30-day average of 0.21, so it's almost right on target with what it sees over the normal 30-day period of time. Taking a look at Ortex, as of an hour ago on AMC, there was approximately 650,000 shares having been returned. It's now 3.23 million shares having been returned on AMC. That's going to drop the short share interest of the free float to 24.85%. Cost to borrow min's 8.21, average is 64.29, and max is 356.8. Shares on loans at 168.59. That's 210,000 shares less than it was yesterday. And Ortex estimated about 52,000 of that was in closed short interest. On APE, still just showing a return of 26,000 shares for the day, leaving our estimated short share interest of the free float at 5.56%. No change to cost to borrow since no shares have been borrowed today. Shares on loan, 3.7 million shares were returned yesterday on APE, bringing us to 19.37 million shares on loan. Taking a look at call options, with the highest amount of volume, strike is at a $5 strike. An hour ago there was 11.5 thousand contracts. There's now 13.8. And on puts, highest amount of volume is also at a $5 strike, went from 19.5 thousand contracts to 23.9. Do note the additional large quantity of volume and in the money puts that have been purchased for the day to day, going from $5.50 strikes all the way up to 10. Quite a few. Somebody needs to return a lot of shares, and they're getting them through in the money puts. It'll be interesting to see what happens when they exercise those going into next week, because as I'll show you here in just a minute, there's going to be a lot of in the money puts going into next week. Combined price of AMC and APE is at $6.65 and rising. We finally did break that Fibonacci level at 663. Whether or not this thing's going to get the volume that we need to see that end of the day push to get some big numbers, we'll see. But we did get, I'd say for the most of the day today, we did some consolidating. We'll see if this continues this consolidate, if we're actually going to get a rip going into next week. Orders by Fidelity customers, AMC, APE, and GME are the only three I'm looking for on this list, and due to low volume, I don't expect to see any of them, and I do not. Trigger price for SSR for the day-to-day on AMC is at $4.56, APE at $1.467. Does look like they did borrow a few shares here at the end of the day to before closing out this day. Looks like they borrowed an additional 200,000 shares. That's going to put us at 1.65 million shares borrowed, according to Ortex, or not Ortex, but Sonko Tracker. So I've had somebody mention before that this is only reported by IBKR, I believe. So, and this is correct. It's only one source that's reporting here, but I think it's a good place to take a look and see where you have like returns and borrows going on. So, fees are showing up here is at 65.2%. Oh wait, I forgot to show you. 192.2 thousand contracts in the money on puts. It's a lot. 19.2 million shares. It's a lot of shares. I think that's 19 point. I always forget. 1229900. Yeah, 19.2. NASDAQ is down 0.34. Dow Jones is down 0.35. The S&P 500 is down 0.21. We have 3,553 decliners to 2,720 advancers. The market is more declining than advancing, but about where it was an hour ago. Not a whole lot of change. Some of the big moving banks, we've got, let's see, Silvergate is up 4.35. PacWest is down 3.29. Western Alliance is down 3.58. Zion is down 2.75. Coinbase is down 5.68. And that's the biggest movers. Ethereum Classic is now showing down 0.38 for the day. DXY, or the US dollar, is up 0.33. It's been struggling most of the day. It had this big drop in the middle of the afternoon, and it's been trying to recover from that. Oil is up 1.09. Mortgage-backed securities are down anywhere from, well, it looks like both BlackRock and Vanguard mortgage-backed securities are down 0.34%. SPY is down 0.23. VIX currently showing up 4.49% for the day today. VBR is down 1%. VB is down 0.94. Tesla is up 1.58. Amazon is down 1.87. Cinemark is down 1.74. Doge is down 0.04. Bitcoin is up 0.05. GME is down 4.38. HYMC is down 1.53. NCMI is up 3.13. Hood is down 1.8. Ape is down 1.84. And AMC is down 0.89. Man, I was going to go 164.504 on the close for the day today. I would have been so stinking close. I should have just stuck with my gut instinct. Oh well. I tried to change it, get fancy, and went 540 on AMC. Screwed me. Oh well. There's next week. Inflow versus outflow for the day today. We've got about $900,000 more inflow than outflow. 8.42 million shares traded so far for the day today after 360 minutes worth of trading. Putting us on a pace for 9.12 million shares traded by the end of the day today. That is within the 5 to 25 I predicted in the pre-market. On a 4-hour chart, we've got more buying pressure than selling pressure than RSI of 38.44, which is below average. On a 1-hour chart, we've got more buying pressure than selling pressure than RSI of 44.4, which is slightly below average. On a 30-minute interval, more buying pressure than selling pressure with an RSI of 46.57, which is slightly below average. On a 5-minute interval, we've got slightly more buying pressure than selling pressure with an RSI of 56.83, which is slightly above average. On APE, there is approximately almost $100,000, $90,000 more outflow than inflow. 3.73 million shares traded so far for the day today after 361 minutes worth of trading, putting us on a pace for 4.02 million shares traded by the end of the day today. That is within the 1 to 20 million I predicted in the pre-market. On a 4-hour chart, we have equal amounts of buying and selling pressure. Our RSI is at 49.54, which is average. On a 1-hour chart, we've got more buying pressure than selling pressure than RSI of 49.44, which is average. On a 30-minute interval, equal amounts of volatility on buying and selling pressure. RSI is at 50.09, which is average. And on a 5-minute interval, equal amounts of buying and selling pressure with an RSI of 49.58. This thing's just trading. It's somebody is done trading, guys. It's just they're done. They're done, and they're waiting for something to happen. I mean, it's all this is. We're waiting literally for something to happen here. I don't know what it is. I don't know. I have a feeling it's going to be next week, but we're literally waiting for something to happen. I can't see any way around it. All right. I'm going to go back to the back of the big tramp, and I'm going to let anybody who wants to toast head back there as well. If you do show back up in there, you will be live. And where is the back of the big tramp? There it is.
Safety issue. Yeah. You know, if you're on a busy highway and everyone's doing 80 miles an hour or whatever, all right, have the person scoot over to the passenger side, get out of the car, let's step over the barrier or whatever, and then we can talk. There shouldn't be any. Searching and stuff. Did Casey come in?
I did, and I agree totally.
Okay.
Those assholes that like drive like exactly the speed limit in the left-hand lane.
Oh. Well, that's passive aggression. That's not.
There's no need for that. And you know what else pisses me off? When there's 2 lanes, one's a right-hand turn lane, right? You got to turn right in some lanes, so it's always the right one. And you always get those guys that want to hog the red light going straight in the right-hand lane. Get in the freaking left-hand lane and let the people who want to turn right. You know what I'm saying? Like, don't hog the red light going straight just so you can be at the front of the line to go first. Let people turn. Pisses me off. Just
stop it.
Yeah, I know it pisses me off.
You know what pisses me off? You know what pisses me off?
What's that?
These nuts.
Well, just chop them off. Guys, Fu, Yucca, do you have any toast to the end of the week here?
Yes, I really do. And it's a toast to Pirate Born. I'm very sorry for pissing you off all day.
Are you saying, I don't know, Fu, are you saying pirate porn or pirate born?
Pirate porn with a P.
Oh, okay.
To pirate porn. Cheers.
Yes.
I do. And I'll add one more to that. What does a
grab my
pirate
drink.
porn say?
What did it
No,
say?
rawr. Cheers.
Well, I was telling Yucca earlier that there was some repeated texts in the chat, and I knew that it was getting pirate mad. So I, you know me, I'm gonna go in there and agitate. So I go in there and like,
You know,
I wonder if this is gonna.
I
Pirate was
saw
like, God
I
damn
saw it. I saw it when you came in and you did it, and I was like, is he doing that on purpose? I saw when you put in there, you're all like, I wonder if, what did you say? You said I wonder if Robinhood's going to fail because of Bitcoin or something. I don't remember what it was you said. You said something like that. I was like, dude, I'm like, you're pushing buttons. Come on, man.
I knew Pirate was gonna blow a freaking, blow an artery on that one because he was like, "God damn it, foo!" And I was like, all right, I'm sorry." Oh, it was so funny. He's such a chill dude, though. He got the joke. He was like, "Okay, I get what you're doing."
hmm I kind of got it too, and I was like, if I got it, everybody got it.
Hell yeah. Oh yeah, that was funny. So cheers to Pirate, and he needed his day.
Rex, how's it going, man?
Uh-oh. It's another good day in paradise, Casey.
Nice. Do you have any toast for the weekend?
I do.
What you got?
I got a toast to my arch enemy, Censored Content, for another successful week of his trivia.
Cheers. Wait. What's your YouTube name?
For me, it should be Aaron.
Oh, okay. Cheers.
I only got 2 points this week, man. I'll do better next week.
Arthur, how's it going, man?
Hello, everyone.
Do you have
How you
anything
doing,
you
Arthur?
do you have anything you want to toast to? But for that, you look like I saw your Twitter post on your loot grab that you got. I saw you got the awesome I wanted to call it a challenger, but it's not a challenger, is it?
No, it's a charger.
No, yeah, it's because that's right. The old school version is a charger. The new one's a challenger that looks like the charger. Yeah. So that charger looks pretty sweet. Nice grab.
Yeah, I was glad they still had some left. They kept those in under lock and key, man. They had none out on display. I was like, "Do you guys have those?" And they had to go get a manager with a key to get them out and everything. I was like, "Damn."
Wow.
Did you get the mango yellow?
No.
What'd you get? Super purple, or what's the purple one called? I can't remember the paint name.
I don't know. I thought they only came in black.
Oh. If you lived in my state, you'd really regret buying a black car.
Oh, we're talking about the popcorn bucket, not a real car.
Oh, sorry about that. Well, there I go.
Wait a minute. Wait, I'm so confused. It looks like a real car to me.
That's one big bag of popcorn next to it, then, ain't it?
Like, boy, that Arthur's got some money to get that much popcorn.
That's a lot of popcorn.
I should probably share the post, so everybody knows what it is that I'm talking about. Otherwise, it won't make any sense.
I'm not gonna,
Wait a minute.
nice. I'm not going to open the box though. I think I'm going to leave it in the box.
Yeah, that's a good idea.
Where's your little tub of butter at, man?
I don't get the extra butter. I told him I didn't want that.
Arthur, am I not following you on
Joe
Twitter?
Pines says best. Good.
Yeah, nothing to duck and see. I think you are anyway.
And that's, hold on a second. I swear I'm following you, but I can't. I'm looking you up and I don't see it.
Now I have to look up what the Dodge purple color is. Damn it. I'm like KC with a squirrel.
Yeah, it says KC Shaw follows you.
So just like send it.
I'll send you.
Yes, do that. I don't know why I can't find you. I'm trying to pull you up. I know I saw it earlier and I was like, oh, there, that's cool. I should have liked it.
There's your little high direct message.
Oh, 2001 sneeze. He got it. Pirate on my channel, on my channel, 2001 got the color before me, or before you.
Man, what did you stage this shit on a table someplace in the woods? What the hell is going on here?
It's on my car in the parking lot.
Oh, okay. I was like, what, did you go camping right after you went to the movie theater? Wait, I'm so confused now. Now I really am confused. You took all this. You took your bags of popcorn outside and put everything on the top of your car.
Yeah.
And that looks like a cherry. I'm gonna go. I bet you it's cherry Coke. Did you get cherry Coke?
No, I always get the fruit punch high C.
Okay. I could see there was a little something pink going on there. I guess it's red.
You get the rainbow drink, huh? Okay.
It's not a Bud Light.
You gotta let me know how that popcorn, the perfectly popped popcorn microwavable brand tastes.
You still haven't found any?
I actually didn't go last week and go look for it, but I want to. I didn't have a chance. Well, I'll have a chance this weekend. Didn't have a chance last weekend.
So far it's pretty good. I haven't tried the lightly salted microwave yet, but the other two are good.
Are you afraid?
Be very afraid.
No, I'm not afraid. I've tried the lightly salted in the bag. I like it. It's got salt on it to me.
Oh, Dino Mike. Yeah, that's right. We get the rainbow Ford Raptor. Have you guys seen that?
Mm-mm.
I saw that commercial.
That's going to be another Bud Light. I guess this ESG is going to be here until we change presidents, which may be pretty soon.
Is this for real?
Oh, it's for real. Yeah.
He's getting impeached.
Oh, they filed letters of impeachment.
Really?
I thought you meant the rainbow Ford Raptor. That's real too.
Oh, no, I meant because I was sitting there hearing all kinds of stuff about impeachment, and I thought, I'll believe it when I see it. But apparently it's true then, huh? Interesting.
Every president's going to get impeached from now on.
Right? I mean, that seems to be the case.
Bird Eye said his friend's Challenger only weighs 1,900 pounds. That's like a Miata, Bird Eye. I don't agree.
Do you know, I actually was looking into the specs on my Challenger, and I actually had, I didn't have like one of the bigger engines. But the Challenger itself is like one of the more heavy vehicles on the road for a car. I think there may only be like one other car that weighs more than it that's driving around on the road, and I think it's the Avalon. No, I think even the Avalon's lighter. I don't. There may not be any other that's heavier. It's a heavy car. It's wide.
I come to toast.
Oh, what's the toast?
You come from French toast?
No, that's another story. Burnt French toast, no good.
What's up, Doug?
Oh, I just come to toast on Fast X at the movie theater. Go watch it this weekend.
I mean, I'll say
Yeah.
cheers, but I'm not gonna go watch it. Cheers.
I knew Casey was going to say that. He's like anti on what's that white dude that's bald?
Family. Chuk, family. I can act. Yeah, I'll pass. 2001 Skinnies says Tesla weighs a lot more. Skinnies, we were only talking about real cars.
That's right. Tell him again. Get that electric out of here.
Yeah, you can take electric and file that right into a different category because that is not a real car.
Go-kart. There you go.
Mm-hmm.
Gosh, I had a Ford Bronco that weighed 5,300 pounds. That's amazing.
Gracious. What did you do? Put steel beams double on it?
Yeah, it was an 84, so it was a.
Yeah.
It was a monster. But I'll tell you what, nobody pulled out in front of it. Probably the easiest car to drive because it was so ugly. The paint was faded, but I'd replaced the engine in it and had a hot engine in it, and nobody knew because I kept everything else stock and just put some nice tires on it and drove around. People wouldn't pull out in front of me because they'd be like, that's an uninsured driver right there. Look at that. It looked like hell, but man, it was the funnest truck I've ever owned.
Well, I've got a story to share if it's okay with KC. It's a short one.
Okay.
It has to do with a 1966 Chevy 2-on-3 with a 283 engine in it. And it was in Naples, Florida, heading on Pine Ridge Road. And needless to say, the Mercedes-Benz dealership was right next to it when it happened at a red light. This guy comes out with his Mercedes-Benz. Pardon me if anybody has Mercedes-Benz in here, because that's what it's about. Has a Mercedes-Benz, and I guess he's not looking at his phone, texting or whatnot. Nobody knows. But he was only doing 35. And this 1966 Chevy in the front was at the red light. And he hit it going 45, I can't remember. And do you know that tin can, that's what I call them, went all the way to the steering wheel, buckled all the way down to the steering wheel on 45 miles an hour, hitting that Chevy?
Oh, man.
Well, they're designed to do that, though, right, nowadays? How long ago was it? How old is this story?
It was in the 90s, like 99.
That's a long time ago. Never mind. Nowadays, they're designed to crumple.
The Mercedes, man, there's something else. I've looked at so many wrecked Mercedes, and they're tough as nails.
I'll be right back. I gotta go shut the door. Bruno just let himself in. I'll be right back.
Yeah.
Not back then. They were tin cans.
I saw one roll over on the Autobahn doing 140, and it went over and landed on the hood, and then skidded probably 1,000 yards on the hood, or not on the hood, but on the roof, and that thing didn't crush down. I mean, it was and the guy kicks the door open and walks out like it was nothing.
Wow. Must have had like bulletproof. No.
They're pretty badass. I've looked at a lot of wrecked ones, and I'm like, boy, they take it. They take it like a champ.
It was just funny because it happened right at the Mercedes dealership on Pine Ridge Road.
Damn.
Yeah.
Yeah, I actually, it's funny you mentioned that because I actually put a souped up 283 in, it was, boarded out to 304 and put that and replaced a 351 Windsor in my Bronco and put this old Mustang engine in it. It all bolted up like no problem.
Big block or small block?
Small block.
What?
Yeah, the Windsors and the 283s are the same size.
Mm-hmm.
And they all have the same bolt pattern. So
well, I would still do the 283 in a heartbeat. That's a better dang motor anyway.
Pretty much, yeah. I agree. I agreed with you then. Pretty hot little engine with hyper-eutectic pistons in it. I mean, I ran hot gas in it, and boy, it went. It made that big old Bronco haul ass, and it looked so small under the hood, but it moved.
Well, I tell you what, whatever year it is when we squeeze, one of my bucket list, KC, is getting me a track hawk.
A what?
A track hawk.
Track hawk, yeah. Oh, boy.
I don't know what that is.
Yeah, I want one of them suckers. Hellcat track hawk.
Oh, okay.
Damn it.
Have you seen them? They're 1,000 horsepower, Casey.
I was going to say they're pushing over 900.
I think those are called red eyes.
Yeah, but the brand is
it's a demon red eye is what it's called.
Yeah.
Those that's why I didn't recognize what it was you were talking about. But the demon red eyes, yeah, those are 1,000 horsepower, and they're, believe it or not, they're actually street legal.
Barely.
Mm-hmm. But I guarantee you, if you're rolling around though in the track settings, I guarantee you're getting pulled over every time by a cop. Because they've got the two front wheels that are real thin and light, and then the back wheels that are nice and thick and fat.
They barely sound like they can run. They sound like an old man coughing. They're like, The cams are so huge and they're raising the lifters up so high. It's like, God, is that thing gonna stay running?
Heck yeah. I still would love to have one though, man. I saw these videos of them with 1,000 horsepower. They're governed down to 180, I think.
Man.
And man, oh man.
I just don't think I would want one of those because, I mean, it doesn't seem like a very good car for everyday driving. So I would probably pass. Yeah.
Oh no, that's just my toy, Casey. I got a while till my daughter grows up.
Yeah. I hear you. I'd rather have
Corolla.
No, I'd actually rather have the Scat Pack because I think you can drive it around every day and it's still got some good horsepower and I don't know. It's still good looking.
They're a good looking car, man.
Heck yeah. Well, I might have to cut this short. My baby just woke up and she's starting to cry, and I don't want everybody to hear that.
That's all right.
Y'all have a good one and have a great weekend, all of you.
Doug, you too, man. Take care.
Later, Doug. You too, man.
Bye-bye.
Good weekend.
Take care. Bye. Hold on, Scarlett. I'll be right there.
So, KC, the purple color on the Dodges is called Plum Crazy.
Mm-hmm. Yep.
And the yellow ones are called Mango Yellow.
Yeah, I guess good names. Good colors too.
I think Dodge used to have a color called Electric Peanut Butter.
Electric Peanut Butter.
That sounds gross.
It was the 60s, man. It was the 60s.
Deb's talking about. Tell me about it. I deal with it every day. Not just cars block the left lanes. The trucks piss me off too. Yeah, those I can't deal with it. It's terrible. I don't even really drive that fast, Deb, to be honest. My wife, I think I piss her off because I don't drive fast enough. I think she gets a little annoyed when I'm driving, and so, but even so being a person who doesn't even drive that fast, for me to get angry at people not driving fast enough in the left-hand lane says something, you know. But it happens quite often.
Anger management.
No, it's okay to just yell at people. It's a great way to release.
Uh-oh.
I use other stuff to release.
Yeah. Moving on. Pirate-born, if I did get your request, I will accept it. Who's Jim Brown? Why do I not know who Jim Brown is? Who's Jim Brown?
Uh-oh.
That's
That sounds very fishy.
Jim Brown.
James Brown. Is that what he's saying?
Well, he said Jim Brown, and that's an American former football player. I don't know who. I know who James Brown is, but I saw Jim Brown.
Oh, James Brown. Yeah, he's a football player.
I'm not.
Held a lot of records.
I'm not
Joe
into
Brown?
football.
I know who Joe Brown is.
Judge.
Seawin says Jim Brown was an NFL great. I guess I just don't. I'm not that too much into football, I guess.
Does he mean Bo Jackson?
No, he was talking NFL. Bo Jackson was a hell of an athlete, though, huh?
Something else.
Whatever happened to that guy?
Broke his
No.
bone.
I mean, like, what's he doing now?
Well, that's a good question.
Yeah.
I don't know.
Remember Barry Sanders played for the Lions?
Yep.
Yeah, he wasn't anything like Bo Jackson, though.
Jesus, man. But Barry Sanders was like top of the game, and then he just said, all right, y'all, bye. He just left the NFL.
I don't blame him. He get beat up in that game. Bad. I'm surprised Jim Brown made it to 87. I mean, holy crap, that guy, he was like a linebacker who played halfback. He was huge.
I'm going to sign off here, guys. I've got to close out the end of the day. I'll come right back after I end out the show, but I'll be back in just a few.
All right, love chat. Love you guys. Thanks for talking to me all day.
All right. Unfortunately, guys, it is that time of the day. And as usual, like always, all good things must come to an end. Eat, sleep, drink. Get plenty of rest. You have a 2-day weekend ahead of you before we have another trading day. Spend time with your family. Spend time with your friends. Go out to see a movie, because after all, that is what we're here to do, is support AMC. And take your pets out for walks, for crying out loud. They like to get outdoors too. But above all else, don't have a good weekend. Have a great weekend. Beep, beep.
T-minus 90 seconds and counting. All systems are go. We're about 90 seconds from the launch of Space Shuttle Discovery. T-minus 60 seconds and counting.
We cleared all of our constraints from weather
We are transferring to orbiter internal power at this time. Discovery is now running off its 3 onboard fuel cells. Coming up on a go for auto sequence start. And we have a go for auto sequence start. Discovery's onboard computers have primary control of all the vehicle's critical functions. T-minus 17 seconds and counting. 15, 12, 11, 10, 9, 8, 7, 6, start, 2, 1, booster ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
Separation confirmed. Guidance now converging. Discovery's onboard computers commanding the main engine nozzles to swivel, aiming the shuttle for its precise target in space for main engine cutoff.
Should have a good forward leg now in S10.
Okay, you sound good.
Discovery Houston, negative return.
Copy, a negative return.
With the mustache and a supernova, tossed off the cliffs of Dover, washed up on a faraway shore in the arms of the daughter of the buffalo. Mama said he was a chosen one, Ray said he was the other one. All that paid no mind inside his econo line. Swallow our planets, the prophets of doom. Quarterly projection, the prophets of doom. The prophets of doom. The prophets of doom. The prophets of doom. A caliph, rabbi, and a bishop walk into a bar. One says to the other, hey now brother, just for you. Never trust the white man driving the black man. He just saving all his voodoo for you. Just for you.
Getting cold, you're needing a shoulder. Puff out your chest and be a little bolder. All we do is buy and hold. There will be shills who wanna steal your thrills. There will be friends who hold till the end. There will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead. Panic and fear really are near. It's not ours to own. We have shown that all we do is buy and move. Oh, there will be shills who wanna steal your thrills. There will be friends who hold till the end, and there will be doubt, fear and cloud, but it's all in your head. Those hedgies are dead, so when the nights get colder, you're needing that shoulder. 'Cause Ape's got your back, we got each other. All we do is we got